Good morning or good afternoon, depending upon where you are. I'm Jim Stock, co-editor of Brookings Papers on Economic Activity. On behalf of my co-editor, Jan Eberly, the Brookings Economics Program, and the Brookings Institution, welcome to our Spring 2021 conference. We have 4 regular papers and 2 panels, one panel on the COVID crisis, and a second on intellectual contributions by Brookings papers over the last 50 years. Last March was our 50th anniversary, but for obvious reasons, we pivoted at that point. But we're going to return to the theme of Brookings' 50th anniversary this afternoon, and we'll say a little bit more about that before it begins. Let me go over some mechanics. The session timetables, authors have 15 minutes, discussants have 12 minutes, and then the rest is open discussion. The panels have 15 minutes per panelist, and then the rest is open discussion. It is, as the authors and presenters know, as everyone knows, at this point, it's kind of tough to stay on schedule to intervene in Zoom, so please stay on schedule. At lunch, we're going to have 3 breakouts for the participants. So after a 10-minute break, we'll have 3 different sessions. You should have gotten some information from Anna Dawson yesterday at 11 o'clock with some links, and she'll send the links again at 1 o'clock this afternoon. So grab some food and then eat and join, and hopefully each session will be on a topic from the morning. Zoom protocol. So important note. So just like we were in June and September, this is being webcast live, so everything is on the record. If you're a participant, you can ask questions during the conference, and Jan and I will call on you. The best way to do that is to use your raise the hand feature, and then we will unmute you and you'll be able to ask your question. If you don't want to do it that way, you can type in a question into Q&A. You can also use the chat function. We'll be monitoring that. If none of that works, you can email events@brookings.edu, and hopefully that will come through. So that's order of preference. If you have any technical issues, email Anna Dawson at Brookings. And without any further ado, let's go to the first session. So the first session, the paper is by Jamie Lenny, Brian Lutz, Finn Schula, Louise Shaner, and Brian Lutz is going to be the presenter.
Okay. All right. Hopefully everybody can see the slides. If not, somebody should let me know. Okay, I want to take that. Yeah. Good. Okay, thank you, Jim. Okay, I want to take the opportunity at the outset to say a major thank you to Lorena Barcena and R.A. Brookings, who has been absolutely essential to this project. Okay, I need to start with the disclaimers that the opinions you hear today are those of the authors and not necessarily those of the Federal Reserve nor of the Bank of England. Okay, so I'm going to be talking about the fiscal sustainability of state and local government pension plans today. And we're going to be asking, are these pensions fiscally sustainable under current benefit and funding levels? And if not, what could be done to render them sustainable? To give you a preview of what we're going to find, in aggregate, we find that these pensions are not currently sustainable under low or moderate asset returns, but that they can be stabilized in most of our scenarios with what we'll term moderate fiscal adjustments. We find only modest returns to beginning the stabilization process today versus, say, waiting 10 years in the future. But there's tons of heterogeneity in this space, and some plans are far from stable. In terms of background, in recent years, there's been really significant concern expressed over the size of unfunded state and local pension liabilities. Our discussant today, Josh Rao, has estimated these liabilities are as large as $4 trillion. And this is very similar to the now official estimates put out by the BEA, the Fed, and others. You know, these estimates imply a funding ratio of only 50%, meaning the assets on hand will only cover half of the benefits accrued to date. This lack of full pre-funding has generated really widespread sustainability concerns for the pensions. This has come in a sort of a nonstop flow from academics, the press, rating agencies, and policymakers. But stepping back from the standard narrative, it is useful to realize that pre-funding is not required for fiscal sustainability. In fact, in the extreme, even a fully unfunded pay-as-you-go pension can be sustainable. A fact that's been well understood since at least the work of Paul Samuelson in the 50s. A pay-go plan will be sustainable if the internal rate of return paid to retirees does not exceed the growth rate of the wage base. In this case, you can simply pay benefits to current retirees out of the contributions going in for current workers and maintain stability. Another way to see this basic point is to note that unfunded pension liabilities are simply a form of implicit public debt. And as has been widely discussed in recent years in the macro space, of course, public debt does not have fiscal costs in all circumstances. In particular, in low interest rate environments, you may be able to roll over the debt and maintain it as a share of the economy without any need for tax or expenditure adjustments. You know, a fairly straightforward corollary to this is that the failure to fully pre-fund pensions does not necessarily imply the need for future fiscal adjustments. You may simply be able to roll over the unfunded liabilities as a share of your economy. But I do want to be excuse me, very clear here that, caution is required. Pension debt may be sustainable in principle, but it need not be so in practice. And in fact, again, our findings suggest that under low or moderate asset returns, they're not currently stable. Okay, so most analysis of state and local pension plans to date has focused very heavily on a full pre-funding benchmark. In contrast, we're going to focus on pension sustainability of only partially pre-funded plans. And the analysis of partially pre-funded plans is very consistent with the historical record, as all the official sources now show that state and local pensions have never even approached full funding at any point in their history in aggregate. So we're taking these plans very much as they are and as how they have always operated. Okay, in terms of methodology, analyzing fiscal sustainability requires having projections of the full future flow of promised benefit payments to retirees. Very unfortunately, these cash flows are typically not available. We're going to respond to this by reverse engineering the cash flows. We're using a method pioneered by Novi, Marks, and Rao, our discussing Josh today. These authors deserve a lot of credit for innovating this method because it enables several types of analysis that they're just infeasible without it. To do this, we're going to collect data by hand from the actuarial reports and financial statements of the plan on things like plan membership, actuarial assumptions such as mortality assumptions, and plan benefit parameters, things like cost of living adjustment. We then construct statistical machinery to age our workers and retirees each year and calculate benefits each year. And then finally, we add in new workers based on demographic assumptions. We're doing this for a sample of 40 plans. This relatively small sample size reflects the extremely labor-intensive nature of the methodology and the real care that we put into modeling each plan to ensure that we have the contour of benefits correct, because as you'll see, that's crucial to our results. However, our sample is observationally essentially identical to the universe of state and local pensions. Okay, so here we have our first result. We plot total aggregate benefit payments going to retirees as a share of the economy in the US by year. The first thing to note here is benefits rise over the next decade and then flatten out, but the rise is quite muted, only about 5% when denominated as a share of the economy. These benefits then decline really substantially. This is quite important because it indicates that plans have fiscal relief in train and carries the implication that there's the ability to smooth through this period of peak outlays. It's also a very surprising finding. It certainly surprised us tremendously when we first got it. Because of the aging of the population, we project that the ratio of beneficiaries of these plans to their workforces are set to rise sharply over the next 2 decades. All else equal, this would tend to push up benefit payments as a share of the economy. So we've put great care into trying to model why this is the case. And it turns out there's 2 key reasons. The first is that in recent years, cost of living adjustments have very systematically been set below expected rates of inflation. And this causes for any given retiree the value of their real benefits to decline over their years of their retirement. The second factor is that although the plans are typically legally inhibited from reducing the benefits of current workers. They have full latitude to do that for workers not yet hired. And systematically, almost all the plans in our sample have enacted fairly large downward adjustments to the generosity of the plan for new hires. You can see the effect of these two factors on benefit outflows by comparing the gray line, which is our baseline estimates, to the blue line, which is a counterfactual where we set COLAs equal to inflation, and we simply flip off all the new hire reforms in our sample. And you can see that the effects are dramatic. About 2 decades out, there's a 15% difference between the baseline and the counterfactual. And then further out, there's a full 30% difference. You know, the fact that these factors are pushing down benefits so significantly is really a first order fact in assessing the fiscal sustainability of these plans. And we believe that we're the first to systematically document this for the nation. This is an outcome of the fact that we very carefully modeled all the different benefit tiers for new and old, old hires. Okay, so moving on to the sustainability analysis, we're going to assume here that plans maintain current contributions and benefit. We're going to discount the stream of future benefit payments at a risk-free rate. Although, as we discussed in the paper, the choice of discount rate has very little influence on our estimate of how much contributions need to change to stabilize. We're going to consider 4 deterministic real rates of return. The first is a risk-free rate that's 0%, market-based, based on current TIPS yield as of about a month ago, although they haven't changed tremendously. We do view this as conservative. The market-based risk-free return measures may overstate the cost of governments bearing risk due to their ability to spread risk both contemporaneously and particularly intergenerationally. Now, there's a large literature on how to think about risk and government budgeting going back to the 60s. Debbie Lucas, our discussant today, has been a key contributor to that, and I know she's going to have some things to say. So we're very interested to hear about that because this is an area we've wrestled with. So we're also, because of this, we're also going to present some other rates of return, just a 5% expected rate of return. This is simply the risk-free rate with a 5% equity premium, which is about the historical equity premium. We're going to do a middle ground 2.5% real return. And we're also going to use the CBO's risk-free rate projection, which remains low for many years, but then gradually rises more towards its historical average. Okay, so here we plot total assets for state and local pensions as a share of GDP. The black line shows what happens to these assets under current benefit and contribution parameters, and the black line is a 0% rate of return. You see the assets are drawn down and exhausted in about 30 years. The red line shows what happens under a 2.5% rate of return. Again, they draw down more slowly, but are exhausted in about 45 years. With assets falling continuously, debt is rising indefinitely. The plans are clearly not sustainable. They are, though, more than sustainable at the 5% expected rate of return as assets grow without bound. Okay, so under the low and moderate returns, what could be done to stabilize these plans? We're going to run 2 exercises. The first is a long run exercise, which calculates the one-time change to contribution levels made in perpetuity that would result in the pension debt or unfunded liabilities as a share of GDP to be constant in the long run in our steady state, but without regard to the level of that debt. We also do a medium-term 30-year exercise where we calculate the change, which if maintained for 30 years, would result in the debt to GDP ratio exactly matching today's in 30 years time. I want to be, intuitively, this exercise is the dig the hole no deeper over the next 30 years idea. I want to be clear that all stabilization exercises involve stabilizing unfunded liabilities and also honoring all benefit payments. I also do want to be clear, because it can be obscure given we don't have a lot of time today, that although it never occurs in aggregate, there are some instances of particular plans running into negative asset positions. What this entails is that these plans would take out marketable debts when their assets are exhausted, use the proceeds to pay benefits over the period in which the benefits as a share of the economy are receding, and then in steady state they make current benefit payments and service the debt out of their contributions going in each year. But this is not the typical outcome by far, but I do want to be clear about that. Okay, here's our first result. We see for stabilization, we see that at 2.5% rate of return, if you start today, you need to increase your contributions by 8% of payroll in order to stabilize your debt in the long run. To put this into context, over the last 10 years, pension plans have increased their contributions as a percent of payroll by 10%. So if they do a bit less than what they've done over the last 10 years over and again, they would be able to stabilize their debt at the 2.5% rate of return. This only goes up to 10% of payroll if they wait 30 years, although it does come at the expense of stabilizing at a higher level of pension debt. Now, of course, if we go to the risk-free rates of return, the contribution increases become larger. These are certainly not small and would entail some, moderate to more than that fiscal strain. It's about 15% of payroll, but it certainly seems achievable in the context of having done 10% in the last 10 years. An interesting aspect here is that the required contribution actually declines if you wait. This may seem counterintuitive, but it's really the relatively straightforward result of the fact that purely from the standpoint of debt stabilization, when GDP growth is above the rate of asset returns, assets impose a pure cost on you. They're never available to pay benefits, and you have to put in additional money each and every year simply to maintain the assets as a share of the economy and therefore keep your debt stable. And so by waiting, you draw down your assets and stabilize them at a lower level, which is actually less costly. Okay, so I'll now turn to the medium run exercise here. We're getting back in 30 years to where we are today in terms of debt to GDP. At a 2.5% rate of return, it's a 7% increase. The cost of delay in this case is larger. It goes up to 17%. There's a larger than compared to the long run exercise. That is because in this instance, you're waiting 30 years, accruing more debt, but you then have to pay that debt down over the subsequent 30 years, and that becomes more costly than the long run exercise. Okay, a point I want to make on this slide is that regardless of your preferred rate of return, in all cases, the increase in contributions required to stabilize debt is much lower, radically lower than that what would be required to move to full funding in 30 years. So the table on the right here shows the contribution increases required to reach full funding in 30 years, which has been a heavy focus of the past literature. And we see here that at 2.5% today, you have to increase about 35%. But if you only want to stabilize your debt over 30 years, it's a 7% increase, 1/5 as large. This table very clearly shows the different tenor of our results relative to a lot of the past work. Okay, the last result I will show you, because I'm almost out of time, is the very important heterogeneity. On the vertical axis, we have our calculation of the required contribution change at 0% rate of return to stabilize in 30 years. And on the horizontal axis, we have the traditional funding ratio. I'd like you to take two things away from this graph. The first is that there's tremendous heterogeneity in terms of the required contribution. There are some plans that have to make horrifically large contributions, and there are a lot of plans that actually can cut. The second thing I want to emphasize is that the identity, the place where the particular plans fall may really surprise you. For instance, the two-state Illinois plans here, which are among the most poorly funded in the nation, actually can cut contributions and stabilize, even at a 0% rate of return. And this is the result of the fact that these plans have made absolutely massive contribution increases in recent years and radically reduced the value of the benefits to new workers, which our forward-looking measures give them a lot of credit for. Okay, I am out of time. So my last point will just be to acknowledge we have lots of limitations in this paper, of course. One that is clear is that we use a deterministic framework which ignores risk, particularly around asset returns. We'd like to address this in a stochastic framework in future work. It's also the case that it's very difficult to think about pension funding in isolation from the broader state and local budgets and objectives. Our paper suffers from this, as does most other papers in this space, and we'd like to address that in the future. So I'll leave it at that. Thank you very much.
Thanks very much, Byron. Our first discussant is Debbie Lucas.
Okay, great. Thank you. So I want to just one second. Okay. I want to start by applauding the authors for their contribution to our understanding of what future benefit payments associated with S&L pension liabilities will look like, and for emphasizing the importance of those projections for evaluating the sustainability of a public pension plan. I guess it's said that imitation is the sincerest form of flattery. So I'll note that we have a project underway at the Golub Center to do a similar exercise for what we hope will be a much larger universe of plans. We're just getting started on that, but I can attest to how much work it is to create each new data point. I also want to emphasize a few points where there's fundamental agreement. The first is that reasonable projections for assets and liabilities suggest that absent a major meltdown in asset prices, there is unlikely to be a serious crisis caused by S&L pension plans being unable to meet their liabilities, at least not the sort of crisis that will have major repercussions for the aggregate economy. To elaborate a little, even if some plans run out of funds much sooner than suggested by the analysis in this paper, and I believe that some will, those exhaustion dates should be staggered over time, again, absent a very major market meltdown. Hence, I agree it's wrong to view the situation as an impending crisis. I also want to concur with the lack of any imperative to quickly or fully close pension funding gaps, although for reasons that are quite different than the ones suggested in this paper. I've written about this in the past and excerpted from that work in the appendix to these slides, but I won't spend time on that today. But in any case, the authors go much further. They argue for the provocative position that not only is there not a looming crisis, but really there's no reason to worry. In fact, they suggest it might well be desirable to divert funds from covering funding shortfalls, and that such policy is likely to be sustainable. Along the way, they also question the need for risk-adjusted discounting in public finance, which has been my life's work. But in the interest of time, I'll put that in my written comments and not talk about that today. What I want to focus on is the fact that this conclusion about this high degree of sustainability comes from a trip down the rabbit hole of R minus G identity accounting. So my discussion is mainly about what this sort of analysis is for, the reasons this sort of analysis is highly misleading in general, and in particular in the context of public pension funds and the conditions that would be necessary to make them sustainable. Okay, so let me start by quickly summarizing my main points, because I might not have time to really elaborate on all of them. So just to start with the values of R considered here in the analysis, I don't think the choices are the best ones, even if you are going to accept a risk-free paradigm. I think basic theory, basic optimization theory implies that in general, certainly in any steady state analysis, R is greater than G. So there's a theoretical point, but also I think if you look at what's going on in financial markets today, you would come to a different conclusion about the likely level of future R. Perhaps more fundamentally, defining sustainability as stability is unsatisfactory for both conceptual and practical reasons that I want to go over. So going a little bit back to the return on assets, it's likely to be higher, but more importantly, more volatile, much more volatile than what's assumed here. So I want to suggest that under a more reasonable definition of sustainability that takes into account the possibility of running out of funds along the path that you're on, rather than under some kind of a steady state assumption, funding levels matter a lot, and a larger number of plans would be classified as unsustainable. So the first issue is, if you're going to do a steady state analysis, what's the right risk-free rate that you might choose? Clearly, it's possible, and many believe likely, that interest rates are going to rise significantly, and that generally they can be expected to exceed GDP growth. So let me start out with the support for that from first principles. I always enjoy doing this math, and I'm going to not walk you through all of it, but just make the main point. So if you just looking at this slide, if you just write down the simplest intertemporal utility maximization problem where people are smoothing their consumption between today and tomorrow, it becomes clear that the way that RNG actually interact is through preferences, and taking that into account, in fact, you get, if you assume that utility takes a log form, you get the result very quickly, that as long as the rate of time preference is positive, the interest rate is going to exceed the growth rate. I think the best way to think about that is if you think of the growth rate as coming out of something like productivity growth, the interest rate is coming out of market clearing. So the market is responding in terms of its savings and investing decisions, and the R is clearing that market. And if there's a positive rate of time preference, you wind up with an R which is greater than G by approximately the rate of time preference. While I'm on the theoretical side, I just want to point out that there's an old paper by Kip Viscusi that noted some of the properties that are emphasized in this paper about the kind of weird things that happen when you assume a zero interest rate. He noted, for instance, that there's no advantage to acting now instead of later. He actually labeled this as a paradox, not as something you might want to use to analyze the world. And he noted that it could lead to conclusions we actually don't like, such as that we might be indifferent to waiting indefinitely to take any action to abate climate change. Okay. So in any case, let's go on to what the market has to say about all of this. I have two graphs here. One is simply a picture of the current severely upward sloping yield curve there on the right. And if you look at the implied forward rates on that yield curve, the nominal implied forward rate, say between 2026 and 2051, is 4.4%, much higher than most of the rates assumed in the analysis. It's also interesting to look at the implied volatility data and to see that actually opinion has changed on the likelihood that we will wind up in this higher inflation regime, which will lead to higher interest rates. Okay. Okay, so what I would just say about that in conclusion is, like other R-G analyses that suggest governments can spend freely without adverse consequences, the authors are focusing on current levels of RNG that in this moment in time favor that optimistic conclusion. However, for long-term or steady state analysis, best practice would suggest putting more weight on his historical experience or more normal configurations of RNG, as well as considering forward-looking indicators from market rates. But now let me turn to the fundamental question of sustainability. The paper focuses on the stability of the steady state ratio of debt to GDP, but I think it's reasonable, and most economists would agree, that size also matters for debt to GDP sustainability. Quite simply, when debt to GDP is at 100%, it's much more sustainable than if it's at 200% or 500%. This is just one of my favorite pictures from the cover of CBO's long-term budget outlook. And at the federal level, we don't seem to be converging to any steady state. But in any case, it's also important to note that if you do have these underfunded state and local plans and you add that underfunding or that level of debt to GDP on top of what's going on at the federal level, it looks a bit scarier, a lot scarier than what they have in the paper. Okay, so what does constitute stability? I think there's also more fundamental considerations that arise from political and institutional constraints. So an alternative definition that I'd prefer is that a fund is sustainable if it can meet its contractual obligations with a high probability. I think the analogy is to the Social Security system, where whatever the truth is about the future of the economy and the sustainability of benefits, kind of in theory, the exhaustion of the trust fund will trigger a crisis because budget authority will run out to pay full benefits. And so in the same way for state and local plans, if their assets go to zero, that is a crisis, at least a local crisis. So the steady state or the very long run is largely irrelevant. But what does become relevant under this definition is asset returns and the uncertainty about those asset returns. So those become critical. So that leads to the question, well, what would be more realistic assumptions about asset returns? I think you don't really need to get into the details of what these plans do. I think if you just group them into risky and safe assets, you kind of get at the essence of it for this kind of an analysis. And so, I'm kind of on board with a risk-free rate of 2.5%, an expected return on risky assets of say 7.5%, that's both nominal, but importantly, a standard deviation on those risky assets of 20%, which is kind of consistent with the stocks and the alternative assets that these pension funds invest in. Most of these, there's a variation in their investment strategies, but most of them are typically 60 to 80 or even 90% in risky assets. So for a given funding ratio, if you take this situation as being more true about asset returns, it kind of pushes in both directions. You have a higher expected return than most of the analysis in the paper, and that will make the funds appear to be more sustainable and that it will take them longer to run out of money on average. But of course, that volatility implies there's a chance of running out of funds in the intermediate run. But certainly it's true that as soon as you take volatility into account, underfunding does increase the likelihood of exhausting your assets, and hence it does reduce sustainability for better or worse. Okay. I think that by my definition of sustainability, which requires shortfalls to be much more unlikely, most public plans are in fact not sustainable. I recently published a paper with Dan Smith, who's now a PhD student at Boston College, which looked at actually the sustainability of a collective defined contribution plan, but it very much had the ingredients that would help you evaluate what was going to happen here. And the bottom line is that in a DB world, if you take our analysis as kind of representative of a typical public pension fund, in about 10% of years, even with very modest pension benefits promised, more modest than you see in the world, plans would run into problems. So I would encourage the authors to simulate the exhaustion date distributions for individual plans when returns are risky. I know they say in the paper that they're planning to do that in the future, but I think this current paper would be much more persuasive and informative if they would also look at it here. And I know I'm out of time, so thank you.
Thanks, Debbie. That was terrific. Josh Rao.
Okay. Hello, everyone. So thanks very much to the organizers for inviting me to discuss this very interesting paper, The Sustainability of State and Local Government Pensions, a Public Finance Approach. I also want to start out by commending the authors. I learned a lot from reading this paper, and I think that there's actually much that we can learn from it, although I do have some critiques of various pieces of it. So just as an overview, although I probably don't need to do this now being the second discussant, but obviously the paper is studying the sustainability of pension promises. The goal in the paper is the stabilization of pension debt to GDP or unfunded pension liabilities to GDP. This is a hard question because it requires the projections of annual pension fund cash flows and accruals in a landscape of heterogeneous plan design. So I fully appreciate how challenging this is. And furthermore, because of the long horizon nature of this exercise, it relies on a modeling of new entrants into the system under current pension deals that new entrants are receiving, which in many cases are different from earlier tiers due to reforms that have been implemented by public pension systems. And these reforms have varied across pension plans in the US. So it's really a pretty challenging exercise. The bottom line of the authors find, of course, is that only moderate fiscal adjustments are required to stabilize pension debt to GDP on average. There is significant heterogeneity. And so that's the finding, and I'm gonna have a few comments about that. So first of all, I think that the stabilization goal is very reasonable to consider. You know, I also want to agree with Debbie Lucas, the first discussant, and the authors, that it is perfectly reasonable to consider the goal of stabilizing unfunded liabilities to GDP, because the optimal level of public debt is very unlikely to be zero, and unfunded pension liabilities are another form of public debt. So in that sense, I very much appreciate the public finance approach that the authors are taking here with the stabilization goal. However, I think that there are some elements that are missing. And the main one is that the public sector's approach to funding pension liabilities with risk assets creates additional issues for this particular type of debt, for unfunded pension liabilities, relative to government bonds. And what is that issue that I have in mind? There is substantial instability due to market risk that isn't in the model, because the model is deterministic. There is no distribution of possible outcomes in this model. In fact, in practice, the higher expected return you target, the greater is going to be the distribution of outcomes, the wider is going to be the distribution of outcomes. But because of the non-stochastic nature of this exercise, that simply isn't in there. And so, you know, another way of saying this is a sentence that the first discussant, that Debbie Lucas said, which is that the likelihood of exhaustion is going to increase the more unfunded the liability is, and also the more risk that there is in the pension system. And in terms of that unfunded point, it comes to the idea that the stabilization that happens if one, you know, waits for a long time is going to be at a much lower level of funding. And so this is going to expose, in a stochastic analysis, would expose funds to much greater risk of insolvency. So in my view, actually, when I read this, I mean, in my view, in this paper, the only meaningful scenario right now is the R equals D equals 0% real scenario. And in that scenario, the fiscal adjustment is, as Byron Lutz said, 14.9% of payroll if you start now, versus 29% if currently. Currently, that's the summary statistic for what is the contribution percent of payroll. So that's a 51% increase. And Byron, I heard you say that, you know, well, they've already increased by 10% of payroll in the past, so another 15% shouldn't really be a problem. Okay, I mean, it's a 51% increase. I think that's a statement that we can assess. I'm also going to provide some reasons that I think this still might be low. But, you know, even in the same breath as saying that criticism, I also want to say that I think we learn a lot, even from this R equals D equals 0% scenario, because underlying all of this is still the author's very careful analysis of what the reforms are that have already been made to pension benefits. And I think that's something that the literature or the research that I've seen has not really come to grips with. And I think that if the paper, the only big contribution of the paper were to highlight that and say, what has that been worth in terms of reduced contribution increases, that by itself would be a very big contribution. So I want to say that. So some graphs that I just wanted to show to give a kind of big picture of this. This is from the Federal Reserve's Financial Accounts of the United States, and it shows the assets and liabilities of state and local pension plans. There is an original number, which I'm calling the old series, that was discontinued in 2018. And then there is a new series, which was begun in 2018, but it was also calculated going back. These are based on BEA, a BEA method from the BEA that is incorporated into the Federal Reserve's Financial Accounts of the United States. And so the point of this is to show that with the updated methodology, actually, you know, the official numbers for unfunded liabilities are, as of the latest 2020 Q4, around $4 trillion. So those are those numbers. There's some methodological details about, you know, how they do. Suffice to say, I think the new series is more accurate. Now, when you scale this by GDP, this is what the figure looks like. And the key thing I want to highlight is that since the financial crisis, unfunded liabilities to GDP have been hovering at around around 20% of GDP. During this time, what has been going on? Okay, first of all, the S&P 500 total return, and pension funds are heavily loaded on the stock market, was 517% over this time period. So there were incredible tailwinds from equity markets over this time period. Other things that were happening where we had strong tailwinds or strong help were contributions to public pension plans by the governments rose from around 0.7% of GDP to over 1% of GDP. And the third thing that was going on is what the authors are highlighting, which is that there have been some benefit reforms that tend to affect the out years. And so I think that the big question is, have those benefit reforms been effective enough so that if we can kind of get over this, what the authors are modeling or are finding as a kind of hump in benefits to GDP, that that with some additional contribution increases that we can achieve sustainability without having to hope for these 15-16% annualized returns that we had over the recent period. All right, so standard finance market model. I just wanted to show a picture of this on the to illustrate, I think, what we've been trying to say about the importance of doing a stochastic modeling of these of the asset returns. This is just a standard finance market model, and again, as I was saying before, I appreciate, I'm on board with the wisdom of the public finance approach of saying, how can we stabilize unfunded pension liabilities with respect to GDP? But I'm not so on board with the idea of abandoning the finance insight, which is that if you target a higher expected return than the risk-free rate, you're taking on a distribution of outcomes. And this is a graph. You can play with the assumptions. There's a website here that I constructed with a colleague. And this is just a way to just visualize this over 30 years. What is the distribution of outcomes in the standard Black-Scholes-Merton assumptions? And you can tweak these in various ways. You can put in some shorter, medium-term mean reversion and so on. But this targets a 6% expected return, and that's roughly what the mean annualized expected return is over 30 years. But it shows that that's kind of in the 65th percentile of the distribution when you target that return. In fact, more than half the time, you don't achieve the expected return, and that's because the median of the distribution is below the average. I just think these are very important. As soon as this one starts deviating from a risk-free scenario, I just think these are very important insights to build in. I also want to say that, I was excited when I saw that in this paper, the discount rate and the expected return might play distinct roles, because they should play distinct roles. The discount rate measures the liability. The expected return is measured by asset allocation. But in order to properly incorporate that expected return difference from the discount rate, one has to incorporate a distribution of outcomes. Also, I was asking myself, okay, what does it mean to separate the discount rate and the expected return in a deterministic analysis? And there is an analysis of this paper, of the LLSS paper by Kestrel and McGee, who analyzed the steady state of this paper. And they point out, and I believe this point that they make is correct, that the steady state contribution rate ultimately becomes independent of the discount rate and depends only on the expected return. And so the paper does rely on the idea that one can earn above risk-free profits with certainty in perpetuity. I just don't think that's a beneficial feature of the paper, given the potential that it has to make so many good points about what the impacts of the reforms that have been made have been on the necessary contributions. So again, in my view, the only meaningful scenario right now without a stochastic analysis, without a distribution of outcomes, is R equals D equals the risk-free rate. And as I mentioned before, the authors find that if you go from a 14.9%, if you go from a 29% of pay baseline, which is where we are right now, if you increase that to 14.9, increase that by 14.9%, that would stabilize unfunded liabilities as a share of nominal GDP today. So that's a 51% increase. When I looked at just what the employer contributions would be that would be necessary, again, not to fully fund, but just to stabilize, to pay the present value of new benefit accruals, plus the interest on the unfunded liability, I found an 83% increase. And of course, the authors also find that if you wait 30 years, you only have to make a 30% increase. So I actually think the discussion should be around this. My number is probably too high because it doesn't incorporate the benefit changes that are going to happen in the out years that have already been built in for new employees. And so I think that there's definitely something to be learned here by understanding how much of a change in necessary contributions is occurring due to those changes. I do have some comments about the adjustments just even under this R equals D equals RF scenario, which is what I'm focusing on. First of all, there are a number of plans that are insolvent before 30 years. Around 35 to 40% of the plans are insolvent before 30 years. And there's this idea in the paper that plans can issue debt to smooth through the period of the peak benefit outflows. So, and Debbie Lucas made this point too, if there's any volatility, then there's a chance that more could become insolvent. And I think that that's a serious issue to contend with. I also maybe want to use that point to also point out the fact that there are a lot of plans in the U.S. states that have been issuing debt in order to fund pension obligations, either directly with pension obligation bonds, but maybe more commonly just by issuing lots of debt and making pension contributions. So I think that that's a piece of this that has to be considered as well. Second, this has been discussed before, waiting would stabilize the funding ratio to much lower level. It still becomes less costly as a share of payroll because of the G greater than R assumption in the model. But even taking that as a given, one has to consider the risk that the volatility is in the plan is going to add becoming insolvent. And then finally, I have a request to the authors, which is to really understand the mechanics. And when I say mechanics, I mean to understand how much these benefit changes have impacted the required contribution rates. There's some additional info that I think would be great to disclose, which are just, what are the model normal costs or service costs? These are the present value of new accruals at T equals 0 and T equals 30. What is it at the risk-free rate T equals 0 and T equals 30? What are the calculated pay-go rates at T equals 0 and T equals 30? And what is the funding ratio that we're stabilizing at if you start increasing contributions at T equals 0 versus T equals 30? That would help make the exercise a little more transparent. That's it. This is a really interesting paper. It's asking a very good question and taking on difficult modeling. I do appreciate the public finance goal of stabilization of pension debt to GDP and believe that's a valid goal to consider. But I think it's not advisable to ignore the finance insider distributions of outcomes. In talking about this paper, which I will a lot because I learned a lot from reading it, I'm going to emphasize the R equals D equals risk-free rate scenario until stochastic analysis is introduced. But I also just want to say that I think there's a lot of potential to learn something even just from the R equals D equals risk-free rate scenario, namely how much the new tiers have reduced necessary contribution increases. So I benefited a lot from reading this paper, and I think you should all read it as well.
Okay, thanks very much. So we're open for questions. You can raise your hand. You can chat, put something into the Q&A. You can put something into chat. There was a chat question that was raised, and I think I'm going to start with that. So Henry Aaron, hopefully you can unmute. And why don't you raise the question that you for the general discussion and audience.
The question is to Debbie Lucas. Her comments suggest that with volatility, there's a much greater chance of where assets are exhausted, and I think that's the condition of that makes the funds unsustainable. The question I had was whether taking that risk into account, there are interventions, if you will, quasi-insurance steps that funds could then apply to prevent that from occurring. And the question is, how serious or difficult would such insurance measures be? If steps can be taken in the event of unpleasant shocks to trust fund balances that are not excessively onerous, isn't the relative optimism of the paper's authors then restored?
So I guess there's several ways to talk about that, but what's salient to me is actually our analysis of a collective defined contribution plan. So the goal there was to ask the question, could you guarantee people a reasonable benefit using investments in a mix of risky and safe assets and have the contribution rates that you do today? And we found that the answer is unambiguously no. And what that means is that effectively what that means is that if you invest enough in risky assets to create the kind of benefit levels that you want, with the contribution levels that we have, it just doesn't all add up because you're relying on that equity premium. And so there's this risk that you're going to run out. And so that's like an inescapable cost that you can't just sweep under the rug. So if you did buy insurance, you'd basically be having to pay that premium. Or another way to say that is if you didn't, the cost of the insurance is the difference between the risk-free liabilities and the risky assets. And that's why it makes sense to discount at different rates for the different things. But in any case, so that's one take. Just one more twist on that is to say more optimistically that actually the broader governments, not the pension fund. So I think the pension funds in themselves can't do it without investing considerably more, either in insurance premiums or in safer investment strategies. The state and local governments themselves could actually write insurance policies that would make sure that they didn't go into crisis. And I think they actually mostly do have the fiscal capacity to do that, but I think it's a question whether they have the political will to do that. So I'll leave it at that.
I'll add a question to the mix if there's time here. So both Debbie and Josh were recommending adding uncertainty to the analysis. And I wondered, maybe based on the analysis Debbie has done already, does that change your view of the heterogeneity? So you all sort of talked about how it would change a representative plan. Do those changes vary a lot by plan, or is it just sort of in general applying, standard errors around the estimates that we have already, or similar standard errors? And I can see where it would vary because different plans have different investment profiles. So some of them have riskier portfolios than others. So that would be one source of variation. Are there other significant sources of variation that would add to the heterogeneity that the authors identify already?
So Josh, I was going to let you take a stab at it because I spoke already, but
Okay. That was for me. All right. I'm sorry. I thought that was for the authors. Okay. Well, I guess what I would emphasize would be that I think the way to do this requires actually doing a stochastic simulation, basically a Monte Carlo simulation. And again, I think the reason for that, I think adding standard error bounds doesn't quite do it because of the asymmetry that you get when you model asset returns the way we typically do in finance. So to take the sort of Black-Scholes-Merton just log normal model that I showed, the median outcome is much below the expected return. So if you target an expected return of 2.5% real, that means that you're more than 50% likely to fall short of that. And I think until one does that kind of stochastic modeling, it's going to be hard to reflect that just by adding some error bounds.
Yeah, I guess my question was not so much, I probably shouldn't have mentioned standard error bounds because that threw the discussion in the wrong direction. My question was more about heterogeneity and whether adding the risk, would give us very different results for different plans over and above the fact that they have different investment profiles. And I think your comment about asymmetry tells me that the answer might be that it is quite different. But Louise, if you wanted to add.
So I just want to sort of, first of all, thank you all for the comments. They're really fantastic. And I learned a lot just watching these slides and stuff. I think this whole question about sort of two things relate. We are definitely taking a public finance approach, not just about sustainability, but honestly thinking about this as basically government debt, right? So state and local governments have lots of future obligations. These are just obligations that they have. And so this idea that we could smooth through is really taking a very broad, just like some of us don't worry about the Social Security Trust Fund, we look at the unified budget. We're sort of looking at that, but we recognize that we really need a broader look at state and local government debt in general to do it this way. So we sort of said that. In terms of stochastic analysis, we do think it'd be very important and very interesting, but we also would not just want to do it on the returns, right? So the whole question is, what kind of world are we in when returns are higher than you think in terms of GDP? Because that's sort of what's going on. It's wages, demographics, GDP, all the things that affect returns also have direct effects on the pension. So it's a very complicated thing to do. We think it would be very useful. I also want to make a comment when we think about sustainability analysis. You know, we are used to doing it for the federal government all the time. We are doing projected cash flows. A lot of those revenues are coming from capital income. We sort of just take expected values based on past experience. There is a lot of uncertainty there as well, but people seem to be kind of comfortable with that kind of sustainability analysis for the federal government. And when you're thinking about a state like California, you might think that's got a lot of similarity, that, you know, it does have the ability to respond, as Henry asked, if something goes poorly. Let's see. The R minus G thing, are there no more questions? Can I just take the rest of the
Actually,
time?
let me just jump in. So we have at least one question from the audience. So let me get that and then give you a few seconds at the end. So Caroline, Caroline?
Hi. Yeah, I hope you can all hear me. This is a question for the authors, and I guess for the discussants as well, but mainly for the authors. So there are a few papers recently that have demonstrated that many public sector employees would be willing to accept less than the present value of their pensions, their future pensions, if they were to get more of it in, current income. And there are political economy reasons why they tend to be paid in benefits and pensions and not be paid in salary and, present day income. Have you considered that at all? Because that's another method of stabilizing. I mean, some of the papers indicate that people would be willing to accept 50% of the value of their future pensions if they were to be given more of it in current income.
So obviously that's not what.
Wait, hold on one second. I'm going to give you one more question and then we're going to just turn it over. So David Wessel also asks, if the unfunded liability approach does not fully incorporate changes in pension benefits for new hires, does it provide a misleading metric for policymakers? So, okay, Louise, you've got like a minute. And then we wrap.
So we obviously haven't considered those papers, but I know them about people not being willing. So there's a big question on whether or not, when you ask people individually that are not willing, or whether or not this idea that, state, local government jobs are good jobs and people don't really understand why they're good jobs. And, so there's a question of whether or not they should be providing these things. Anyhow, I agree with you. And that would be a way, just to lower their compensation. One of the things that I think we have thought about is how is it we can say that plans can just lower compensation in the future? How can you, don't we have a competitive labor market equilibrium? Doesn't that imply they're going to have to raise wages? And aren't we missing that part of the, you can't really do anything about the total compensation level? And I think maybe partially because of your reason, Carolyn, and also this idea that really interest rates have come down a lot. These defined benefit plans are worth a lot more. And because of constitutional constraints, they can't cut them ex post. So the people who got them, made a good bet, and they did well on their defined benefit, but that you can do it going forward. But I think that's a really good question, and thinking about sort of the paternalism or not. Remember that some of these people, about 25% of state and local employees, don't have Social Security. So you might find that same kind of thing, that people be willing to get rid of Social Security benefits if you asked them, if I just gave you more money now. And so there's some question about sort of whether or not that's the right approach. On David's thing, I think that's right. I think one of the things that we do think is a value of this paper is recognizing that, just like in the Greenspan Commission, when they raised the retirement age 20 years in the future, you've seen that same kind of thing in the public pension space. And if you think about that and you're thinking about it from a long run public perspective, you want to smooth through that. That means you want to sort of let your assets dwindle a little bit now, because there's relief coming. Unlike the baby boom, which the benefits go up and they stay up, here they are really temporary and they do come down.
Well, we could say the same thing about debt to GDP. So I guess I just would say that I don't think the unfunded liability ratio is any more or less misleading than just a debt to GDP
Totally,
ratio.
absolutely. It's
So
a current stock. It's
yeah.
not the flows, which is another reason why, when CBO, Debbie showed us that nice chart, we like to do that for the federal government, is not just look at the current, but look at the trajectory. That's what we wanted to do for this, we'd like to do it for the state and local sector as a whole. We started with the pensions.
Okay, thanks very much. We will reconvene, take a short break, and then reconvene at 11:05 Eastern.
That's like right now.
Can I test my microphone? Can anyone hear me?
Yeah, you're good.
Thank you.
I heard you.
I have a separate mute button, so I'm just going to use that one.
Should I start sharing or wait for some kind of introduction?
Jim's going to give a quick intro and then he'll prompt you.
Okay. Oh, I see. I can't start sharing until somebody stops. So I was going to test it, but that doesn't work.
Okay, so we've got 15 minutes per speaker. And it's hard for me to, on Zoom, it's hard without sort of interrupting you and being a jerk. So everybody has to behave themselves and stick to their time. Nice to see everybody here. I'm really, really looking forward to this conversation.
We got a good to start second panel.
Oh, okay. Welcome again to welcome back to our conference, and we are shifting to a panel on COVID-19 and economic policy 1 year after. We have three speakers today: and Andy Atkinson, Christy Romer, and Abby Wozniak. And we'll just turn it over to them. Speakers reminding you that you have 15 minutes. And audience, please raise your hand, or that's the best thing to do, or alternatively Q&A or chat. Okay, Andy.
Thank you. Here. And I'll go to full screen. All right, well, thank you for having me talk today. what I'd like to talk about is kind of what we've learned over the last year about behavior, endogenous, private, and public responses to disease. I want to talk about both how that shapes the dynamics of the epidemic, say relative to what forecasts we made a year ago. But more importantly, I want to talk about how behavior, the endogenous response, and I'll say both public and private, because we're seeing, state and local governments responding what appears with endogenously to the disease, how that constrains our options for mitigating the health impacts of pandemics unless we can come up with a technological solution like a vaccine or a cure. And I want to organize my talk around just showing you 6 simulations from a model that I think fits the data on deaths for the US fairly well over the past year. And a key feature of the model is that it incorporates a prevalence elastic demand for costly measures for disease control. So what, that's a phrase that Thomas Phillipson used to describe what he saw as the endogenous behavioral response to the HIV/AIDS epidemic. But the basic idea is, what we see is that both individual and public mitigation efforts rise and fall as current levels of infections and deaths rise and fall. And that aspect of the behavioral response means that behavior has a very different impact on how the pandemic evolves in the short term versus the long term. And it also means that it puts constraints on what we can achieve with additional public health interventions like testing and tracing or federal programs, unless we make those programs permanent or we come up with a vaccine or a cure. And so I want to talk about those 2 aspects of behavior and the dynamics of epidemics, and then finish with a simulation as to why getting better at non-pharmaceutical interventions should be a high priority even now when it looks like we have a lot of good news about the epidemic, because there's a scenario that's not so good if immunity is not permanent or long-lasting. So the first simulation I want to show you from the model is basically, if I take the model and turn off the responsive behavior to the epidemic and just run the disease through the population in the way that a standard epidemiological model would do, and the parameters of this model are chosen so that it's pretty much in line with the types of forecasts you saw out of the university, I should say Imperial College London, or what Angela Merkel said, back in March of 2020, that a large majority of Germans were going to experience the disease. So the model forecast, or actually the model simulation, is in blue, and data on the 7-day moving average of daily deaths in the United States from the CDC are in red. And so I want you to see 2 things in here. First is the model predicts just a catastrophic first peak. This peak here has daily deaths over 30,000 a day. And then the epidemic through herd immunity just ends quite quickly. It should have been over basically by now. But by the time that happens, you have 1.5 million cumulative deaths in the long run. And, you might argue, where did all these dire predictions come from? They're basically an implication of the basic reproduction number. Once you measure that to be, say, around 3, then this is pretty much what's going to come out of your epidemiological model for those 2 features of the model prediction. Now, fortunately, nothing like this happened in terms of the first peak of deaths. We're off by an order of magnitude, and that's true not just in the US, but pretty much everywhere in the world. So if we alter the model, I had a recent, Jim's worked on this and others have worked on this, but if I alter the model to just include a reduced form behavioral response where people reduce their activity, people in governments reduce activity in response to the level of daily deaths, then I can get the model to come very close to the data. The model now is in blue over the course of the last year. This discrepancy is, I'm going to argue, is the success of vaccines. And this is the new variant coming into the US. If we didn't have vaccines, we'd be having another peak right now. But what I want to, what I want you to see in this picture is that just simply adding this behavioral response to the model, you get the model to, cut off that first peak of daily deaths. And so it's not 30,000, but it's in the neighborhood of 3,000. It looks like what we actually experienced. But when you look at the cumulative outcome, it's still pretty bad. If we didn't come up with vaccines, this model would say we'd have 1.25 million cumulative deaths. Now, that's 250,000 or 230,000 less than what the previous simulation showed. And that's due to what's called, behavior limiting over what they call overshooting of herd immunity. But we're going to see then that this long run outcome is then pretty much a limit to what we can achieve with further mitigation absent vaccines or a cure. And basically, why is it that the short run impact of behavior is so powerful in reducing the first peak, but then doesn't have much impact on the long, as nearly as large an impact on the long run outcome? And that's basically because if behavior is responding to the level of the disease, what it does to the equilibrium outcome is at first when, we were in that initial phase and deaths are growing at say 30% a day early on in New York, behavior starts adjusting very rapidly and it kind of slams the brakes on the epidemic very quickly. But then once you reach a certain level, it acts kind of like a cruise control on a car. As prevalence rises, you slow down. As prevalence, as deaths fall, you speed back up again. And so you keep the growth rate of deaths pretty close to zero, or that keeps the level of deaths kind of wandering around. And you go, how long does this go on? Well, it can't stop unless there's a force, other than behavior to bring the epidemic to an end. Why is that? Well, behavior is going to go back to pre-pandemic norms if the disease starts to fall too low. And of course, if behavior goes back to pre-pandemic norms, then if there's any disease around, it just comes right back into, or the population would have to have achieved herd immunity either through infections or vaccines. So it means that you just drag the epidemic out for a long time until it ends at the standard notion of herd immunity that we've been talking about, for over a year. Okay, so now let's think about how does that constrain what we could have achieved, say, with, some federally organized policy for testing and tracing, or other, federally organized policies aimed at mitigation that would be looking to, do more to limit transmission and the speed with which this epidemic has progressed. So I now simulate the model with a scenario where on top of the endogenous response of private and public behavior, state and local government behavior, we have some federal program that succeeds in reducing transmission by 35%, holding behavior fixed. And we assume that this federal program is maintained for 2 years. I just simulated it from May 2020 to May 2022. And you can see that you save a lot of lives in the first year. And this is a new variant coming in, but you end up pushing the deaths back into later years, and you run out the long run cumulative total of deaths, and we end up with the same 1.27 million that we had absent this imagined federal intervention. So I take that as being very discouraging news about, what we can achieve if you just have non-pharmaceutical interventions alone, and you're not willing to implement them essentially on a permanent basis. Okay, so then if one is going to have this discouraging perspective on what can be achieved with further MPIs, one might ask, well, then what's the point? Why did we do all these lockdowns? Why are we doing this? And what I want to say is, and I think what we should emphasize more clearly when we talk about these things, it's the combination of the non-pharmaceutical interventions to delay deaths together with success in developing vaccines, or if it were a different pandemic, a cure. That's how you save lives. And that's really the point of doing these types of interventions. So in this simulation of the model, this third one, I just introduce a vaccination program on January 1st, where we vaccinate people in the population at a daily rate that's sufficient to cover half the population by June 30th, and you keep the vaccination program going. And we see here, the first year looks the same, and the vaccination program, pretty much brings the epidemic to an end by late this year. This blip here is, in the model, we have this UK variant. That's the UK variant speeding up, and then vaccines in this nice scenario, succeed. And we see that the long run implication for deaths is 672,000 here. So that is basically cutting the vaccines has succeeded in cutting the long-term death toll in half. And you go, that's great. But I want to argue we could have done better. If you had combined that, hypothetical or counterfactual federal program of extra mitigation starting in May 2020, carrying it through 2 years with success in vaccines, then you get this second wave coming from the UK variant. But now the cumulative deaths are down to 292,000. So you can, by combining the two policies of intensive mitigation early on, and then of course rapid vaccine development, you can really bring the death toll down. And that, as I say, going forward, I think this is something that we should emphasize, and we should learn on how to communicate that effectively, when we come to the next pandemic. I think also, it's imperative in terms of policy that we look at, there's a bunch of countries that have been quite successful in following essentially this policy. This is a list of countries that are, had very low death tolls to date from COVID, and they have the prospect of being able to implement vaccination programs that'll mean they'll come out of this epidemic with much lower death tolls than have been seen many other places. And some people might argue that, oh, we can't copy these countries for this reason or that reason. Down at the bottom, this is a list. This is a couple of universities in the U.S. that have had tremendous success in controlling COVID on campus with very intensive testing, tracing, and isolation programs. So, we have real world examples that we should be studying for how we could do this non-pharmaceutical mitigation or interventions while waiting for vaccines next time we have a pandemic like this one. Now, I want to finish with one more simulation, which I regard as kind of the scary scenario of, why we should be paying attention to learning what we can about these interventions now and, not waiting. And that is, we're not entirely sure that immunity gained through infection or even these vaccines is going to be long lasting. The virus is mutating, and then just the human immune system might lose immunity anyway. So I did one final simulation of the model where I have the behavior and I have there's seasonality and transmission in all of these simulations, but I have that immunity only lasts on average for 18 months. I maintain the vaccination program at the current rate, you do about half the population every 6 months. I've run that for 5 years. So imagine that we're continuously vaccinating the population, but we're losing, because on average, after 18 months, people go back to being susceptible to the disease. And under that scenario, then COVID becomes a seasonal disease that kills about 100,000 Americans a year, just year after year. And it's this scenario that I want to say that should motivate us to think about, we should be equipping ourselves with better testing, tracing, mitigation programs that have lower economic cost, and we should be focused on that, basically as soon as possible. So with that, I'll end, and I'll turn it over to Abigail and Christy to talk about the economic side of the situation.
Okay, thanks. And of course, that could just also be because of evolving variants.
Yes.
Too. Okay, so Christy, you're up. Macro.
Just a sec. Excellent. Well, thank you. It's a pleasure to be on this panel. As Jim suggested, I'm going to be talking about the macro fiscal policy side of the pandemic after 1 year. The starting point is obviously that the United States and other countries have taken just extraordinary fiscal actions to respond to the pandemic. So including the most recent 1.9 trillion American Rescue Plan, the US has allocated more than $5 trillion to respond to the pandemic. And so as we enter the second year, it seems like a good time to assess those extraordinary actions. And I really have three questions that I want to look at. One, just what do we know about the variation in the fiscal expansion across countries during the pandemic? Second, sort of focusing in on the US, were the fiscal actions taken appropriate for the unique conditions of a pandemic recession? And then finally, are the fiscal actions likely to have long-run consequences? All right, so let me start with the variation in the size of the fiscal response across countries. So David Romer and I have tried to put together some consistent data on the size of deliberate fiscal packages early in the pandemic in OECD countries. So we only go through July of 2020 in part to try to minimize the feedback effects from local conditions. But we also are trying very hard to only include things that affect the net budget deficit. So not tax deferrals or loans or liquidity measures. All right, so this is what comes out of our analysis for the size of the size distribution of the early pandemic packages. And these are as a share of GDP. And you can see even within a sample of advanced countries, the OECD countries, you see a lot of variation. So some countries did very little. We see Mexico, Hungary, Belgium there on the low side. And some countries did a lot.
Christy, if I could interrupt, I believe you think you're sharing your slides perhaps, but you're not.
Oh my goodness. Yes, I'm so sorry. Thank you. Let me just see what, I'm not sure.
We can all try to visualize that plot.
Nope. Let's try this again. How are we doing now?
Yep, good.
Excellent.
Great.
I'm so sorry. So here's what you were trying to visualize in your mind. And so as I was saying, you see the United States over there tied with New Zealand for the largest. Something that really strikes me from this as someone who was there back in the Great Recession trying to get fiscal packages is just how much bigger the response has been to the pandemic. So in this sample of countries, the average pandemic fiscal package was about 5% of GDP. For the same sample, the early Great Recession package was about 1.5% of GDP. Now, in previous work on the fiscal response to financial crises, David and I looked at the role that fiscal space played. And we found that countries that began a crisis with a lower debt to GDP ratio undertook much more expansionary fiscal policy. So I've tried to look at and see if that pattern continued in the pandemic. So this picture just shows a scatter plot of early fiscal packages on the vertical and the debt to GDP ratio at the end of 2019, so before the pandemic began. And I think it's fair to say it's pretty hard to see much of a relationship at all. I have highlighted sort of the big countries of the Eurozone in red here. And you do see for that small sample, the kind of expected negative relationship. Germany with a low debt to GDP ratio did a lot. Italy and Greece with a high debt to GDP ratio didn't do much. But you see there are just tons of exceptions to that pattern when you think about the broader sample. And regressions confirm what your eyes tell you, that there isn't really much of a relationship here at all. And indeed, this lack of a relationship is remarkably robust to every kind of permutation you might think in the regression framework. So for whatever reason, fiscal space seems to have mattered relatively little in the fiscal response to the pandemic. Okay, so that's the variation across countries. Let me turn now to assessing the US fiscal response to the pandemic. And I think a really important first step in this assessment is to point out what I see as sort of crucial differences between a pandemic recession and an ordinary recession. So one difference involves the goals of policy. So I think the evidence has shown that a fall in demand is a key forcing variable in both types of recession. But importantly, in an ordinary recession, the goal of policymakers is just to get demand back up as quickly as possible. But in a pandemic recession, one has to factor in the crucial reality that the virus thrives on human interaction and hence on economic activity. And as a result, policy should only stimulate as much output and employment as can be done safely. A corollary to this is that the public health situation is really everything, right? The state of the virus both determines what can be produced safely and ultimately, I think, how much people actually want to spend. Right? A second difference is that the effects of a recession are particularly unequal in a pandemic. So we know that the effects of recessions are always unequal. Some workers in some sectors are more affected than others. But the effects of a pandemic recession, I think, are uniquely unequal. So some workers can easily move to remote work and may even benefit from increased flexibility, the end of long commutes. But other workers may be locked out of their jobs for long periods by shutdown orders. And essential frontline workers may be forced to take additional risks to their health and safety. And then a third important difference is that aggregate demand stimulus in a pandemic recession doesn't flow to the most affected. So in an ordinary recession, it isn't essential to focus aid closely on the most affected because stimulus in one area will flow to other sectors as workers earn more and spend throughout the economy. But a pandemic short circuits this process. So no amount of broad stimulus will put waiters and hairdressers back to work if their sectors are shut down or people are afraid to go out. Right, so these unique features of a pandemic recession, I think, have two important implications. So one is that pandemic fiscal policy needs to be directed much more towards social insurance or direct relief, if you want, than toward a general stimulus. Right? The goal is to provide people with the income they would have received if they had fought to insure themselves against pandemic unemployment. Now, of course, to the degree that there's a general shortfall in demand, some general stimulus is likely to be appropriate, but it's targeted aid that's really essential. And second, just keep coming back to the idea that dealing with the root cause of the recession, in this case, the virus, is just simply essential to recovery. All right, so with these general principles in mind, let me turn to the particular fiscal measures that the US took in response to the pandemic. So this table just shows you the rough breakdown of how we allocated that $5.2 trillion. And you can see there's lots of acts. So I think so let's kind of, I like to put them into some categories. So in terms of sort of how appropriate they were to the unique conditions of the pandemic. So in my valuable and effective category, I think the most obvious one is the public health spending. We did about $600 billion of that. It was, as Andy's paper points out, it was essential to contain the terrible toll of the virus in terms of illness and death, but it was also essential for the economy. Dealing with the root cause of the recession was and still is crucial. And I'd say, indeed, given the continuing infections and the economic consequences, it's pretty clear we should have spent more on things like testing and vaccine distribution and genetic sequencing. I'd put the enhanced unemployment benefits again in that highly appropriate and effective category. This is exactly the type of targeted relief that's called for by a pandemic recession. It gets the aid to those most directly affected, and so helps to deal with that extreme inequality that results from a pandemic recession. And to the degree that we need general stimulus, it provides it. The benefits are largely spent, and actually spent on things that are relatively safe to produce, like rent and food and things like that. I'd also put the state and local fiscal relief into this highly valuable category. You know, the pandemic recession has not been nearly as catastrophic for state revenues as was previously feared, but certainly state and local spending has had to increase substantially to deal with the pandemic. And the federal grants to state governments, I think, has helped to continue needed services and deal with the public health issues. And so are another type of aid that's very much targeted to those most affected. All right, so what goes on the other side of the ledger, the not well suited to the unique challenges of a pandemic recession? I'd actually put the two of the highest profile parts of the various packages. The first, it's the one time, or I guess I should say the 3-time now stimulus payments to households. So these were certainly very popular, and no doubt they helped some families weather the pandemic, but they were obviously very poorly targeted. They went to everyone under a relatively high income threshold. They also suffer from the problem that general stimulus just isn't very useful in reaching the people who are suffering the most, say because their industries are shut down. And there's also some evidence that the payments were largely saved, and so provided relatively little immediate stimulus. The other program that I put in my less good category is the Paycheck Protection Program. So this, as we all know, provided what turned out to essentially be grants to small businesses if they maintained their payrolls. And there is some evidence that employment fell less in firms that were eligible for this program than in firms that were not. But the effects were so small that the implied cost per job was just saved was just ridiculously high. I think as much as $350,000 per job. Or to put that into context, estimates of the cost per job saved of the state fiscal relief back in the 2009 Recovery Act was about $30,000 per job. So I'd say that the PPP was a lot of money for what appears to be not much gain. So the bottom line of the analysis of the various pieces is that there was much that was great in the $5 trillion that the US spent on pandemic fiscal packages, but also a fair amount of misguided or wasteful actions. The last thing I want to talk about just briefly are some of the longer run consequences of these extraordinary actions, fiscal actions. So the first is related to some of the current discussion of whether the US economy is about to go into a rip-roaring boom because of the American Rescue Plan. The first thing to say, and I want to keep emphasizing this, is it all depends on the virus. If the virus continues to moderate, I think the economy will be poised for rapid growth. If the virus surges again, the economy will slow down or stall. And to the degree that the most recent fiscal measures have helped to speed up vaccinations and other public health measures, it could be very helpful to the recovery. Second, in terms of the coming aggregate demand increases, I suspect that the fiscal stimulus of the American Rescue Plan is actually just the tip of the iceberg. So I think we're all aware that personal saving has been very high throughout the pandemic, in part because people have just been unable to get out and spend. Between that and the boom in the stock market, households and nonprofits are sitting on about $10 trillion more of financial assets than they were before the pandemic began. So that's a lot of accumulated saving that could come pouring out when people feel it's safe to start spending again. And actually my former student, Jillian Brunette, has suggested that maybe the closest parallel to the current situation may actually be World War II, where forced saving during the war unleashed a spending boom afterward. But before we start panicking over excessive growth and inflation, I think it's useful to remember just that the labor market is still quite depressed. I find this picture a very important reality check. So payroll employment, which obviously fell just catastrophically last spring, has come back a lot. But importantly, we're still down about 10 million jobs from where we were before the pandemic began. And to put that into context, that's the size of the entire drop in payroll employment during the Great Recession. So we need a period of very rapid growth to heal the labor market. And even if we're lucky enough to get that growth, I think we're unlikely to push up against capacity constraints for quite a while. So I put myself in the camp of people that are not particularly worried about inflation. What I am somewhat less sanguine about is a second longer run consequence, which involves the decrease in our fiscal room to maneuver, right? And this picture just shows you what's happened to the US debt to GDP ratio, including the most recent package. And what you can see is that the debt ratio has jumped from about 79% of GDP at the end of 2019 to to a projection of about 110% of GDP in 2023, which is going to be very close to the World War II record. Now, I described earlier that fiscal space seems to be much less important as a driving force for the size of the fiscal response to the pandemic than was true in the financial crisis. But we just don't know what's going to be true going forward. And I worry that that previous relationship could reemerge as the terror of the pandemic fades. And if it does, I think that the administration is likely to face growing resistance to additional spending precisely because of the run-up of government debt. And to me, this possibility kind of puts the misguided or the wasteful pieces of the US fiscal response to the pandemic in a somewhat harsher light. If spending $1 trillion on those one-time stimulus payments end up preventing spending $1 trillion on mitigating climate change, I'm afraid we will have made perhaps a very bad bargain. All right, well, thank you. Let me stop there.
Okay, thanks. That was great. Abby Wozniak on social insurance programs.
Absolutely. Thank you, Jim and Jan, for inviting us to be part of this really interesting panel. And I want to highlight that I think at this point, we're going to be able to drill down a little bit beyond the programs that Christy really helpfully outlined and talk a bit more in specifics about programmatically how did the efforts to support workers and families during the pandemic recession function and fare. And we're also going to make some suggestions for what we think policymakers should be considering in 2021. I want to highlight this is a joint work with Krista Rufini, who's also a visiting scholar at the Opportunity and Inclusive Growth Institute. And as such, the Fed disclaimer at the bottom of that first slide really applies to both of us. So like Christy, we actually group the programs that we are considering into two buckets. We are taking kind of a broad view of programs that reached workers, households, or families. Of course, all of the efforts in 2020 really fall on some continuum in terms of their connection to those parties, but we think these are the most important in terms of directly reaching workers, households, and families. And we group them into first a bucket that really had as its intention to stabilize the employment relationships that existed at the eve of the pandemic. And so we think of the unemployment insurance expansions and the new pandemic unemployment assistance or PUA program that was built up as being a piece of that, since unemployment insurance is often intended in part to keep folks in the labor force. And we also think of the Paycheck Protection Program as falling under this bucket as well, because it had such a primary goal of preserving the employment relationships that existed as the pandemic descended. The second bucket of programs that we consider were designed to more directly support household balance sheets. And I think to some extent, this reflects our view that in addition to providing some stimulus, the goal of some of these programs was income replacement, but in a way that was doing so somewhat independent of the relationship to the labor market that might have existed prior to the pandemic. So for example, we put the economic impact payments in this bucket. We also put expansions to SNAP or the food security programs into this heading as well. And one program that we highlight as an important part of the response in 2020 that we think hasn't gotten as much discussion is the eviction moratoria. Or moratorium, if you want to consider the federal program that started in the latter part of 2020. This really doesn't get as much conversation because at least until recently, it was not part of the big spending packages, but it could be a really important piece of stabilizing that bottom line for affected families. And so we think it's important to include it. So there's a lot of detail on how these programs functioned in the paper, and I'm not going to be able to go into detail on that today. Instead, I'm going to focus on really what we see as the main success that runs through in a common way through all of these programs, and then talk about the shortcomings that we saw, as well as hopefully getting to what we think the important considerations in the near-term horizon really are for modifying and expanding these programs and considering new ones. So the main success that we see is really that all of these programs, in our sense, were very successful at reaching the beneficiaries that they intended to reach, either through existing payment infrastructures or by expanding the existing payment infrastructures that we have. So we can think of this as kind of in a programmatic or a kind of plumbing analogy type way. The pipes worked, they got a tremendous amount of money out, and they went all the way to the end to kind of whoever would be touched by this program. By and large, we think most of these programs were very successful in reaching the folks that they were aiming to reach. I'm going to come back to the second point of did they reach everybody that was needed assistance when we come back to the shortcomings. We have many examples of how each program this applies to in the paper. I want to highlight one of them, which is the UI expansions. So what we're showing here is something that DOL officially calls the recipiency rate. It might more adequately be called a ratio. It's a ratio of continuing claims, usually on the regular UI programs, to an estimate of the unemployed population from CPS data. And so there are a lot of reasons why this may or may not kind of completely reflect receipt of UI benefits among folks who in the CPS say they're unemployed. But you can see from the graph that whatever this reflects, which we think is an adequate measure of UI receipt in some gross way, this changed dramatically in 2020. Going back quite far, recipiency rates tend to be below 50%. They actually ticked down after the Great Recession and did not really recover. But now in 2020, we reached recipiency ratios that sometimes exceeded 100%. You can also see in the adjusted line that we've graphed with the dashes that when you factor in presence on the extended benefits portion of UI, that rate remains very, very high. The reason it's coming down in the kind of more official number is that as folks move on to extended benefits, they move out of that numerator. But overall, the ratio of folks currently receiving some benefits to the population estimated to be unemployed in the CPS is extremely high. This is just an example of what we meant by the dollars went through the pipes and they reached the folks who are connected with these programs. Now, a shortcoming is that many of these programs missed the most marginalized. And we think it's important to make this distinction here. This is different from failing to reach intended beneficiaries. It's rather the case that there are a number of populations who, and I think this just reflects a failure of, many of our own imaginations to understand that there are many folks who are not simply going to be reached by these programs at all. And so as a result of using mechanisms where these folks were not connected prior to the pandemic in any way, the programs that we use to push out aid, even though it was a large volume of aid, we're going to miss these individuals. And again, we have a lot of examples of how this was a thread that kind of wove through many of the programs. One way to see that is to look at statistics that we've been monitoring from the Census Household Pulse Survey. I view these statistics as really indicating the consequences of missing these marginalized folks rather than as a true footprint of that. But what we see in each of these graphs is that, to generalize, food and housing insecurity have really been persistent throughout the recovery. And if anything, they seem to be worsening as the recovery goes on. I'm not going to detail the survey redesign in the Household Pulse Survey that happened in food insecurity, but what you can see is that over the course of the pandemic, these rates are fairly elevated. These are the share of individuals saying they can't afford to buy all of the food that they want or need. And what you see more importantly is that this has been trending up over the course of the pandemic. There's a lot of discussion about what, in terms of pre-pandemic data, to compare this to. Overall, regardless of how you do that, these levels are elevated. But for us, the big story is that in spite of huge volumes of aid going out, this situation is just worsening for some fraction of American households. And we think we take these data seriously as reflecting that. The housing security is in a little bit of a similar picture. We view the SHED data point that we have on the left there as a more expansive definition of housing insecurity. So if you look in the census data, that's the pandemic era data, you see that this is a more strict definition that has levels about as high as the more generous SHED definition. And again, these are trending up a bit towards particularly the last several months of 2020. This again gives us some concern that housing insecurity is worse for a fraction of the population than it was prior to the pandemic. And in spite of all the aid that's going out, it's not reaching the folks who are most affected by this, and it is trending up over the course of the recovery. Another way to see that the programs didn't reach folks that they weren't designed to reach is to look at the share of folks who had income loss. That's the blue bars in this graph. And this is the most recent data from the Census Household Pulse Survey. So as of February, the share of folks who had some income loss in the pandemic as compared to those who report having received some UI benefits in the course of the pandemic. Now, of course, I think there's probably reason to be concerned that that yellow line and the blue bars is not necessarily completely reflective of who exactly got UI benefits. This can be hard to harmonize in self-reported data. But I think a picture is clear here that there was significant income loss that happened in the pandemic that was not connected to the UI program. And this goes back to what were the EIPs doing? To some extent, they were making up some of this income loss. But nevertheless, that kind of insurance component that we were thinking about functioning and that Christy mentioned as part of the UI response was really not present for a significant share of folks losing income. And that's in part because the short-time compensation programs that were available were just so limited and used very modestly in this pandemic. So a second shortcoming is that targeting capabilities that were there went unused. So early in the response, limited targeting was indeed, I think, discussed as a real feature of the response, rather than spending the time and creating the barriers, frankly, to target aid to where it was very most needed, say in April. We pushed out lots of aid in a very broad way to kind of get the aid out speedily. But as the recovery progressed, we really only modestly incorporated other targeting capabilities that really were already there in much of the policy landscape. Just one example of this is that early on, the sectoral nature of the employment loss was very clear, but later aid could have targeted by industry of 2019 employment. We believe that's possible with the data sources that are out there. This just was not done. There's a small example of this in PPP with somewhat more generous benefits for restaurant and hospitality sector firms. But by and large, that capability to target by sector, even though it still would have been imperfect, was not used. We also believe that there are data sources on the marginalized populations that were most affected that could have been used to reach them as well. For example, the Medicaid rolls, and we discussed that in the paper. So I want to just conclude quickly and try to give us some time back for questions. The next thing we go to in the paper is to think about what the conversations should be right now about two things. One, how to phase out this historic level of support. So far, we don't think that's been a very large part of the conversation. Nevertheless, some of the recommendations that we make are reflected in the ARP. So we think that it makes sense to avoid massive cliffs and simultaneous benefit expirations, given that we've moved so much aid and support into the economy. An orderly revision or withdrawal seems to be in order, as opposed to kind of a uniform contraction of that. We have an order of retreat that we think makes sense, moving from programs that have, I think, the most direct hand in the economy and the potential for creating the most distortions, starting with the PPP, all the way back to things that we think are plausibly less distortionary, like the EIP and the SNAP payments. What we do want to highlight is that the eviction moratorium, again, is a real wild card here. Because of really limited pre-pandemic data, we just have so little information about who might even be benefiting from this right now. There's no data on who is actually being reached by this. We can make some inferences, I think, from some of the census data that we have, but it's just a really unknown piece of the landscape, and it could be a large part of the rental market. Regardless of the size, it's certainly very concentrated in some places more than others. And so thinking about how to roll that back and reach folks who might be using it right now, I think is a really important piece of the puzzle to consider in the next few months. So finally, what remains to be addressed in 2021? We identify in these first 3 bullet points things that we think are creating long-term impacts of the pandemic and that need continued attention to roll back their negative effects or mitigate their negative effects in ways that maybe haven't been received as much attention in terms of ongoing policy supports. So mental health effects, both addressing the persistent mental health needs that have happened in the pandemic, potentially through schools, in a way to help families limit the spillover of mental health impacts to their children that we know from all sorts of research are present. Also thinking about those who might have experienced acute mental health impacts and potentially addressing those through a setting like the VA that has some experience in addressing that type of trauma. Learning loss, some ARP funds have been provided to address this already, but we think that given that fewer than half of American schools are currently operating at full capacity, it's unlikely that they're going to be able to stand up significant learning loss programs in the summer. So we need to be thinking about stemming learning loss as a kind of medium run project, at least into 2022 or 2023. And then thinking about how we are going to address potentially persistent health impacts for some folks of the COVID disease. In particular, how are we going to support and expand DI programs that might cover folks who are not able to return to full health after experiencing the disease. And then finally, a kind of longer term, medium term consideration is exactly what Andy is talking about. We need to be having programs that are going to support ongoing virus containment, think about ways to mitigate the effects of future outbreaks more quickly. And in our case, one thing we'll highlight is that bottom point, which is to shore up supports for those who need to test and isolate, particularly to understand whether employers are taking advantage and using the paid leave support that was designed to enable them to let workers stay home to evaluate symptoms that they might be experiencing. In an ongoing way, this will be important, always having folks be able to stay home, isolate, and test in any outbreak. And so I think evaluating how well that worked here and thinking where that needs to be shored up is important as well. Thanks so much, and I hope we have time for some questions.
Okay, that was just great. So we've got a few questions teed up already. So we're just going to start going to the floor. So the first is Bob Hall.
Traditionally the first, hey? Okay, so with respect to Andy's remarks, I think there's one more scenario that ought to be included, which is pretty profound, and that is the completely unnecessary delays in the propagation of vaccines. You know, there's two phases to testing a vaccine. There's the safety phase, and the safety phase is pretty straightforward and doesn't require a large sample. And of course, it can be done on an ongoing basis as well by monitoring people who've received a drug and taking full account, which of course the FDA does aggressively. Then, on the other hand, the efficacy phase, which is central to the FDA's procedures, is something that should be done on the basis of experience with the drug after it's being used, if it has, as vaccines do, a huge timing benefit. But although there were people screaming, jumping up and down, saying we're not doing things right, there's a very long delay. It's very important to remember in this respect that the molecule that was injected into me, the Moderna, in January, was created in February of 2020, right at the beginning of the knowledge of the problem. And there was no delay whatsoever in creating the vaccine. The delay was entirely in the testing process. So if we could really speed up the next vaccine or do the counterfactual of faster propagation, it would make a big difference in Andy's evaluation. Christy mentioned a question just briefly on the fly, but I think it's really important, and that's what is the prospect of expansion of the economy on the labor market side. With 6% current unemployment, we can't really realistically expect to push it down below 4%. So there's 2 percentage points of expansion there, but there's 3 percentage points lurking in the dramatic reduction in the size of the labor force, which is clearly related to the pandemic. And as the pandemic recedes, we're going to see a 2% increase in the participation rate, and that's equivalent to a 3 percentage point decline in unemployment. So actually, normally in expansion, there's no growth of the labor force, but we're almost certainly going to have a reversal of the 2% decline in the labor force participation rate that was clearly a result from the pandemic.
Okay, thanks. So I'm going to remind or ask everybody to be really brief. We have a number of people who want to talk. Claudia Som.
Hi, thank you. So this question is for Christy, though it addresses some things that Abby talked about too. So just briefly, so usually when we're in a massive demand shock, which I would argue we did see last spring, I mean, we had unemployment going up to about 20%. It's still around 10 if you take into account people who've left the labor market. So what I was taught by a lot of you all is that in a moment like that, you should be doing very stimulative fiscal policy, such as the stimulus checks. So as Abby was talking about, I mean, our safety net just, it doesn't reach a lot of unemployed workers. It was better with the policies that were put in place this time, but we still had, I mean, she was showing replacement rates that we were still missing 40% of unemployed workers, right? So people still have to pay their rent, they have to feed their kids. You know, given the safety net we have, why aren't sending checks out good? Because they do get to those people falling through the cracks. So thanks.
Thanks. Catherine Abraham.
Thank you. I just wanted to pick up on a comment that Abby made about the limited use of short-time compensation programs during the pandemic. It seems to me that that was really a lost opportunity for US policy, that there are a lot of advantages to giving workers prorated unemployment benefits when their hours are reduced, as opposed to requiring that they be fully laid off before they're eligible for benefits. I think it helps workers avoid the costs of long-term unemployment. I think given that many of the businesses that were impacted are, we're going to need the same type of businesses in the future, it would help them. There is, of course, the issue that you worry about impeding needed reallocation by keeping people on their current jobs. But in this situation, I'm not very worried about that. So I'd be interested in both Abby and Christy's thoughts about whether, as we think about future policy, trying to find ways to make more use of short-time compensation in response to temporary downturns might be a good thing.
Maury Oaksfeld.
Yeah, just a comment on Andy's presentation. I think one becomes even a little bit more pessimistic if one reflects that variants are likely to be endogenous. They can arise even when a big percentage of the population is infected or immunized. And a cautionary tale is from Manaus in Brazil, where the Brazilian variant arose even though 65% of the population had been estimated to have been infected. So the pockets of people can be important breeding grounds, and we have two of them at least to think of. First of all, the vaccine hesitant, and there are a lot of them, surveys show, and also developing countries. The Kaiser Family Foundation estimated in March that so far these countries have been able to purchase only enough doses to vaccinate 30% of their populations. So if that process takes a long time, we could be in for many more variants.
Steve Davis, brief.
Yes, thanks. Great panel. I wanted to make a comment about the pipes of the UI benefit system, to use Abby's metaphor. There's a report from the Inspector General of the Department of Labor last month, and they say two things that are relevant to this discussion. One, in 14 out of 17 of the last year, 14 out of the last 17 years, the improper payment rate in the UI system has been 10% or more. And they also say their initial audit under the CARES Act suggests it's likely to be higher. Home gets much higher. So if we put that together with the numbers in Christie's table 1 about the size of UI benefits payments in 2020, that's what I think it was, we may have misdirected, and that includes fraud, something on the order of $100 billion through the UI system. And that would take $100 billion from the first part of Christie's appropriate spending and put it in the inappropriate spending category. And I emphasize that as just, there's a huge problem in the functioning of the UI system. And that's not the whole of it, but that's a big piece of it. It undermines the targeting goal of that program. And it arguably involves a large waste of funds, even by macroeconomic standards.
Okay, I'm afraid I'm just going to have to call it there. There's a bunch of interesting questions, both in the Q&A and I'm sure on tap, but we've got to keep going. I would urge people to make sure, people who have questions and want to continue this conversation, join the lunch breakout session. Okay, so we're going to take a brief break, and then at 12:10 Eastern, we will reconvene for the next paper. Thank you.
Hey, Dan, can you hear me?
I can.
Okay. All right. So I'm going to see if I can share my screen.
Andrew, you'll have to wait till the break's over. We have another, the screen won't let you share.
The screen won't let me share? Okay.
Until we start the session, yeah.
Okay. I will wait. I will wait for the break to be over. Dan, if you, I can just keep controlling the slides.
If you've got it, I'm
Yeah.
fine, because you'll know when to.
That'll be, yeah. I'll follow. I only have to make one switch.
Right. I just do the three attributes.
You're doing the last two slides.
Congruence, and then right. Yeah.
Okay.
Hi guys, good to see you.
Hey guys, we're live.
Andrew, hi Dan.
Hi. So Andrew, you're starting the presentation?
Yes.
Great.
Oh, okay. So it looks like have you put my slides up? Or is that me?
It's certainly not Jan.
Okay, then great. These are my slides. I don't know. They just suddenly appeared on the screen. So.
but they're not on the conference screen.
Oh, okay. Then I don't know what happened. Hang on. Okay, so I am now saying yes, please share screen.
There we go. It's coming. Yep.
Okay, why don't you just leave that up since we're starting in a minute anyway.
Oh, I don't think you're seeing the right screen.
Here we are.
Are you seeing the presentation screen, or are you seeing it also with the slides on the left?
Just the presentation.
Just the presentation, nothing, you don't see the 1, 2, 3, 4, 5 on the left. No, just the presentation. Okay, great. Then you're seeing. All right, we got it.
Jan, is my volume okay with this new super mic that I've been given? I worry that I blast people out sometimes.
Oh, it sounds great to me.
Okay, thank you. Every time someone upgrades me for Zoom, I feel like I have to recalibrate everything.
Great. All right, I think we're ready to start. I want to welcome everybody back from that last interesting discussion and a short break. Our next paper is, as you can see, Congruent Financial Regulation by Andrew Metrick and Daniel Tarullo. And I think Andrew will start the presentation.
Thanks a lot, Jan, and thanks to Jan and Jim for inviting us to this, and to Brookings for hosting it. I'll dive right in. We're going to hold ourselves to just 5 slides of content here. I'll do the first 3, and Dan will do the last 2. First, talk a little bit about the general problem, which I think won't be a surprise to anybody listening. And then quickly about 2 case studies of malfunction, of the type of malfunction that we think we would like to see the regulatory system attempt to fix. And then Dan will talk about what our fix is in general, and then specifically how one might implement it in, for example, these 2 case studies. So that's the plan. Okay, so first, the statement of the problem. We made banks safer. I think it's really quite good news, and we shouldn't lose sight of this good news, which is that not only did we have a massive liquidity panic a year ago, but we have had a year of much worse economic performance for very good reasons than I think was in any of our stress test models. But yet we're not hearing about bank solvency concerns. Nobody is saying, oh, I'm worried about this bank, we're gonna have to bail out this bank. It's just not a common conversation, at least right now in the developed world. And that's really outstanding. That would not have been the case, I think, pre-GFC reforms. But also, we have to recognize that buying that safety, does cost something. And while we have shored up bank balance sheets tremendously, and that's why they were able to absorb this shock, there are constraints now on those balance sheets, and those constraints have been filtering through the system over the last 10 years, such that what we used to call the shadow banking system, and now goes by other names, non-bank financial institutions is the popular one now coming out of the FSB. But basically, if you're doing a traditional banking function, but you are not a bank, you are not a depository, you're not subject to all the same rules as banks, we're seeing that part of the system, that parallel system, really grow in its market share across a lot of different markets and do some things that it hadn't done before. And even people who consider themselves experts on the system, as I used to until I learned how little I knew in seeing what had gone on in the last year, are surprised by some of the changes that have happened in the last 10 years, partly as a result of, we can call it regulatory arbitrage, or just the movement of the activity away from the place where it might have some regulatory costs to places where it does not. Now, even though the shadow banking system, if I'm still allowed to call it that, is less regulated than banks, it's still the case that in extremis, it does benefit from the safety net and contribute to systemic risk. So we have observed that. And when the Fed did its monstrous work and the ECB did its monstrous work a year ago, among the beneficiaries were some of these non-bank financial institutions that had been engaging effectively in bank-like activities, but without all of the regulation. So maybe this is what we want. I don't think it's what we want. Dan and I don't think that this is really that we got here in any kind of planned way, but rather we've kind of gotten here because we made one part of the system safer and people kind of took their cars on a different highway that wasn't subject to the rules. And so this is a good opportunity for us to step back and think about what we want to do. Okay, so quickly, non-prime mortgages is one of our two examples. The other is what happened in Treasury securities. So non-prime mortgages, we all know that this was a big issue leading into the global financial crisis. The private label securitization chain, we all learned about that, asset-backed commercial paper, securitization, CDOs. We had an alphabet soup before the global financial crisis. Largely, a big chunk of that market went away. And there's very little private label securitization for non-prime, non-Fannie and Freddie loans these days. We're not really seeing anything there. So, but people are still getting these loans. Largely, they are in the United States guaranteed by the FHA or the VA. The VA actually having a larger market share now, somewhat surprising. And they get securitized, are guaranteed by the FHA and the VA, and they're securitized by Ginnie Mae. And who's ultimately buying a lot of these things, even the agency guaranteed stuff, a lot of them are being bought by mortgage REITs, mortgage real estate investment trusts. And all along this new chain, kind of at every step of the chain, from the individual mortgage brokers that are arranging the loans, the non-banks that are arranging the loans, and they have 75% of this market, all the way down to those who end up owning it, are a bunch of institutions often serving the same role that banks used to. You know, they're originating and then holding on to these loans, but subject to very different regulation. So the paper has some figures that show these nice little chains and describe each one of the things in it, but it would be hopeless for me to try to do that in my time available. So I'll just point people towards the paper. Figure 4 has what I just described. You can see, however, in figure 8 of the paper that in fact, even these mortgage REITs, which are holding government guaranteed securities, these things have no risk any more than the dollars in your pockets do. They fell in value by 80% in March. You know, that is clearly a liquidity effect. They're highly levered. Markets start to disappear on us. And so there's no question they were helped tremendously by the Fed's infusion of liquidity, but we don't get to tell them how much leverage to have. So we don't have the same rules as we do for banks. Treasury securities, they've gotten a lot of attention. You know, we know these markets we first noticed these markets could malfunction in ways that we didn't quite understand in September of 2019. We saw that again in March of 2020. It's led to a lot of papers on this topic. Many people who I'm sure here in this audience who know much more about it than I do at the level of detail. Dan and I aren't trying to come and claim somehow we have some special insight into this market specifically. Rather, we just want to talk a bit about how it got to where it did and how we might want to fix it and change and fix it in a more general way. So instead of the world of primary dealers buying this stuff and then intermediating them, as I think is now well known, it's a world where hedge funds are selling treasury futures. They then buy the physical treasuries and hold them until they deliver them for the futures contract. And while they're financing that whole thing with repo. And ultimately, the other end of that repo often is the money market mutual funds. So banks are somewhat out of this business, in part because of the regulatory balance sheet cost, and it's been taken over by this interesting chain of money market mutual funds, hedge funds, and now in the most recent years, central clearinghouses. So FICC, the Fixed Income Clearing Corporation, in fact, has a form of repo that really enables banks to avoid balance sheet cost. Money market mutual funds had no money in this as of 2017. On the eve of the crisis, they had 250 billion. Okay, so this was really quite a surprise. This is a form of sponsored repo, which just hasn't gotten a lot of attention. And so why, again, we're going away from our nice safe banks this other way, and we learned that this system could be under great stress. So how do we fix this? So I get to just state the problem, and now I can leave it completely to my co-author for the solution. Take it away, Dan.
Okay, thank you, Andrew. So in light of the continuing permutations of NBFI activity of the sort Andrew's just described and which we go through in the paper, we suggest an organizing principle of congruence to guide regulatory initiatives. So let me say a few words on what we mean by congruence, and then I'll provide a very brief illustration of a first, although we think significant step for implementing it. Our core notion of congruence, of our congruence principle, is that forms of financial intermediation posing similar risks to financial stability should be regulated with similar stringency. And that should be the case regardless of the legal form or the business model of the entity involved. As we conceive it, the congruence principle has the following key attributes. First, the resulting regulation should be directed toward containing systemic risk, not all the risks that are associated with, for example, bank regulation. Second, while we contemplate that only significant contributions to systemic risk would be covered and thus regulated, congruent regulation, in our mind, would aim for ex-ante comprehensive coverage of activities that pose similar risks. And that would be a distinction to the present situation in which, since the global financial crisis, we've had a largely reactive business model by business model approach to trying to regulate NBFI activities. And obviously, this is aspirational. This is not something that could be achieved right away. Third, congruence does not necessarily mean identical. So, for example, in our suggested approach to regulating lending collateralized with securities, we contemplate the use of haircuts and margins as well as capital regulation. And a corollary of this point is that we wouldn't need an overhaul of regulatory activity, such as would probably be necessary to adopt a purely activities-based approach. That is, you wouldn't need a lot of legislation to be able to start the job. Congruence can now be applied through the existing balkanized, institutionally based regulatory system. So what in the paper, next slide, Andrew. In the paper, what we do is to outline the process that could be followed under present law to achieve congruence in the regulation of the systemic risk associated with securities financing transactions. We don't actually do that work of calculating what the margins would be, at least not in this paper. We're just trying to show that it is possible under existing law. Now, to do this, there would first need to be an analytic exercise to determine the appropriate macroprudential charges associated with this activity. And then you'd need an implementation exercise to apply appropriate regulatory requirements across the various markets and platforms in which the activity takes place. In practice, the two exercises may well be melded, since the differing kinds of risks that one observes with, for example, a central clearing facility as opposed to bilateral transactions would probably be taken into account even in the analytic phase. Now, let me just say right away, this would not be a straightforward process, either substantively or procedurally, and Andrew and I recognize that since we first began thinking about it. As to substance, the regulatory agencies would need to determine, in effect, the macroprudential component of capital and potentially other bank regulatory requirements. That is to say, distinguish them from other regulatory purposes. The current capital regime obviously doesn't make a clear identification of how much of regulation is macroprudentially motivated. So this is going to call for considerable technical work and ultimately judgment. But I'm not sure that it would call for any more of that technical work or judgment than lots of current regulations, things such as swap margining requirements and indeed capital requirements themselves. And the exercise would have the virtue of focusing all the relevant regulatory agencies on system-wide risks. As to the process, we'd need to involve 5 or 6 agencies, the banking agencies, the SEC, the CFTC, and at least for Treasury-backed lending, the Treasury Department itself. Now, it's obviously going to be a challenge to get agreement among all these agencies, as we saw with the implementation of required joint rulemakings under the Dodd-Frank Act. But, and this is potentially a very important point, we do think that legal authority exists for a single agency to drive the process, both with respect to transactions involving treasuries as collateral and those involving other securities. Now, it may come as a surprise, even to people immersed in financial stability policy, that we think the Treasury Department has authority to set minimum haircuts under the little-noticed Government Securities Act of 1986. To date, the Treasury hasn't really actively used that law. It basically passes the implementation to the banking agencies and the SEC, and it's more or less incorporated SEC capital requirements for dealers. But the scope of the financial responsibility, that's a term of art, financial responsibility standards, which Treasury is asked to promulgate under that act, we believe is potentially quite broad-ranging and could cover minimum margining requirements. The Fed has parallel authority under the Securities Exchange Act of 1934 with respect to all securities financed lending transactions that are not backed by Treasury collateral. Indeed, some of you may remember that back in the 2014-15 period, the Fed was contemplating use of that authority in order to implement an agreement it negotiated internationally in the Financial Stability Board to have minimum margins on non-government securities-backed securities financing transactions. Unfortunately, that agreement has been shelved every year since. In both cases, there's not the authority to cover transactions as such, but the statutes provide, I think, enough regulatory room because basically they allow Treasury and the Fed to impose the regulations on dealers. And the definition of dealer under the Securities Exchange Act of 1934 is pretty broad. There's limited judicial precedent on it, but what precedent there is suggests that if you're doing a lot of business, you are a dealer. Now, given the structure of the two laws, the implementation and enforcement would have to largely be done by other agencies. And that means it will need to be a cooperative and thus somewhat messy enterprise, even though we do have an underlying single legal authority. But Andrew and I began our exercise almost a year ago, and we're ending it today, or at least interim ending it, by asking what's the alternative? If the alternative is just to leave each agency to its own devices, we don't think that's a very good response to what we saw in March. And if the response is to say, the alternative is to say, let's wait for Congress to comprehensively reorganize macroprudential regulatory authorities so we can do everything on a transaction by transaction basis, that may be a long wait. Thanks very much.
Thank you. Both Dan and Andrew, that was great. Their first discussant is Vera Lacharia.
Thank you, Jan, for inviting me to discuss this really interesting piece by Andrew and Dan. And I wanted to start out by stating a very interesting theorem that my colleague Larry White explained to me when we were writing our book on the government-sponsored enterprises and the debacle of mortgage finance in the United States. In his sort of unique way, he called it the waterfall theorem of arbitrage in the financial sector. And the theorem was that risk travels within the financial sector until it reaches the balance sheet that has the lowest regulatory capital requirement to warehouse it. And in our book on the GSEs, we were explaining that for how GSEs ended up with such a large share of mortgages on their portfolio, because there was this capital arbitrage in the system, and the waterfall theorem meant that whatever the GSEs could hold, they should hold all of it in big chunks. And I think the piece by Andrew and Dan highlights two very interesting examples of this, especially the first one on how the non-prime mortgage originations end up in many cases, with REITs holding these assets. And more broadly, this has led to the view that gets echoed, I would say, on a recurrent basis in the literature on financial regulation, that we must regulate by function rather than form. And I think there are two variants of it. The first one is the most common one, which is that we should regulate things that look like banks as banks. But perhaps there is also an instrument version of it, which is that, we should regulate deposits and money market savings in a similar way. After all, we know through history that money market funds came about because of Reg Q and the Reserve Primary Fund, the first to be formed and the first to fail, was really a cycle of shadow banking getting around Reg Q. And ditto for portfolio mortgages versus mortgage-backed securities, because sometimes even for the same institution, if the risk is pieced up into different alternatives, we don't have internally consistent regulatory capital requirements. And I think I think of Andrew and Dan's congruence principle as, I think, another take on this important point. And I think it's crucial that they have brought it back in spotlight, because there has been a tendency in financial sector regulation to forget about this once we have reacted to the last war.
But what happens is once you finish the last war and your immediate reactions to it, such as the Dodd-Frank Act, of course, the waterfall theorem starts applying all over again. And, over a decade, by then you have several imbalances showing up in different parts of the financial sector. Now, there are several reasons why I think the systemic risk focus of the piece is absolutely crucial. And besides the overall risk that the system as a whole could collapse because maybe shadow banks have just become very large, I also want to highlight that invariably shadow banks have been found to be very close to banks in their activities. And perhaps this is not surprising once you think about the waterfall theorem, because banks are by and large involved in originations, and therefore they are a part of these regulatory arbitrage chains in one way or the other. And I like this quote a lot. It's actually from a children's poem on shadows, that shadow always touches the feet. And I think there's something similar to shadow banking. And the linkages arise either through explicit guarantees. Banks provide credit lines to give credit enhancement so that money market funds can hold short-term paper. They may have provided implicit guarantees to get around, some capital requirements and move stuff off balance sheet, such as in SIVs and ABCP vehicles, asset-backed commercial paper vehicles. There's also just flow of fund linkages, which is that banks may be providing insurance, liquidity insurance to firms. And then when the bond market freezes, firms are now insured by drawing down on credit lines. So even if bond market freeze is not directly connected to banks, through the chain of contracts, the fact that corporates have arranged insurance, it again comes back to the banks. And of course, there's information contagion and direct interconnectedness. So I think getting into the cracks of systemic risk into the shadow banking is important to ensure safety of payment and settlement systems, because at least as of now, banks are important parts there. We'll have to see how that changes if digital stuff takes off in a big way. And there's a second reason why I think Andrew and Dan's piece is very, very timely, especially after what we have seen in response to the COVID. I think the central bank remit has really shifted over the last 12, 13 years. I think it's almost a given. Everyone now almost asserts that we have learned that the efficient thing to do is for central banks to not just be lender of last resort to institutions such as depositories, but that they should really be a buyer or market maker of last resort for systemically important markets at large. Now, people say this very comfortably and almost as a matter of fact, but I think it has a tremendous implication if one thinks that moral hazard is something to worry about, that we have effectively expanded the safety net to essentially all parts of the financial sector. My sense is, at least as of now, one has to pause and accept that that's the state of affairs, whether we like it or not, and whether it's efficient, exposed or not. And therefore, I think it's paramount that we start thinking about whether there's adequate private insurance in contracts, because otherwise, I think the long shadow of moral hazard just keeps getting broader and broader. And, whether there's any risks we are not willing to socialize, I think it's really anyone's guess. So again, I think the congruence principle that we must regulate different institutions and different risks in congruent or identical manner, maybe it's really worthy of discussion given this expanded central banking remit and expansion of safety net across board. And finally, to just propose some ways in which I think Andrew and Dan's congruence principle could be implemented. I have some thoughts on that they might consider for their future drafts, that we have to think hard about the political economy considerations. As I said, regulating by function rather than form keeps coming up. It just doesn't get as much traction and sustainably in the financial sector reforms. And it does beg the question of why we haven't embraced this concept before more wholeheartedly in the regulatory space. Why do we keep fighting the last wars and then assessing our performance based on that rather than taking a system-wide approach? Of course, I don't have a proof, but my conjecture is that this is because of a short-term trade-off in growth and employment versus financial stability. And even if there isn't a long-term trade-off, which is that if we really ran a stable financial system, it would probably be for long-term growth and employment. It would be a plus for that. But given that these trade-offs are often short-term, not just in political minds, but perhaps also in individual central bankers' minds, it's good to think about the implementation. And a second point here is related to political economy, which is that perhaps individually regulators may not have wanted to embrace this idea because maybe a central bank doesn't want to get into housing regulation, because if it does, they know it's going to be politicized anyways. And then, they worry it's a slippery slope. And then, first comes housing, then comes corporate loans, then comes monetary policy. And that, we could be having conversations about all of them all the time with the governments. So this suggests that maybe when we think about implementing the congruence principle, we may have to not perhaps take a case-by-case approach, even though it is good to think about every individual case in my view, which is that I think the empowerment of the regulatory authorities has to be broad. And I think this goes to Andrew and Dan's point that we need legal backing for this. Because I think if we try to push for legal authority case by case, I think it's going to be a process that's politically extremely vulnerable and heavily subject to the risk of lobbying and so on. So I had three ideas. One is that perhaps we need to get in the US FSOC and internationally the Financial Stability Board / BIS to adopt the principle. Maybe the idea of regulating by function rather than form, or the congruence principle, should really be elevated at the highest level in these discussions. Maybe it needs a committee to be set up to assess it, to see how we do it across board and embrace it wholeheartedly. Second, and this is my favorite one, which is that we need to immediately put in place what I call as a Hotel California approach to extending the safety net, which is that once a part of shadow banking has been given safety nets because exposed, they turned out to be systemically important. That's it. They are systemically important financial institution or a set of institutions from then on. And the SIFI authority, such as the FSOC, has to automatically be transferred the powers to regulate it. I found it really bizarre that we extended the safety net to money market funds, and then we were going through this lobbying process of whether we should regulate money market funds or not. I thought it was extraordinary after the global financial crisis. And if the global financial crisis cannot swing the pendulum decisively in favor, and we have to wait for long for these reforms to take place, it suggests that we have not embraced these principles, and the legal backing is not as strong as we would like. And finally, I think that even when regulators don't yet recognize a set of institutions as systemically important, they must run stress tests over there. So it's kind of like I would say a medium tier authority, which is that I can run stress tests on you, even though I'm not yet regulating you as a SIFI. Maybe we did this for insurance companies, for example, but perhaps it needs to be broader. Why? Because if they do show up as important in the stress tests, then perhaps we can think of applying the congruence principle, at least on a state contingent basis, provided there's the legal backing to do that. So if something is very small, it doesn't show up in the stress tests, maybe we don't need to spend a lot of time, all the time, trying to fix everything to the congruence principle. But we need to keep watching on an ongoing basis, testing what needs to be brought into the framework of the congruence principle, and system-wide stress tests are perhaps the only way to get this done. So let me stop there. I think it's a very important idea. I commend Andrew and Dan for bringing it up. I think it's just the right time given how we have expanded the safety net worldwide over the last year. And I think we run the risk that even what we thought was entirely private risks, such as corporate loans and corporate bonds, may very soon become systemically difficult because risks are perceived as being entirely socialized. Thank you.
Thank you, Viral. That was really helpful. The second discussant is Hyun Shin.
Yes, hi, Jan. Thank you for the invitation. And let me just post my slides. I hope you can see that.
Yeah.
It's really a great pleasure to discuss this paper and to be back at Brookings. I think my discussion is going to be very complementary to what Viral has just presented, and it's really only just one message. I just want to underline one very important theme in the paper, which is that focusing on defaults may give us an incomplete picture of systemic risk. Now, this picture is typically how we think about systemic risk, and it's the so-called domino model of cascading defaults, where A has borrowed from B and B has borrowed from C. A takes a hit. If the hit's big enough, B takes a hit. And if that's big enough, then C takes a hit, and so on. It turns out that, so if this is true, then if the underlying assets are safe, then we shouldn't have systemic risk. But in fact, I think what the paper does very well is point out that it's the deleveraging that could be the really potent force here. And let me just pause here just to illustrate how you could have a change in leverage through three different ways. The left panel is the standard MBA textbook example of an equity buyback with a debt issuance. So you squeeze equity, you increase debt. The second is an asset sale, and then that is paid out as a dividend. But it's a third mode of increasing leverage, which I think is crucial to understand this paper, which is the idea that when the constraint on leverage is the margin or the haircut, then a decrease in the margin allows you to expand the total size of the balance sheet. And we know that this is the appropriate way of thinking about leverage in the non-bank financial intermediary sector. And if we just look at the data, this is from the US broker-dealer sector quarterly series from the flow of funds. And the way to read this is the horizontal axis is the quarterly change in the total assets of the whole sector. So it's the dollar value. And on the vertical axis, we're measuring the dollar value of the change in the debt, which is the blue dots, and the dollar value of the change in the equity, which is which are the red dots here. And if you look at the slope of the blue line is essentially 1, which is to say, dollar for dollar, a change in the assets are matched by a change in the debt, and the equity is pretty fixed. So we're looking at the right-hand diagram here, where a dollar increase in assets is exactly matched by a dollar increase in debt. Now, why is this important? Well, and just to point out that on the far left corner there is 2008 Q4, that huge deleveraging that we saw from Q3 2008 to Q4 2008. This was really the and if you read the example of the lead up to the GFC, it was a deleveraging and the increase in the margin which really caused the biggest damage. The issue is that if you have an increase in margin, like you saw in 2008 Q4, after a very protracted period of thin margins, this is going to really enforce the lower leverage across the system. And to the extent that that's actually going to other system participants, you're going to see a huge contraction of credit to these other parties. And so clearly insolvencies are going to exacerbate the stress, but it's not necessary to actually have the stress in the first place. And I think one of the things that comes up very clearly is that pecuniary externality, in other words, spillovers that work through prices, might actually be pretty important. And here's one example in the treasury market. So this is the difference in the futures implied price of treasuries. The blue is the 30-year treasury, the red is the 10-year. So it's the difference between the futures implied price and the cheapest to deliver cash bond. And then you adjust it for carry, and you saw this huge spike where, if you're engaged in a relative value trade where you're buying the cash bonds, financed with repos, but then you're hedging that price risk by shorting the futures, this kind of blowout in the spread is exactly what's going to force you to unwind, or this kind of stress would actually transmit to the other parts of the system. I think it's the so to the extent that this kind of price mediated stress might be an issue. I think we need to have a better sense of why it is that we actually regulate margins. It's not so to some extent it's there to protect the equity and to protect against default. But from a system perspective, it's the size of the balance sheet which is also going to be important. And I'll finish with this one chart, which I think illustrates very nicely the central theme in the paper, which is that there's been a very far-reaching change in the structure of the market-based intermediation system. And the left-hand panel here is just showing you the total assets of three sectors. The red is the household sector, the blue is the non-financial corporate sector, and everything is based to 100 in Q1 1990. The yellow is the broker-dealer sector, which saw this tremendous growth in the lead up to the GFC. And and then we saw this very sharp deleveraging during the crisis. And then and from then on, it's really been very subdued. And you see the leverage chart on the right-hand side. The leverage has come right down. But I think what the paper does very well is that this kind of chart gives a misleading impression of the total size of the non-bank financial intermediation activity, to the extent that a lot of the activity has migrated elsewhere. And I think so I think the central theme in the paper, is well worth thinking with these kinds of things in mind. So let me stop there, Jack.
Great. Thank you, Hyun. That was also great discussion. We'll open it up to discussion from the floor before we go back to the authors and give them a chance to respond to the discussants. We have a hand up now from Don Cohn and some more are coming up. So if you'd like to make a comment, please raise your hand in the participant list. So Don, why don't you go ahead?
All right, can you hear me now?
Yeah, we can hear you, thanks.
I'm sorry. So I really liked the paper. I thought they did a very good job of defining the essential problem of the risk moving away from the banking system and the regulatory arbitrage and the financial stability risk. The concept of the Congress, the linking up the regulation to get the same kind of leverage across transactions is right. Coordinating across agencies, and I thought it was very clever that they found some existing authority that could be used in a more proactive way than it has been used. My question and my doubt is whether the agencies will really buy into this. So thinking back to the resistance to what seemed like pretty simple money market reform, 5 years ago. I think it's going to be very, very hard to get this coordination. And I have one legislative suggestion that I think will really help implement, and that is give every agency on FSOC a financial stability mandate to add to their existing mandates, and make them create a financial stability office that then has to interact with all the rulemaking and can interact with the other offices. I think until the agencies see the financial stability mandate, I'm doubtful, unfortunately, that they'll take the kind of actions that you guys have pointed out. Thank you.
Thanks. The next question is from Austin Goolsby. Austin, you'll need to, you unmuted, great.
Thanks. Kind of in the spirit of Don's previous question, doesn't the existence of the shadow banking system and their political strength, doesn't it say that though this is deeply correct as a diagnosis, that there would be legislative / political that the political figures would opt to block any such? It's not just the agencies, it's that senators and advocates of the industries would kind of work to prevent it. And I guess that leads me to my direct question of, is there a way to quantify in your mind how much more damaging it is to just have the Fed have to do emergency rescues or interventions of the form that we saw when things go wrong, rather than try to overturn the politics of the regulatory system?
So why don't you guys start off by answering those questions, and because there's been a number of issues raised about actual implementation. So Don's question is about that, and also Austin's, and it came up in the discussion. So why don't you start with that before we get any more questions?
All right, Andrew, you want me to start with the political economy points? In the absence of a negative from Andrew.
Oh, yes, sorry, I was muted.
Okay. In the absence of a negative, I will do so. Obviously, both Don and Austin are right in anticipating institutional difficulties in the interagency process, and at least potentially political difficulties. I would say, Don, I think that, well, I'd say two things. First, speaking strictly as a lawyer, as a law professor, I kind of think that there's a financial stability mandate to the market regulators already within Dodd-Frank, even though it doesn't state it in just those terms. But given the number of rulemakings that it makes the market regulators involved in, I wish they would have concluded that they have such a mandate. If you could get legislation on such a mandate, that would be great. Anything more to push people in that direction would be great. My pretty strong suspicion is that President Biden's appointees to all of the financial regulatory agencies are going to have more of an inclination to undertake this sort of thing than certainly their immediate predecessors, and maybe even the appointees of the Obama administration. But we'll just have to wait and see. Austin, on the point about quantification of, well, I'll leave that to Andrew, the quantifying question. I would just give you a kind of qualitative answer to that. If it turns out that this is basically going to be a free ride for non-bank financial intermediaries because there's not going to be a prospect of regulating, and as Vero pointed out in his comments, the safety net has become more and more explicit with each passing crisis, then I would anticipate that there would just be an accelerated outmigration of various forms of financial activity from the prudentially regulated sector, which I think that's going to make it hard to calculate, what that curve would look like over time. But it also is going to start eroding more dramatically the franchise value of the existing prudentially regulated sector. And so I think you kind of just get into a syndrome at that point. Both of your questions are very fair ones, but I would say that's the reason why Andrew and I took the position that we did, that we know what we're proposing is both kind of messy in interagency terms and not at all assured of success, but we're not at all sure what the better alternative is right at this point. I like some of Viral's suggestions because they're ways of kind of underscoring everybody's responsibility, even short of Don's legislative approach. But, you know, when it comes right down to it, if Treasury and the Fed, much less the other agencies, are not willing to undertake this, then we are just going to be in the position that we're in. And by default, the Fed will have to, every time there's a market dislocation, will have to decide whether, yes, we're going to go in and provide more liquidity again, even though we know we will have just reinforced every instinct in the markets that they can count on us under stress.
Andrew, did you want to pick up the quantification question? No, okay. So I was going to ask you actually to respond to Viral specific suggestions, which Dan just mentioned. So in particular, you have implicitly maybe talked about the FSOC and the FSB a little bit, but you could expand on that if you want. But in specifically his Hotel California suggestion, which for those of you who aren't steeped in rock lyrics from, I'd like to think it's the 80s, but I think it's the 70s. You can check out anytime you like, but you can never leave, something like that. And the system-wide stress test, which I think has the flavor of an extensive margin aspect to the stress test rather than just looking at particular institutions. So could you comment on those other institutional mechanisms?
Sure. So with respect to Hotel, and you're right, Jan, it was an Eagles song from the 70s, not from the 80s.
Darn.
And of course, it was incorporated into Dodd-Frank, not with respect to liquidity assistance from the Fed, but basically it was the injection of capital by Treasury, so that today, for example, Morgan Stanley, even if Morgan Stanley or Goldman Sachs divested their banks, their IDI, their insured depository institutions, and thus ceased to be bank holding companies, they are nonetheless regulated by the Fed because of the Hotel California provision. As a principle for incorporating into legislation, some future legislation, I would be very much in favor of it. And, you know, I think tomorrow, is the 13th anniversary of then candidate Obama's Cooper Union speech, in which he proposed something of that sort. Any entity that ended up getting assistance from the Fed during a financial crisis should, by definition, then be a prudentially regulated entity. I guess part of the problem here may be that a lot of what the Fed did was to inject liquidity into markets rather than necessarily to particular institutions. And the second point, of course, is that at least under current law, there's no automaticity there, and thus you would need, as we needed the SEC to take action on money market funds, you would need the regulatory agency or agencies with authority to act. System-wide stress testing, I think is a really good idea. It's not easy to accomplish bureaucratically, particularly in the US with our balkanized regulatory system. I think it's something that is probably easier to do in the UK. Don probably does have better insight into that than I, with a more unified regulatory approach. But I think as a policy and an analytic matter, it's sort of unimpeachably a good idea. And FSOC, yeah, I think, sure. I mean, I would absolutely hope that the theme would be struck and restruck in FSOC. And in a way, what we were proposing with this notion that Treasury take leadership on the Treasury-backed repo is that it'd be used as leverage to enhance Treasury's position within the FSOC for saying, we can not only urge you to do something, we have the legal authority to drive it.
Jan, could I add a little something? Yes. So the theme that's come through in a lot of the discussion comments and in Don's point and Austin's point that has to do with the practicality of all of this. And I want to stress, Dan talked about these things. I want to stress it just to make sure it's clear. Maybe a fundamental part of our paper was we know legislation in this area is hard, if not impossible. And so the task we set for ourselves was to think about what can we do with existing statutory authority? What is available with existing statutory authority that can't just be easily blocked by one filibustering senator, for example. And it was that with that theme that we ended up with this concept of congruence. Viral points out correctly that people talk often about regulating by function rather than form. Congruence is a bit different than that, because to really regulate by function, not form, you would need legislation. We can all kind of talk about this all we want, but that would be a paradigm shift in the United States to really do it right. Rather, what we're saying is we have existing authority already. It's just that places that have it need to think about it as a systemic risk thing. Right? So the SEC needs to think about their margining authority, not about protecting investors, but rather being congruent to the financial stability concerns that perhaps the bank regulators have when they do it for banks. So that's what all of this is what makes congruence a bit different than form and function, and makes congruence something that we think of it as achievable under current statutory authority. That doesn't mean the agencies are all going to behave themselves and want to do it. We're just hopeful that maybe right now would be, if it was ever going to happen, it would be now.
There was a question in the Q&A from Andy Atkinson. Andy, do you want to ask your question live? Are you there?
I don't think he's there anymore. Oh, wait, hold on.
Oh, Andy needs to be promoted to the Q&A.
Okay.
There he is. Thank you.
Okay, thank you. So this is really motivated by the picture Hyun Shin showed about broker-dealer balance sheets. I had an opportunity to ask Larry Fink about why did Wall Street get so big? And he answered immediately, ERISA. And it took me about a year to figure out what he meant. But I think it links back to our first session that the funding of defined benefit pension funds that was required under ERISA created big pools of institutional money. And as we discussed in the first session, if taxpayers are going to bail out these pension funds if they go bad, it seems like they are like a root cause of the demand for risk-taking in the financial system that the broker-dealers are servicing, through the hedge funds, et cetera. And so I just wonder whether it might make sense to go at that source. And it's not just the US, it's a worldwide demand from these funds to regulate them as investors rather than regulating the intermediaries.
It's an interesting question. I don't think that the pension funds have historically been a big part of the problem that we're talking about here. That's not to say they couldn't be part of the solution. And in part that really is.
I think they are indirectly through hedge funds.
Okay, so I see. So the hypothesis would be pension fund investments, for example, in relative value hedge funds, and then it's the relative value hedge funds playing this game of intermediating the treasury markets. And if we had, it's an interesting thought. I can't say that I have thought deeply enough about it to have a good answer for you, but I will think about it going forward.
Yeah, I would just say, I mean, it is an interesting thought, but I would say that in keeping with our sort of ex ante comprehensive, don't wait for the mutation to occur approach, I think I at least would be a little reluctant to say, well, let's try to identify today's source of the motivation for a lot of these things, because that motivation may shift to a completely different source or a different channel tomorrow. So it might be something that, the new Secretary Walsh wants to think about for different reasons. But in terms of financial stability regulation, I think one wants to stay with the sources of financial risk, and that's why we took the approach that we did. I will say, though, Andy, that one thing we just mentioned very briefly in this paper, but maybe there'll be a subsequent paper on this, is the specific role of mutual funds, potentially EFTs, other intermediaries that do not take on any risk themselves, but are basically just maturity transformers. But the scope of their maturity transformation has grown exponentially since the global financial crisis, and it probably does need some direct attention because of the differing incentives that exist for investors to pull out and the like there. But we just didn't tackle that in this paper.
Yeah, could I just jump in with a quick comment?
Yeah, go ahead.
Yeah, if it's okay. Yeah, I just wanted to make sort of one slightly tangential point to Andy's observation, which is that while it's entirely possible, I think that some of the pension fund search for yield is manifesting itself through hedge funds, etc., maybe even for other institutional investors. In the end, though, it really begs the question of whether they are being offered enough on their long-term investments of the traditional type, what they used to earn through fixed income investments. And I think it's an important financial stability angle to monetary policy, where we have used bringing down the long end of the yield curve tremendously in the hope that will actually create longer term investments. But I think the question is whether it's creating longer term value enhancing investments, or is it really creating longer term high risk speculative kind of hedge fund investment? So I just worry a little bit that if the root cause of the problem is that the long end is in the fixed income, the traditional safe asset is not giving pension funds enough. If we try to attack that problem through financial regulation, we'll just have a whack-a-mole problem. It's just going to show up in some other form. And, then I just thought I'll raise this possibility that it's more about monetary policy, especially unconventional, rather than about financial regulation.
Okay. I think we will wrap up there. We're just ready to take our lunch break. So we have a 10-minute break before the breakout sessions. So in your email inbox for the participants on Zoom, you'll find an email from Anna Dawson that has links to the 3 breakout sessions, one on state and local public finance, one on COVID-19 policy and economy, and one on financial regulation. And so you can click on those links to go to the 30-minute breakout sessions once you have had a chance to get your lunch. We'll come back from those at 1:50 Eastern time and use the link that you got this morning for the general session to come back in so that we don't have the BPEA version of Hotel California. So you can come back for the history panel, and there will be a brief audiovisual presentation that Brookings has put together on the history of BPEA, and that will commence with the panel at 2 o'clock. Okay, so first look for the links for the breakout sessions, and those will start in 10 minutes at 1:20 Eastern. See you soon, and thanks to all the morning presenters and discussants.
And the history, the video is worth seeing.
Yeah.
Great, thank you.
Hey, Jim, I was trying to leave that on, but I had to turn it off to get our next panelist up.
Okay, everybody, welcome back. I think our audiovisual is ready to tee up, and we'll come back and start the panel.
You know, Brookings Papers is probably the single best source I look to for really contemporary relevant research about economics written by really good economists. The Brookings paper is, in my view, perhaps the premier location for really good, really relevant policy research.
I think people have not as fully recognized how much the Fed, and this does start in my regime in 2008, how far it's gone beyond classic budget. I think this is justified by the circumstances. Again, I'm not being critical, but we will need new doctrines and new thinking about how the central bank operates. And we'll have to ask the question whether or not these extra tools might help, for example, with the zero lower bound on interest rates and monetary policy as well.
If you care about macroeconomics, if you care about doing research that connects to the actual economy and the actual challenge that policymakers face, the best set of examples of that research that you'll ever see are in BPEA.
There is a thread through the literature on cost-benefit analysis using a value of statistical life, trying to say, well, what is the economic cost versus the death cost? What we're trying to say is that that's the wrong either or, that we can have, through disciplined use of non-economic NPIs, we can both reduce deaths and make room for the economy to reopen. And it seems like now is a good time to start.
The reason I chose to spend my career working on economic policy and trying to figure out how we can refine policy so that it helps more people is really because of BPEA.
When I was in the field of macro, I was just finishing my thesis, and all the major macroeconomists of my day, the important people, were all involved in the Brookings enterprise, and it was something we regarded as very exciting.
The Brookings papers did for all those years, and I presume still does, is it extracted out of serious economics what the essence of what it had to say to the policymaker.
If you're in public policy, maybe you're a grad student, maybe you're not a PhD, but you're a grad student, maybe you're a business student, maybe you're just coming to Washington to work in government because that's your calling and so on. The Brookings papers, they're incredibly relevant, but they're also incredibly accessible. And I think that is one of the greatest, attributes of them and why they're such an important part of the policy scene.
When I was teaching, I would make sure that people would read the Brookings papers as a way of understanding how what they learn can be applied. And that's precious. The quality of a paper comes not only from the author, the editors, but very much from the people who are members of the panel. And I was extremely impressed by this at the beginning. When I came in the room, the amount of feedback you got, which was tremendously useful, which led you to rewrite the paper entirely, actually.
I was so excited when, as a graduate student, I was first invited to participate in BPEA in the late 1970s. And whenever I haven't had a government job, I've always tried to be a regular contributor to BPEA. I know it's brought the best out in me. And if you're lucky enough to be invited to do a paper for the Brookings papers, that will maximize the chance that your work will get visibility and will have a substantial policy impact.
I want to thank the Brookings staff for putting all of that together for us. We've had really a year to think about this 50th anniversary. We had hoped to gather everyone together in person in March a year ago to celebrate this 50th anniversary. And we didn't want to wait any longer because there's been so much happening that we wanted to celebrate this endeavor and start thinking about the next 50 years. So that video is a good example, as many of our mentors and inspirations of why we're proud to be part of this endeavor and take it forward. So the panel includes three longtime contributors to BPEA, both as authors, discussants, members of the panel. And we selected 3 main areas in which Brookings has made contributions to BPEA. So I want to ask these authors who've been patiently waiting and refining their work over the last year to present their work on labor markets, on productivity and growth, and on monetary policy. So I guess it's traditional to start with Bob Hall. So we'll start with Bob Hall on Brookings panels and BPEA's contribution to labor market research. Bob, are you there? Give him a second. You were there, Bob? We could go ahead and start with Bob Gordon if we don't get Bob Hall in a moment. Oh, there we are. There's Bob. You're muted still.
Okay.
There you are.
Now.
Great.
Okay, now. Here we go. All right, I think we're ready to go.
You are.
Think so? Okay, so the Brookings panel on activity and its journal, the Brookings papers, played a key role in the evolution of scientific understanding of the US labor market over the past 50 years. As in other branches of macroeconomics and related specialties, the panel has developed a unique position in the research process and in the dissemination of research findings at the intersection of labor and macro. Major new ideas and theoretical constructs have informed the panel's research and papers as accompanied by the careful use of relevant data. Although the panel has remained faithful to the founding goal of sponsoring research and publishing papers that informed current policy debates, the panel has established a leading position in basic research in labor market issues. It's been my privilege to be involved in the panel's activities as an occasional author, frequent discussant, and inveterate formulator of off-the-wall remarks from the floor, ever since the price of a room at the DuPont Plaza Hotel was $14. That was 1970. My remarks come in 2 parts. First, the labor market topic that's received the most attention from the Brookings panel is unemployment. So a lot of what I'm going to discuss today relates to papers on unemployment, but not all. This preoccupation is not surprising. Unemployment, shown in the first slide here, is a key indicator of the state of the aggregate economy. Unemployment receives as much attention from macroeconomists as from labor economists. In fact, sometimes I think more. And it's been a very important topic throughout the history of the Brookings panel. Modeling of unemployment advanced enormously over the past 50 years, and the advances were the subject of numerous well-known and heavily cited Brookings papers. But Brookings papers also covered labor market topics apart from unemployment, and I'll be talking about those too. So first of all, on unemployment, this picture shows the unemployment since the CPS survey went into effect in 1948, and unemployment is close to a stationary, untrended, mostly high frequency indicator, which means it's the ideal indicator for talking about the business cycle. You don't need gray bars to see when a recession occurs if you're looking at unemployment. That's one of its big advantages. Now, traditionally, unemployment was analyzed in a Walrasian competitive equilibrium type of framework. And in that framework, if we were considering the economy to be out of equilibrium, unemployment was taken to be the difference between the Walrasian supply and demand for labor. Then, right around the time when the Brookings panel was formed, we began to do something which was identified as landing on another. Oh, I know what the trouble is. Hang on. Here we go. The Walrasian continent was the traditional view that I just mentioned. The new view, identified as the landing on the non-Walrasian continent, which I'm taking here to be the USA, was something that as now dominates the theoretical and most practical discussions, certainly in the Brookings papers, of the theory and practice of analyzing unemployment. The paper that I'm referring to that announced that this was landing on the non-Walrasian continent went on to explain, and this is, I've loved to quote this, and I've quoted it many times, maybe getting bored from this, that this is Edmund Phelps writing. It's been a mind-expanding trip. We need never go back to P dot equals alpha times D minus S and Q equals the minimum of demand minus supply. That's the view that was aimed at, and I think, at least in my opinion, successfully eliminated. So the gapology approach to unemployment has pretty much been replaced by the notion that the unemployed are engaged in purposeful activities, dealing the best they can with frictions in the labor market. That was controversial at first, but less so today. And today you can write what's become the Diamond Mortensen Bicerides view, which is a new view, the landing on the new continent, that emerged from that revolution that occurred right around 1970, right around the time when the panel got started. So to explain the continuing presence of unemployment, the new model, what we now call the DMP model, invoked a steady flow of job losers and job leavers. Unemployment in the stochastic equilibrium of inflows of workers to the pool of unemployment arises in the stochastic equilibrium of inflows of workers to the pool of job seekers and outflows from the pool. This new view grew in influence to the point of receiving a Nobel Prize in 2010. So it is fair to say that it's deeply embedded in the profession today. Many established macroeconomists in 1970, though, gave this view a chilly reception, arguing that search and matching theory was blaming the victim by making job search somehow voluntary. But that negative view of this, I think, has pretty much disappeared today, although you still find occasional pockets of. Okay, so most microeconomists today view unemployment as the result of rational conduct of job seekers in the face of labor market frictions that impede the job finding process. Perhaps the single most important aspect of the new view is to make rigorous theoretical sense out of the concept of labor market tightness. The concept was obviously important. We knew that labor markets could be tight or slack, but we didn't have a theory of it until this theory began to develop around 1970, and then took hold as a view, especially prominent in the Brookings papers. Sometimes, notably in the years up to 2020, the labor market is tight. It was, in fact, when I wrote the first edition of these remarks, the unemployment rate was 3.5%. And there's many remarks which I had to change about the current unemployment rate, which right after I wrote that, just a few days after I wrote it, the unemployment rate just zoomed up to 14, or some people would say 17%. It was just a remarkable spike showing in that picture, which I can go back to. That's the spike. Okay, so traditional thinking involved something called aggregate demand. Getting rid of the concept of aggregate demand has been one of the accomplishments of this, but not everyone accepts that. Many people in this room probably don't accept that. But it's certainly the view I take, that you need a more precise concept of what's driving the economy than just something called aggregate demand. So a paper appeared, by the way, you're going to notice as I discuss individual papers that I never tell the names of the authors. It would take too much time, and it's going to be hard enough to get through this. So, but you can guess probably accurately in many cases. A paper appeared in the first year of the panel's existence, the first of quite a few, to study the flows into and out of unemployment for various demographic groups. It concluded, quote, unemployment is high at full employment, the topic of the paper, because first, normal unemployment remains high. The natural flow of workers through the labor market is high. And second, there's an additional component of abnormal unemployment. Members of some groups in the labor force do not follow definite careers, but change frequently and erratically from one job to another, experiencing unemployment with both changes. So I like that paper. Next in the line of Brookings papers that studied the flows in the current population survey was one that extended the investigation into what the literature now calls the three-state model, adding consideration of time spent out of the labor force to the story. And that's been an important, very important, especially recently. As I mentioned today, the movements of participation, which this brings into the story, have been very important under COVID. One of the discussions of that paper nicely summarized its conclusion. The paper, quote, shows clearly and dramatically the dynamic character of most unemployment. For most workers, unemployment is a state through which many pass rather than a condition that constitutes a chronic problem for a fixed group of workers. That commentary, which I found very interesting in terms of what amounts to archaeology at this point, included the Cobb-Douglas matching function in exactly the same functional form and notation that's been used in hundreds of search and matching papers in subsequent decades. I think it may be the first time that matching function was written down, and as an interesting contribution that I was unaware of until I prepared these remarks. Next in order in this line of Brookings papers in 1976 was a paper that continued the development of the three-state dynamic model. It introduced the study of what has become to be called the ins and outs of unemployment, rates of inflow to unemployment from job loss and rates of outflow from job finding. It recognized that part of the rise occurs because of demographic shifts toward groups. It recognized that part of the rise in unemployment in the mid-70s occurred because of demographic shifts toward groups with higher normal unemployment, but concluded that there was more to the story. Increases in unemployment are a serious, this is a quote, problem because they concentrated among mature men, job losers, and long-term unemployed. The changes that the paper noted were generally reversed once the baby boom grew up. A paper in the following year diagnosed an outward shift of the Beveridge curve, which accounts for higher average unemployment. And the Beveridge curve came in and remains a tool that is widely used in this general approach to unemployment. Also in the framework of the Beveridge curve found a disproportionate source of volatility of unemployment and vacancies was an aggregate activity shock. And the opposite view of reallocation shocks have never been found to have an important role. A Brookings paper in 1990 showed that recessions achieved most of their employment decline from major cuts in some firms rather than diminished flows of hires. A paper in 2014 made a key contribution to research in labor dynamics. It found that the probability that a job seeker finds a job in the coming months is not really indicative of a job finding success. Job finding rates seriously overstate the probability of finding a stable job. A paper in 2011 studied administrative data on workers who lost jobs where they had substantial tenure. It found job losers for many years. It followed job losers for many years as they recovered from the adverse effects of job loss. The results show that the displacement for a job that has proven durable results typically in a year or two of depressed employment, presumably a number of spells of unemployment or time out of the labor force, followed by lower wage rates for many years. That's a very widely cited paper today. Outside the search and matching framework, a paper in 1973 qualified the gains and losses from reductions in unemployment. It provided a comprehensive analysis of the differences in the economy between 4 and 5% unemployment. I would nominate that as the least appreciated important paper in the history of the Brookings papers. It occurred at quite an early stage of the panel's existence. A related paper in 1973 on the benefits of a low unemployment economy appeared in the same issue of the BPEA. Noted that unemployment is merely the tip of an iceberg that forms in a cold economy. You can guess who wrote that. A paper in 1999 provided a retrospective discussion of the tight labor market of the 1990s, written at a time when the labor market conditions were similar to those of 2019, that is 3.5% unemployment. A paper in 2006 contained a comprehensive review of data on labor force participation. And we're looking forward to a repetition of that, given the importance of recent changes in participation. In 2014, a follow-up Brookings paper showed that the forecast published in 2006 proved to be quite accurate for 2014, despite the upheaval in the labor market from the financial crisis and deep recession of the intervening years. This finding confirms that the decline in participation over that period was not the result of a slack labor market, but rather represented the realization of forces in place before the Great Recession. A recent Brookings paper in 2020 studied the super tight labor market of 2019 in a framework that recognized heterogeneity among the unemployed and other job seekers. The paper concluded that the apparatus underlying the search and matching model performs reliably even at unemployment rates under 4% once composition effects are taken into account. Last but conspicuously not least was the explosion of unemployment in April 2020, as you can see in the picture that's showing, from the pandemic. The Brookings panel swung into immediate action, scheduled a special meeting on the macroeconomics of the pandemic in June of 2020. One paper documented the huge 21% decline in employment that occurred at the March and April of 2020, especially April, as the economy shut down. It also showed that the recalls of workers on temporary layoff occurred in May, anticipating the sudden imports of layoff recall. And those only recently, those effects are disappearing. That process dominated labor market dynamics in the later months of the pandemic. The second paper studied a variety of high-frequency data sources to demonstrate the concentration of reduced hours of work in the retail and hospitality sectors. The authors found that the vast majority of laid-off workers expected to be recalled, and some had already been recalled by June. The regular September 2020 meeting of the panel included a detailed structural model of the pandemic labor market. It's the most advanced state-of-the-art implementation of DMP ideas, I would point out especially. The paper emphasizes the importance of treating unemployed workers who expect to be recalled differently from those who have definitely lost jobs. That's a topic that I've worked on as well. Do I have any more time?
You should be wrapping it up, Bob.
Okay. I was going to say more, but I should probably skip it about other labor topics, but it would be, I'll just skip over that. Okay, so concluding remarks. Prior to the panel's founding in 1970, the Brookings Institution's main involvement in macroeconomics was the sponsorship of and funding of the Brookings model of the US economy. The panel's founders, Art Okun and George Perry, believed that macro advances a science if we attack the subject in chunks, issue by issue and event by event. The founding motto of the panel, this has probably been forgotten, but the founding motto of the panel was no big models, and none has ever appeared in the pages of the papers. I hardly need to say how much I agreed with that motto. It's what attracted me and it kept me as a participant in the panel. In that respect, the Brookings panel was a complete innovation. Nothing like it existed in macro or in any other branch of economics. I congratulate the designers of the Brookings panel on economic activity for a remarkable and durable achievement. Thank you.
Thank you, Bob. The next speaker will be Bob Gordon on productivity and growth over the years at BPEA, to which he has contributed much. It's like Bob Hall has to the labor market piece.
I'm going to talk about productivity and growth over the years at BPEA. The first of the two topics is U.S. labor productivity growth. It's always been a prime topic. In the early 70s, there were two papers asking why labor productivity growth slowed after 1965. In the early 2000s, there were two more papers asking why productivity growth revived after 1995. More recently, in the last half of the 50 years, there have been a number of papers about what may be definitely is a more important issue, and that is the divergence in outcomes between rich and poor countries. Why haven't the poor countries converged? What are the secrets of growth? Is there an empirical strategy to reveal those secrets? Now, in looking at past papers, I'm going to take two of the very early papers to give a flavor of the early BPEA. And then, based on Google Scholar citations, I'm going to look at three more papers on US productivity, and then three papers on more broad-based world growth issues. It's very striking to look at average citations per paper over the decades. We started out with a relatively low 227 per paper in the 1970s, and by the 1990s, we had the astounding figure of over 1,000 citations per paper, falling back somewhat in the 2000s and the 2010s. I think in the 2010s, it's just partly because the papers are still young and still have many citations to come. Why were the citations so low in the 1970s? I'd like to go beyond Bob Hall's comments about the early vision of BPEA. While there was no big macro model, those of us who were asked to join the panel were thought to be proprietors of an equation of a model, and we would provide not only periodic papers, but also short sector reports about the current status of our particular part of the economy. And I think if you took away all those sector reports out of the denominator, citations of Brookings papers in the 70s would be much higher. About the short run orientation of the panel in those early days, quoting from volume 1, number 1, page 1, particular attention is devoted to recent and current economic developments that are directly relevant to the contemporary scene. That's not a description of the Brookings panel papers as it evolved in the 1990s and 2000s. Some more about citations. The top paper had 7,500 citations. If you look at the top 20 out of a total of 650 papers, the top 3%, the cutoff to make the top 20 was 1,239 citations per paper. Mean citations per paper were 250, median were 103, and that leads to the question, are Brookings paper citations more or less equal or unequal than the US distribution of income? So here is the US distribution of income versus BPEA paper citations. The top 0.1%, 9% of the income versus 5% of the citations, a little more equal or likewise in the top 1%, 20% of the income is accounted for by the top 1% of earners, 15% of the BPEA citations. And then if you look at the top 10%, BPEA citations account, the top 10% account for 51% of the citations. So I conclude from all this that inequality is a natural outcome of human endeavor. Now, looking back to the early 70s papers, we had one by George Perry in 1971 and one by Bill Nordhaus in 1972. Both sought to explain the first stage of the productivity growth slowdown. Their data referred to the total economy, not non-farm private business. The total economy, as I measure it, averaged 2.8% over the 50 years from 1920 to 1970. And in the early days of BPEA, it was accepted that 3% productivity growth in the US economy was normal. Remember those old Kennedy-Johnson wage price guideposts that had a 3.2% criterion for the okay growth of real wages. But by 1971, the evidence of a post-1965 slowdown was there. And here is annual productivity growth at selected intervals that I've chosen to correspond to the efforts made in Brookings to understand it. In particular, the top bar, the green bar, shows productivity growth per year through 1965, followed by the next 5 years, which show a marked slowdown into the brown area, but not nearly as much of a slowdown as appeared in the data at that time in the Nordhaus and Perry papers. Then we had 25 years of slow productivity growth marked by more brown bars. I broke it at 1980 because both the two early papers made predictions for the decade of the 1970s. We'll come back to this chart and talk about what happened after 1995 a little bit later. George Perry's paper highlighted the drop in productivity growth from 3.4% pre-1955 to 1.6% after 1965. He pioneered the analysis of the changing age-sex mix, in particular, a growing share of women and teenagers who were assumed by their lower real wages to have lower productivity. And he was able to explain 0.4 of his 1.8% drop with this change in age-sex mix. 1970 was a bad year for productivity, and so another 0.7 of his drop was explained by the cyclical effect, and the remaining 0.7 was unexplained. Perry went into projection, looking out over the decade, then the future decade of the 1970s. Since the age-sex mix didn't seem to matter for much, he projected a fairly healthy growth in potential output of 4.3 and productivity of 2.9. In today's data, if we look back at the same period, 1970 to 1980, potential GDP grew at only 3.2. And from my graph, productivity output per hour grew at only half of Perry's prediction of 1.4. So there was really something more serious going on than the age-sex mix. Bill Nordhaus followed a year later. In his data, because he went on to 1971 and got rid of some of that recession effect, he had to explain 1.2%. He rejected the age-sex adjustment as reflecting discrimination against women, and instead explained most of his decline as due to a changing mix of industries toward those with a lower level of productivity. Bob Solow was the discussant of both papers and suggested that their explanations were compatible because the industries with the growing share of industry output were also those which had a high share of women and teenage workers. Bill Nordhaus also made a forecast. He predicted 2.1% productivity growth in his data, and the actual for his period is a little more than half that, 1.2%. Now moving on to the later productivity papers, the one that Martin Bailey and I wrote in 1988 also tried to explain the slowdown pre and post 1973 in our case, and that was 1.6% that we tried to explain. Measurement issues was in the title and was most of the paper, and we found that maybe a third of the slowdown could be explained by measurement issues. Most measurement problems were equally valid before and after 1973, but we focused on Perry's age-sex composition, and there were other interesting labor quality issues, including a decline in test scores that we focused on. About computer power, we emphasized that advances in finance and communications had productivity gains that should be credited to the computer producing part of durable manufacturing. But our conclusion was that most of the slowdown was real. And I'd like to quote from that paper because I think it echoes in what you may have heard more recently. Quote, "The impetus to productivity advance in the early post-war years, perhaps a backlog of innovations and investment opportunities delayed by depression and war, followed after the mid-1960s by depletion of opportunities." So this diminishing returns idea was present even 32 years ago in that early Brookings paper. Now to the post-1995 revival, Bill Nordhaus returned again with a very highly cited paper called Productivity Growth in the New Economy. He developed a new income side industry database and distinguished between the pure productivity effect that one gets with constant output shares and the Baumol effect that would bring down productivity by a shift into the low productivity service sectors. He found zero Baumol effect for the period after 1977. His headline result was that the post-1995 revival, contrary to most contemporary research, was not primarily due to ICT, information and communication technology, but rather only a 13% contribution to the post-1995 revival in the non-farm private business sector. Why was there this discrepancy with other authors? The discussants pointed out that Nordhaus had only counted the contribution of ICT producing industries, not the ICT using industries. And the current consensus is that you got to combine the ICT production and the use of ICT throughout the economy to explain the post-1995 revival, which looks like this. If you look at the green bar that's labeled 1995 to 2004, we had a pickup from the previous 25 years of roughly 1.1%. And then a slowdown back into the brown area after 2004 to 2010. And then the red area, the very serious productivity slowdown of the most recent 9 years, leaving aside 2020, which is a very different story. The last of the productivity papers I'll discuss was by Eric Brynjolfsson and two co-authors trying to make sense of this ICT effect. They studied hundreds of computer-using firms over 11 years. And this was an example of BPEA's increasing receptivity to micro-oriented papers. They showed that the effectiveness of ICT on productivity depends on business organization and practices, by which they meant the use of teams, individual decision-making authority, broadly defined work definitions, investment in skills and education. And their headline result was that firm market value responds much more to computer capital than to other types of capital, with an amazing coefficient of $15 of market value produced by each $1 of computer capital. And despite the work that they did on organizational capital, in their regressions, it didn't seem to contribute much. There was a lot of concern, both by the authors and the discussants, of reverse feedback, that the high marginal value firms had high value for other reasons and had a lot of money to buy computers. And the paper and the discussants focused on an example of a successful ICT using firm, Walmart, which had pioneered the big box store format and had applied computers successfully to the redesign of its supply chain. But now let's get to the really important issues of long-term growth. BPEA began to pay considerable attention to this in the 1990s. And that's one reason why the average citations are so high. Remember Robert Lucas's famous quote that once one starts to think about the difference between the rich and the poor countries, it's hard to think of anything else. Traditional production functions, building off the Solow model, would have output Y as a function of multi-factor productivity A, and then capital, human capital, and labor. I like to tell students that it's much more useful to think of a broader production function in which we have an autonomous growth factor, MFP factor, that depends on technology, geography, and political institutions, and all sorts of institutions. And then the function of K, H, and N is augmented by R, which is infrastructure, particularly electricity and telephones. A really highly cited overview paper was Greg Mankiw's 1995 paper on the growth of nations, asking why some nations were so rich and others so poor. Beginning with the failures of the Solow growth model, based only on physical capital, predicted much too small differences between the rich and the poor, predicted faster convergence, and in particular, predicted very large differences with much higher marginal products of physical capital in the poor countries. The difficulties faded away, adding human capital and raising capital share from 1/3 to 2/3, but that wasn't enough. Mankiw was skeptical of endogenous growth models, which were hard to check with international data and didn't explain fast growth in East Asia, where capital and human capital were more important. And Greg spent quite a bit of time criticizing cross-country regressions for simultaneity, the fact that many of the right-hand side variables were caused by growth, multicollinearity, low degrees of freedom, a few years of investigation with many variables. And the conclusion was there just had not been enough progress on why saving and investment were so high in some countries and so low in others. Jeff Sachs and David Bloom downplayed macro policy, market liberalization, and institutions in their paper on geography and demography in Africa in 1998. Their geographic focus was on the heat and humidity and infectious diseases in Africa, the lack of a monsoon, frequent droughts, and the result all this had in deterring foreign investment and settlement. Topography was a problem with the lack of deep harbors and navigable rivers in many countries. Some countries were landlocked with high transportation costs. And so isolation was a major cause of slow growth. Demography was an issue with high fertility, due in part to social norms and a lack of education. And the high fertility led to a high ratio of dependent youth that didn't save or invest much. So we had a lack of saving and investment. The conclusion was that about 2/3 of the growth deficit in Africa was due to these geographic and demographic factors, with much less due to institutions. And they highlighted that Africa was the only place over the 15 years prior to their writing where there was negative growth in real net exports. They had some policy conclusions, but I wanted to highlight that the discussants strongly disagreed with their de-emphasis on institutions. Discussants pointed to civil wars, dictatorships, the high political risk of appropriation, poor information, lack of telephone service, and electricity. The last paper, getting back to the hometown of Brookings with Barry Bosworth and Susan Collins, was a very widely cited overview paper on the empirics of growth, contrasting growth accounting versus regressions, with differing conclusions coming in many cases from the choice whether to measure the capital input directly as capital or as indirectly from flows of investment. There were also different results of human capital, reflecting the difficulty of measuring the quality of education. They constructed a new data set with 84 countries over 40 years, from 1960 to 2000, improved measurement in a number of areas. And their results showed an increased emphasis on physical capital and less emphasis on human capital, due again to problems of measuring educational quality. Things they found strongly correlated with growth were initial life expectancy and those political institution variables that the discussants thought were important in the discussion of the Sachs-Bloom paper: law and order, absence of corruption, protection of property rights. But there were also negative results in the Bosworth-Collins paper: no role for macro policy or openness to trade, and no explanation of why growth slowed after 1980. So just to conclude, for US productivity, the early 1970 to 1995 slowdown, the early paper showed only a limited role for the age-sex composition or industry composition. Most important were diminishing returns to the great inventions of the earlier industrial revolutions. The 1995 to 2004 revival, most people seem to agree that the importance of ICT production and use was important up to 2000, but then ICT investment collapsed. And so you need a different kind of explanation based on delayed changes in business operations. The post-2010 slowdown remains unexplained, but I do want to remind you that we had a very good measurement paper in 2016 by Byrne, Fernald, and Reinsdorf that poo-pooed a overall explanation based on measurement. For rich and poor countries, in the articles I surveyed, there was no convincing explanation of why overall worldwide growth slowed post-1980 or revived after 2000. And it did revive even to some extent in Africa. And there are remaining puzzles that this literature has not satisfactorily solved. involving the huge success of East Asia, the partial success of South Asia relative to many other places around the world. So there are plenty of remaining puzzles for the next 50 years. Thanks.
Great. Bob, thanks very much. The final panelist is Alan Blinder, talking about BPEA's contributions to monetary policy research.
Okay, let me get my slides up here. Okay, can you hear me and see the slides?
Yes, we can.
Okay, very good. So my assignment was to talk about monetary policy, which if you interpret it broadly could be almost anything. As you'll see in a moment, I decided to focus on three aspects. This first slide is just to show you how much Brookings has changed.
We lost your slides, Alan.
You lost my slides.
Gordon's slides.
You still have Gordon's slides up there? Hold on.
No, no, we just have the gallery.
All right.
I have to just share them again.
Wait a second, I might not have shared it. I'm sorry. You know, this is the old guys panel here. We sometimes.
Okay, you got it, Alan.
There we go.
You're there.
I've got it now. Okay, so as I was saying, well, you couldn't see it. This is showing you the huge changes at Brookings over 5 years, 50 years, sorry. I think it's important for what I want to say here that you remember roughly what macroeconomics was like in 1970 when the panel began. This could have been a very long list, but I just want to highlight that loose theory was much more tolerated then. It wasn't like people didn't believe in micro foundations, but it hadn't been raised to the level of a religion. And I think a lot of what goes in DSGE models now would not have been of interest to a lot of macroeconomists in 1970. Among those is something Bob Hall mentioned, that giant macro models rolled in the earth back in those Neolithic days. One of them had a home at Brookings, as Bob mentioned. And something that's often forgotten and maybe best forgotten, but I will spend a couple of minutes on it because it was important in the early days of BPEA. The Keynesian monetarist wars were at their height, really, around 1970. I don't know exactly where to date the height, but they were big deals in 1970 with just giants, not giant dinosaurs, but giants like Milton Friedman and Paul Samuelson in the forefront of those battles. So that was the way things were sort of in 1970 when these two gentlemen, Art Oken and George Perry, assembled what I'm calling here the whiz kids to constitute the first Brookings panel. And this is not the full list, but this is the young ones. And I just want to emphasize how young they were. The old man of the group was Bill Poole, who was 33, Branson, Gordon, Bosworth, Hall, who was 27. This was a very young, smart group with all whose names started with a B. I'm not sure that was important to Art and George in picking them, but this was quite a good group. All of them are blissfully still with us today, except for my colleague Bill Branson, who died far too young. I want to make an important demographic point that I'm younger than all of these guys. So this is the old man's panel, but Gordon and Hall are older than I am. So that's for the record. So as I said, monetary policy could encompass almost anything you could think of, including search theory and unemployment and so on. I want to concentrate, because of its importance in the Brookings papers and in the way monetary policy is done in general, on Phillips curves. I'll spend a few minutes, because of its great importance, now forgotten in the early days of BPEA, on the monetarist Keynesian debate, and then spend more time on papers that offered ideas for monetary policy or evaluations of monetary policy. Generally, that was US monetary policy. So those are my three topics. So since a lot of people listening here are younger than Hall, Gordon, and Blinder, I thought I would show you first. This is Phillips, and this is the Phillips curve. This is the original Phillips curve from Economica 1958. It probably looks familiar to you. In the early days when BPEA started, before and when BPEA started, Phillips curves were usually written as the change of nominal, in percentage change of nominal wages on the left-hand side. Something like, and maybe exactly like, a distributed lag on past inflation rates, interpreted as a proxy for expected inflation. A nonlinear function of the unemployment rate. As you see, nonlinearity was important to Phillips, but became less important as the years went by. And a stochastic error. And in the early days, there was a strong empirical consensus that the sum of these alpha coefficients, which you could think of as just the coefficient of expected inflation, or was thought of that way, I should say, was less than 1. So for Phillips, it was 0 by constraint. Phillips actually mentioned this in his original paper and said it's probably not important. Inflation is probably not important. Richard Lipsey, who was a colleague of Phillips at the LSE at the time, didn't buy that, used more conventional econometric methods, and estimated an alpha of 0.76. In the very first Brookings paper, Bob Gordon, whose name you will see on many of these slides, estimated an alpha of 0.45. So there we were. I said I was too young at the time. I was in graduate school at the time. And the consensus at that time, at least at MIT, where I was in graduate school, is that Friedman and Phelps seemed exactly right, that alpha, the summation of alpha, if that was expected inflation, should be 1. But the empirics were against that. The empirics showed less than 1. And that was a major Phillips curve puzzle of the day when BPEA started. Bob Gordon already in 1972 sort of solved the problem, cheating slightly, with a nonlinear alpha. And if you plugged in the numbers, that alpha, which depended on the inflation rate, got to 1 at roughly 7% inflation, which was a high inflation rate in those days, but not a crazily high inflation rate as it would seem now. Anybody talks about 7% inflation, you wonder what they're drinking. Then supply shocks started to hit, really starting in 72, but mainly in 73, 4. And that, of course, threw the first generation Phillips curves way off. They didn't have supply shock variables. But Brookings ran into the breach very quickly with a bunch of papers mentioned in my paper. I'm not going to tick them all off here, about the supply shocks of 73, 74, food shocks and oil shocks. Barry Bosworth wrote one of them. In 1975, Bob Gordon's version of the Phillips curve had both the supply shocks and an alpha of approximately 1, coefficient on supposedly expected inflation. And I remember distinctly, writing this survey made me remember it even more. Bill Nordhaus, I'm not sure if Bill is on this Zoom, was the discussant of Gordon's paper, and he referred to it as Chateau Gordon 75. There had, of course, been Chateau Gordon 70, 72, 73, 74, and so on. But this is an important paper because it had the two critical ingredients that were missing from early generation Phillips curves. And that, of course, has profound implications for monetary policy. These papers, along with some by Perry and Schultz and Nordhaus and others, led to many years, which you've heard in one form or another. At one of extra, it beats down the inflation rate by 0.5 point. That worked very well for many years, but doesn't work so well these days, as you know. Then the Phillips curve started to vanish. We didn't quite realize it in the 1990s, But there was a big question addressed by Bob Gordon in the 98 BPEA paper about why didn't the very low unemployment rates that we had had of late push the inflation rate up more. It didn't actually push the inflation rate up at all. So that was the first hint that things were going wrong with the Phillips curve. The next big hint, also addressed in BPEA, was why didn't the Great Recession pull the inflation rate down more? We had tremendously high unemployment for a long time, and inflation did come down a little, but not very much. And that was addressed by a number of BPEA papers, including one by Kruger, Kramer, and Cho in 2014. The third question on the vanishing Phillips curve is what in the world happened? So it turned out not to be just a question of what was funny in the late 90s that inflation didn't go up more, or what was funny during the Great Recession that inflation didn't go down more. It's that through this century, the 21st century, we haven't had a Phillips curve. And this, as all of you, I'm sure, on this Zoom know, is still an unanswered question, though a number of people have taken some shots at it. And I, for one, eagerly await Chateau Gordon 2022, which will give us the answer to this. So Bob can get to work on this right after today's panel. Second topic I said I was going to take up briefly is monetary growth and monetarism. The originators of the panel, Art Oken and George Perry, took it, it seemed, as part of their mission to remove the scourge of monetarism from the earth. And there was a lot in the Brookings papers, some of it pushed in by Oken and Perry, including a little piece in a paper Steve Goldfeld and I wrote, but in many, many other places. Pulling the empirical rug out from under monetarism. One irony here is that Bill Poole was original member of the panel. Poole was a monetarist, and it was his QJE paper that actually, it turned out, laid the set the stage for the intellectual destruction of monetarism when so-called LM curves became the whole ball game, and that, according to Poole's analysis and many papers that followed Poole, meant that you should be targeting interest rates, not the money supply. I want to point out an historical irony here, that monetarism had its ascendancy on what I believe was the false accusation that Keynesianism was inherently inflationary. So the monetarists blamed the rising inflation on Keynesian attitudes and Keynesian policies. Rightly or wrongly, I just said I think it was wrongly, but rightly or wrongly, that contributed to the rise of monetarism, both in intellectual circles and in policy circles. But then monetarism fell because of this Poole, not because of Poole's analysis, but because the high inflation that we got spurred a lot of financial innovation, which in the Poole world translated into gigantic LM shocks. This is the period in which the Fed was trying and other central banks to come up with some monetary aggregate for which there was a stable demand, and they didn't succeed very much. Well, during the 70s and 80s, there were a whole host of papers listed in my paper on the question of money demand and financial innovation. The most famous one, I think, is Steve Goldfeld's The Case of the Missing Money, but there were many. As I was looking at these, I noticed that I was the discussant for a paper by Tom Simpson of the Federal Reserve in 1984. And I usually hate quoting myself, but it seems very apropos here. I wrote in that discussion that an intelligent brief about, remember, this was coming from a Fed staffer, an intelligent brief about why the Federal Reserve should not have done what it did during the Volcker monetarist period. And Bill Poole was constantly there. As I said, you can see a list of Bill Poole's papers in my paper. He was overworked by Oken and Perry, but I think never convinced that he should denigrate monetarism. Bill is probably not on this Zoom, but if you are, Bill, That was an enormously impressive amount of work. All right, my third topic, advice for monetary policymakers. And I just put this up here to, especially for the younger members on this Zoom, to recognize the breadth in time and in intellectual development. Since Brookings started giving advice to Arthur Burns as chairman of the Fed in 1970, through all these other gentlemen and one lady, right up to Jay Powell today. Alan Greenspan, Ben Bernanke, Janet Yellen all attended the Brookings panel at one time or another. So starting with the first issue, John Carrican of the University of Minnesota advised the Fed that the economy may take one course if the FOMC uses the bill rate and the monetary aggregates, and another if it uses, the bill rate and another the monetary aggregates. This was the monetarist Keynesian debate. Don't worry, Jan, I'm almost finished. In the very next issue, Bill Poole, in one of those many papers he was called upon to produce, wrote that politicians and the informed public now clearly recognize that excessive zeal in fighting inflation will produce excessive unemployment. There's a plea for gradualism that I at least don't associate historically with monetarists, but that was Poole in the BPEA second issue. In 1972, Art Oken wrote a notable paper on the rules versus discretion debate 5 years before Kydland and Prescott, but of course a quarter century after Milton Friedman had first raised this issue for very different reasons than Kydland and Prescott's time inconsistency reasons. A short digression, because it still hasn't really got into the macroeconomic argot very much. The Kydland and Prescott, and then followed by Barrow, Gordon, and many others, models basically predicted that inflation would be too high because of the time inconsistency problem, not that it would rise for about 15 years and then fall starting in 1980. This is not a prediction of the Kydland-Prescott model or the Barrow-Gordon model by a long shot. Continuing on the early days, I found this, I didn't really remember it. There was a notable BPEA debate on monetarism versus Keynesianism between Jim Tobin, who may have been the leading Keynesian of the day, and Bill Poole, who was always being overworked by the Brookings panel. And I'd like to pause 6 seconds while you guess who the two discussants were. Nobody guessed, maybe Bob Gordon guessed. Aaron Gordon and Robert Gordon, father and son team. Not exactly, by the way, paired to be one monetarist and one Keynesian, I might say. But I thought there was poetry in this choice of discussants. The next year, Franco Modigliani and Lucas Papademos offered one of the earliest estimates of what they called the NAIRU, later corrected to NAIRU, in the 5-ish range. And interestingly, in that paper, they said, monetary policy should be aimed at explicitly stated targets for real output and employment, not nominal anchors. This is another indication of how things have changed. This is not about nominal anchors, this is about real anchors. Because he went on to bigger and better things, I think it's worth remembering that Ben Bernanke appeared in the BPEA 4 times with papers. I didn't look for discussions on the credit crunch back in '91, on oil shocks and monetary policy with Gertler and Watson in '97. When he was a Federal Reserve governor with 2 Federal Reserve staffers, Vince Reinhart and Brian Sack, on the lower bound issue. This is a well-cited paper. And then most recently on the real effects of disrupted credit during the financial crisis, something that he saw firsthand. Just a few other notable highlights, and then I'll wrap up. There was Paul Krugman's famous paper on the liquidity trap coming back. It's back, I forget, I think 3 A's is how he spelt it. A well-known paper by Egerton and Woodford on monetary policy at the lower bound, which led, apropos of what you heard from both Hall and Gordon, of BPEA things feeding into policy, to the lower for longer strategy that the Federal Reserve adopted under Janet Yellen's chairmanship. And in 2009, John Williams on why the 2% inflation target might be too low. Whoops, did I say John Williams? It was probably his evil twin, because the head of the Federal Reserve Bank of New York would have never said such a thing. Of course, he wasn't the head of the Federal Reserve Bank of New York at the time. Finally, there was a host of papers in the 20 teens on unconventional monetary policy, notably including one by the then recently former chair of the Fed, Janet Yellen, and maybe an equally notable paper by Eric Rosengren of the Boston Fed and others, which basically called for what became the Federal Reserve's review of its strategy, tools, and communications. If you were at BPEA that day, you heard it here first. So, summing up the BPEA's greatest hits: the development of empirical Phillips curves, which had its ups and downs, the demise of monetarism, which was final, a lot of sensible thinking and writing about supply shocks, more than you saw in most academic outlets, I think, and maybe a capstone of it all, keeping the Keynesian flame burning through several versions of the Dark Ages. So I join my two previous panelists in saying thank you, BPEA, for all your good work over the years.
Thank you, Alan. I think a lot of people in the room would join that thanks to the generations of research and work that's represented in all three presentations here. With the spirit of BPEA in mind, we're going to move right straight to the next paper, because fortunately, as Bob reminded us, there's still lots of work left to do. So we've worked through our break, so we'll go straight to the next paper on the economic costs of pretrial detention. So I see we have Will Doby, one of the authors here, and the discussants are making their way in. So I think we're ready to begin. So the next paper is called The Economic Costs of Pretrial Detention by Will Doby and Crystal Yang.
Well, thank you so much for having me. It's a pleasure to be here today, and thank you to the discussants in advance for the really thoughtful comments that they included. So today, I want to talk about the economic costs of pretrial detention and why we think that pretrial detention and more generally the criminal justice system might have important macroeconomic implications. Now, just at a very high level, the reason this might be interesting at the macro level is that even though the United States only has about 5% of the world's population, we have roughly 25% of its prison population. And the costs of mass incarceration are likely, therefore, potentially significant. An estimated 8% of all of the adult population and 33% of the Black male population have a felony conviction. So to the extent that we think these convictions matter for people's labor market outcomes and their human capital, the numbers become very large very quickly. Now, the part of the criminal justice system that we're going to focus on is the pretrial or bail system. We'll explain why we think that's so important, but in short, it impacts all of the 10 million individuals that are arrested each year. This is typically one of the first interactions that people have with the criminal justice system. And there's a lot of work suggesting that it's a particularly important decision point where the decisions we make at this point can have very important ramifications for years afterwards. So just a very brief review of the pretrial system, because I know not a lot of people in the audience will necessarily be familiar with it. In the US criminal justice system, you're usually arrested for a crime. You have to presumably commit a crime if you're guilty, but you have to be under suspicion, you're arrested. And then within a couple hours or a day or two, usually charges will be filed. 24 to 48 hours after charges being filed, there then will be a bail or arraignment hearing. And this is the step in the process that we're going to focus on, is what happens at this bail hearing. Now, at the bail hearing, a bail judge will make a decision about whether you should be detained outright, whether you should be released with no conditions, or whether you should only be released with some form of monetary conditions. Now, often those monetary conditions are such that people are detained anyway. So in the data we have, roughly 50% of people where there's monetary bail set are unable to pay it or choose not to pay it and end up being detained for up to months at a time before they're ever convicted of a crime. Now, regardless of whether you're released or detained, you then proceed through the criminal justice system. So you would then be arraigned. You could either go to trial or plead guilty to the charge, and then you would ultimately be sentenced after a finding. Now, by law, that pretrial or bail system is meant to accomplish three potentially conflicting goals. So the first is that it's meant to release almost all defendants before trial under reasonable conditions. So the US, like most countries, has a presumption of innocence. So we're not supposed to be punishing people at this stage. The sole determinant of when we should detain people is that we ensure that people are going to appear at all court proceedings afterwards. We want to make sure that people actually show up and have their day in court. And in many jurisdictions, we want to protect the public by preventing new crime, particularly serious crimes. Now, in practice, despite the fact that it's very clear what the bail system is meant to do, there's a very heated debate on whether the system works in practice. Now, what works can mean different things to different people, but generally the critics of the bail system would say that pretrial detention seems to be the result of poverty, not guilt. So we see incredibly high detention rates among low-income individuals, particularly when bail amounts are very, very small. So even when people only need to pay, say, $50 to be released from jail, they seem to have a very hard time doing that. In addition, there's widespread claims that detention can disrupt employment for those already on the margin. So this can just be a literal direct effect where you're not able to show up to work and you're then fired. Or it could be that eventually there are knock-on effects on the probability of pleading guilty or being convicted, and this can lead to stigma effects that will also make it hard to hold or get a new job. The other issue that people point to in the bail system is that we have significantly higher detention rates for minority defendants, even when we control for rich sets of observable characteristics. So this mirrors many other aspects of the criminal justice system where minority defendants seem to be treated very, very differently than white defendants. Now, as a result of these observations in this debate, many jurisdictions are currently reforming their bail systems or are looking to reform their bail system. And those reforms take many different forms. So some of them are focused on risk-based assessment tools to limit judicial discretion and try to scale back the number of people being detained. Others are focusing on alternatives to bail, like electronic monitoring or supervised release. And finally, many are trying to get rid of bail altogether, either through the legislature or just through community organizations that actually post bail for defendants. So many large cities at this point have organizations that will raise money and are attempting to bail out all low-level individuals charged with low-level crimes. Now, why do we think the pretrial system is going to affect economic outcomes? Why are we talking at Brookings? The first main reason is just simply that there's an overwhelming number of stories about how disruptive the pretrial process is. So this is one quote from a defense attorney speaking in the New York Times, but it's very representative of the stories you hear about how clients who are working in service level positions, if they miss a day of work, they're fired. And then you have that, you have a hard time getting another job, and you also have that on your record. In addition, if you live in shelters, if you miss your curfew, you can lose your housing. And of course, if you have immigration concerns, pretrial detention can also factor into that and potentially lead to deportation, though that tends not to be a factor in some parts of the country compared to others. But the larger point is that when clients have bail set, they have enormous worries about what's happening on the outside. In addition, there tends to be considerable strain on families. So families, one, they're trying to raise the financial resources to pay for pretrial detention, but it also just creates a large emotional strain on everyone kind of involved, from siblings to spouses to children. Now, if we tried to model that, I think there's two different ways that we could think about pretrial detention affecting economic outcomes. The first would be these direct partial equilibrium effects of just what happens for the detained individuals directly. And this would be the idea that there are short-run incapacitation effects that result in immediate job loss, as well as the longer-run destabilizing effects from lower labor demand through the stigma effect. So we show in some of our other work that when you're detained before trial, it seems to really increase the probability that you plead guilty to charges. Much of this is happening from a worsened negotiating position with the prosecuting attorney. Now, the second set of effects that we might be worried about are spillover effects on family members, friends, and the community at large. So this, we're conceptualizing this primarily as negative spillover effects, that by detaining large numbers of individuals from a community, that can be incredibly disruptive and lead to worse economic outcomes for entire groups of people. As well, you might think that there are intergenerational effects, given that just over half of defendants actually have children under the age of 18. So these are not individuals who are necessarily single or very young. These are individuals that have children, and this can be, again, destabilizing to those children as well. And so the broader point is, while most of this talk is going to focus on these partial equilibrium estimates, because that's where our evidence is strongest, I think there are good reasons to think that that's going to understate the economic importance of the pretrial system. Now, in the interest of time, I'm only going to briefly talk about the national trends in pretrial detention, just to give you a sense of kind of what's happening at the national landscape and why the reform efforts are gathering steam given these trends. This is coming from our best available data on bail. So this comes from a representative sample from 40 of the 75 most populous counties. And then you can weight the data to be representative of all those counties. And broadly, what we see is that the detention rate has been slowly increasing over time, certainly through 2005, and that now roughly 40% of felony defendants who are charged in these large counties end up being detained before trial. That tends to be driven by Black defendants who have rates of detention that largely mirror those overall trends, while we see much lower rates of detention for white defendants. Again, this is something that we see in the vast majority of jurisdictions. These are raw numbers, but those same gaps will tend to show up even when we control for a very rich set of observable characteristics. There's a little bit of a decrease at the end of the sample period. Unfortunately, we don't know what's happening in more recent periods, but the little bit of data that we have suggests that detention rates have generally been increasing again. Let me get to the causal estimates and talk about why we think there may be such important economic effects of pretrial detention. So our best evidence to date comes from work that I did with my co-authors Jacob Golden at the Stanford Law School and Crystal Yang at Harvard Law School. And in this paper, we focus on the best available causal evidence of what we can learn from what's called a judge IV design. So what we do here is we exploit the fact that in many bail systems, defendants are randomly assigned to different judges in the system. Now, what is useful from a researcher's point of view is that some of these judges are very strict and detain a large number of defendants, while other judges are very lenient and release a large number of defendants. And so what we can do is track defendants through the system and understand if there are economic consequences of being assigned to the strict versus the lenient judge. We can then scale those estimates by the difference in the probability of detention to have a sense of how costly pretrial detention is on your later outcomes. So what do we find? If you look 3 to 4 years after an individual's arrest, so long after they've been released on any particular charge, individuals who are detained are about 9.4 percentage points less likely to have any formal sector employment. You'll note that the mean is quite low. So that's saying that this is a population that generally has pretty low employment, but it's much, much lower after they've been detained, even after a considerable length of time. Now, linked with that, people are also less likely to get social insurance benefits that are linked to employment. So they're less likely to have any unemployment insurance during our sample period, and much less likely to have any earned income tax credit earnings during our sample period. And again, this is tightly linked to the fact that they no longer have formal sector earnings, and so they're not filing tax returns, and they're just not able to access these benefits. Now, while our standard errors get pretty large when we start looking at continuous outcomes, it can be useful to say, well, what does this mean in terms of actual earnings? And what would this be in terms of the net present value if we're willing to make assumptions about what these effects would be over time? So our best estimates, taking the point estimates perhaps overly seriously, is that this would lead to just under $20,000 in lost formal sector earnings over someone's lifetime, as well as about another $10,000 in lost unemployment insurance and earned income tax credit over their lifetime. So again, I do want to caution that standard errors are what they are here. So, we want to be a little bit cautious with taking these numbers overly seriously. But the idea is that the magnitudes are quite large, and they really back up with our more precise binary estimates based on any employment first done. Now, what do those numbers mean? I mean, what does a 9.4 percentage point decrease mean, or roughly $29,000 in lost earnings and social insurance receipt mean for individuals if we kind of zoomed out and thought of these broad macro reforms that people are considering in the pretrial space? Well, one of the more ambitious reforms under consideration is the elimination of money bail, which our best estimate is that would likely reduce detention rates from around 40% where they are now to approximately 10%. Now, this is very much a guess. We don't know exactly how much judges will offset the loss of monetary bail by detaining more individuals, but I think this is a reasonable guess of where we might end up with overall detention rates. Now, if you take those partial equilibrium estimates seriously from our judge work, that would suggest that a reduction in pretrial detention would increase aggregate income by about $80 billion per year. So obviously a really large number. And those increases are going to be concentrated in low income and minority communities. So communities where income is already particularly low. Now, that's what we know for sure. I think a natural question is whether there is also a relationship between changes in detention and changes in economic outcomes in the aggregate data. Now, I should preface this by saying, we're now moving into less convincing empirical designs. And so we're not suggesting that these estimates should supersede the IV designs, but rather that they're a confirmation of what we're seeing. And they'll help give us a sense of, are the macro relationships that we might expect showing up in the data? So in the absence of really convincing empirical design, we're going to look at changes in detention rate on the x-axis and changes in different outcomes on the y-axis, where we start with the poverty rate in different demographic groups. So we're looking at changes over the 2000 to 2009, 2010 period, because that's where our data is best. And for that time period, we have information from 24 counties. So this is just the raw correlation between those changes, where we weight each cell by the number of individuals in that specific group in that specific county. And so what you can see here is that not only do we have significant variation in the amount of how detention rates have changed over time in these counties, those changes are very strongly correlated with changes in the poverty rate in the expected direction. And so again, I'm not going to belabor what the point estimates are. I wouldn't suggest taking the point estimates literally. I don't think that's the right way to interpret this evidence, but it's certainly consistent with our very well identified work on the partial equilibrium estimates. We also see a very similar relationship when we look at employment to population ratios. Again, there's a very strong negative relationship where areas that have increased their detention rate over time now have much lower employment to population ratios. Again, we are not suggesting that you take these point estimates literally. We don't think that's the right way to interpret this exercise, but we do think this is consistent with the idea that our well-identified estimates have macroeconomic implications. Now, if we were to take this overly seriously, which again, we're not suggesting that we do, the numbers are enormous. I think there's every reason to believe that these numbers are probably not the right numbers to use, and we'd rather rely on the IV estimates. But again, they're very much consistent with the idea that there are very large and serious consequences of pretrial detention policies in this country. And as we have more punitive detention policies, we seem to also have worse economic outcomes, again, particularly in disadvantaged communities. Now, the last thing that we do is to start doing even more tentative exploration into what's happening to children. And so for here, we only have intergenerational mobility data for one set of cohorts. So we're not able to look at changes over time, but we can ask, were detention policies in 1990, when many of the children in our data were young, are those correlated with intergenerational mobility rates later in life? And so here we're leveraging the mobility data that came out of Raj Chetty's work at Opportunity Insights. So again, consistent with our argument, particularly for Black individuals, areas that have very high detention rates in 1990 also seem to have much lower mobility rates for those children later on in life. And again, standard errors are what they are. We're not making an overly strong claim of a causal relationship here, but certainly consistent with the idea that there are negative spillovers on the children. And so from our perspective, what really comes out of this work is that the well-identified micro results suggest really important consequences on individuals. And that seems to also show up on our macro data using the best available evidence we have. And so our results would certainly suggest that reducing the scope of the pretrial system would likely generate significant economic returns. And hopefully with work moving forward, we can have more convincing and more precise estimates of these macro effects, so we can really start to nail down exactly what these point estimates might be. But again, thank you for having me, and thank you in advance to both Conrad and Justin for the great comments.
Great. Thanks, Will. The first discussant is Conrad Miller.
Okay, hopefully I'm set up here. So thank you to the organizers for inviting me to participate in this event. It was a pleasure to read and really think about this paper by Will and Crystal, who at this point have written a series of, I think, very important papers on pretrial detention. For my comments, I'm going to focus on what I think this and related papers tell us about how labor markets work. Okay. So first, let me just summarize the labor market costs of pretrial detention as Will discussed. So for the marginal defendant, they find that pretrial detention decreases the probability of employment in the formal labor market by something like 25%. At the county level, the authors look at how changes in pretrial detention rates among defendants from 2000 to 2010 relate to changes in poverty and in employment rates among prime age adults in this sample of 24 counties, and find that a 10 percentage point increase in the detention rate is associated with a 1 to 2 percentage point decrease in the employment rate. Now, as Will outlined, there's a sense in which the estimated macro effects of pretrial detention appear to be substantially larger than the micro effects, subject to the caveats that Will mentioned. And this would, suggest potentially large negative spillovers. I think the other discussant, Justin Wolfer, is going to talk more about this point. But I think, the authors suggest these spillovers may be driven by parties related to the defendant, potentially family and friends who, for example, may bear the burden of additional financial and caretaking responsibilities. Now, the question I'm going to focus on is this. So why would pretrial detention affect defendants' labor market outcomes? And there are a few potential channels here. So first, this is obviously a disruptive life event, which might lead to immediate job loss or loss of housing. We might also think this experience of detention itself will have some criminogenic effects, perhaps leading to future criminal behavior. We also know from audit and correspondence studies that having a criminal record makes it significantly more difficult to find a job. And in particular, as Will alluded to, there are now quite a few recent papers that I think provide compelling evidence that actually just having a conviction on your record seems to have a negative effect on your labor market prospects, regardless of actually the nature or length of your punishment or your sentence. So, for example, in the prior work that Will described, they find that pretrial detention increases a defendant's probability of getting convicted without actually having that much effect on a defendant's total time incarcerated or their job stability in the immediate aftermath. And really, what they find suggests that the effects of pretrial detention on labor market outcomes in the median run are likely operating through this conviction effect, which is potential kind of signal or stigma effect, which has follow-on effects on a defendant's job prospects. Another paper in this vein is Mueller, Smith, and Schneppel, who study the criminal justice practice of diversion, where instead of getting a conviction on the record, defendants can avoid a conviction by successfully completing a probation sentence. And in their setting, the marginal defendants who have their case diverted don't actually get a reduced sentence. They're just less likely to have a conviction on their record. And similarly here, the authors find large labor market gains to actually having your case diverted. Finally, Egan, Doliak, and Harvey study misdemeanor arrests and whether prosecutors that are assigned to a defendant's case actually decide to file a court charge in the first place or decline to pursue that charge. And getting charged creates a criminal record in many cases and increases the chances of a conviction. But they find that for the minor offenses that they're studying, having a file charged is not actually going to, likely lead to dramatic changes, differences in these two groups in terms of the punishment they face, because most of the people that ultimately are charged aren't going to face a significant punishment. And again, the authors find that getting charged today actually increases a defendant's chance of getting arrested again in the future. And the likely channel is that getting charged initially is going to increase your probability of conviction on your record, which is going to have, again, downstream effects on your labor market outcomes. Whoa. Sorry about that. Okay. Now, I think at face value, these findings make total sense. Of course, getting a conviction on your record is going to make it harder to find a job. On the other hand, I think each study I mentioned intentionally is focusing on situations where getting convicted is essentially a coin flip, right? That's kind of by design in these research studies. So by design, these are all situations where seeing a conviction on someone's record actually doesn't tell you anything useful about the defendant themselves, arguably. So if a defendant from one of these studies applied for a job at your company, once you knew that what the applicant was arrested and charged for, actually knowing whether they were convicted or not actually doesn't tell you much about them, including how productive they would be as an employee. And this idea that the allocation of punishment in the criminal justice system can be quite arbitrary is not peculiar to these studies. So for example, even within a state, counties vary dramatically in how punitively they treat the same criminal case. Ben Fagenberg and I found in prior work that within the same state, there are pairs of counties where you can be 2 to 4 times more likely to get a jail or prison sentence if you're arrested in one county instead of another. So same conduct, but dramatically different outcomes depending on whether you're arrested. And more generally, there's growing evidence that the defendants that are more likely to be punished are often not the defendants that are more likely to commit an offense in the future. And so with all that in mind, it's actually not clear that conviction per se is a strong signal of how productive a potential employee will be, once you know other details of their case. So that actually, I think, creates a bit of a puzzle. Why are employers appearing to put so much weight on what seems to be, quite a coarse signal and perhaps not a very informative signal? Now, here's some direct evidence that employers indeed do take convictions themselves quite seriously. So these are data from a 2003 survey of California employers. And these employers are asked whether they would consider accepting an applicant with a felony conviction. And this figure also compares their answers for other applicant characteristics. So you'll notice here, 37% of these employers will say, definitely not, I'm not going to consider an applicant with any felony conviction. Also quite a high probability of people saying probably won't consider them. This is not exactly the survey question we would want to think about this, because we'd really want to know, well, how much does an employer care about a conviction versus a non-conviction? But still, I think this is highly suggestive that conviction per se is something that employers care about. So let's think about this. Why do employers screen on a conviction, including a marginal conviction? And here are the reasons that employers give in surveys for why they would be concerned about an applicant's criminal history. So one, in some cases, there are laws that are going to prevent those with certain convictions from working in specific occupations. So for example, employers in transportation, financial services, health services, those working with children, they're often going to face laws either at the federal or more local level that place restrictions on the criminal history of the people they can hire. So this is a case where, how marginal that conviction is actually maybe doesn't matter at all, in the sense that these laws define whether a conviction per se matters, regardless of how marginal it was. Employers also report that they're concerned about the perceived risk of negligent hiring lawsuits. So if an employee while on the job inflicts harm on a customer or another employee, employers can be sued for damages under the negligent hiring doctrine. At least if the harm that was if that harm was predictable given the worker's criminal history. So this is another case where marginality may not really matter, in the sense that the legal system is likely going to put additional weight on prior convictions, regardless of the circumstances of that conviction. Third, some employers will claim in surveys that they're concerned about customer preferences. So customers maybe won't want to have, they maybe don't want to interface with people who have a criminal record. Here, it's not clear how much marginality matters. It's not clear what customers would actually learn about an employee in the course of interacting with them, or what they'd care about. But finally, and what I'm going to focus on for the remainder of my time is, employers also use these convictions when they're screening for productivity, or how well an applicant is going to fit for a particular job. And in this case, it's pretty clear that an employer shouldn't really put an additional weight on a marginal conviction if they had the right contextual information about the charge characteristics. But in practice, employers may not actually be able to identify these marginal convictions. So why might that be? The simple answer is just that employers may be screening on this coarse signal whether someone has a conviction rather than a more refined approach, simply because it's just costly to make that distinction. So for one, it could just be gathering the data necessary to do this and interpreting that granular data. It may have these upfront costs. It may also be the case that employers actually need to learn from experience when they're trying to figure out what aspects of criminal history actually matter for predicting job performance. And so this is an environment where biased beliefs and misperceptions can persist over time, because what's going to happen is some employers are never going to hire applicants with any kind of conviction. And that means they may never learn whether having conviction actually matters for predicting whether someone's going to perform well in the job. Now, with these costs to more refined screening, it may only be worth it to employers to kind of figure out how to do this more refined screening when there's actually a large share of their applicant pool that has any sort of arrest history. And if you think about it, this would actually potentially lead to a spillover effect going the opposite direction of what the suggestive evidence will present implied. So if you think about it, if 1% of my applicant pool has a criminal conviction, maybe it's a perfectly adequate hiring strategy to just ignore all those applicants. But if that is increasing to say 25% of my applicant pool, now there's a lot more incentive for me to actually figure out, how do I interpret a criminal record? What aspects actually matter for my position? And finally, I think it's interesting to contrast this issue with ban the box policies, where there's evidence that employers are hungry for information about criminal history from these policies, particularly if you think about this great correspondence study by Egan and Starr. So there seems to be tremendous demand for this criminal history information, yet it's kind of less clear from considering this conviction margin that employers actually know how to use that information. So in summary, the authors of this paper document large labor market effects of pretrial detention. These effects are at least in part driven by employer behavior. Yet I think the evidence suggests that given available information, conviction per se is not that informative a signal. And so what do we learn from that? Well, employers appear to be responding pretty strongly to what looks like arguably an uninformative signal. And this could suggest either that employers are actually responding to just the legal considerations on whom they can or should hire, or it could tell us that they really have significant misperceptions about what information a conviction actually conveys. So I'll stop there. Those are my comments. I think this paper was a pleasure to read. I find it quite thought-provoking, and I look forward to talking about it more.
Thanks very much, Conrad. The second discussant is Justin Wolfers. Got it. You're still muted, Justin.
I love it when there's a cartoon that can really just summarize a whole paper. And, here's the judge, and he's just saying, since this is your first offense, and importantly here, you've not yet been found guilty. So this is pre-trial. I'm going to be lenient in my sentencing. And really, that's the starting point of this paper. And the starting point's actually the 2018 AER paper by Will and Crystal with a co-author, Golden. It's an unbelievably good and careful paper in which what they're interested in is the effects of pretrial detention on longer run outcomes. And so the way they get at this really high quality causal stuff is there's random assignment of who your judge is on a given day. That's the random assignment there. And if you're unlucky, you get the hanging judge. Hanging judge is going to throw you in jail straight away while you await your real trial. And that may lead to bad outcomes. And of course, they can see this because there's a control group. There's a bunch of people who got the lenient judge. The lenient judge put them out on pretrial release, and we see that they have better long-run outcomes. And so this is just incredibly convincing evidence that if you are given pretrial detention, you will have much worse outcomes. So in other words, this is a very clean identification of the direct effects. But of course, for policy, we care about a lot more than the direct effects on the person who's put away. And so today's paper really is, well, we've got this wonderful paper on the direct effects. What about the broader spillover effects? What about the effects of this on others? Sometimes we might call this partial versus general equilibrium, but actually a lot of these spillover effects are even sort of partial equilibrium. So really, the whole paper is very much a metaphor for the difficulty all of us have when you get these incredibly well-identified micro studies, often done by labor economists who've managed to slip something, who've been well-educated by the identification police. But how do we then get those well-identified studies to speak to policy issues, which unfortunately operate in a macro general equilibrium world? So I'm going to say three things, and the truth is I'll probably just say two. The first question I want to ask is, are these macro spillover effects actually plausible, the ones that Will presented? And then I'm going to argue they're not, and I'm going to suggest actually a reasonable prior is that the spillover effects may even go in the opposite direction. So look, here's the study. This again is the 2018 AER paper, in which he finds that if you're detained, the chances of you working, and this is 3 to 4 years later, is about 10% lower. So in a given year, there are 10 million people arrested. 37.8% of them are detained. If detention reduces employment by 9.4 percentage points, that says if we got rid of pre-trial detention, we would raise employment by 355,000 people, right? Now, actually, that's probably an overstatement. So let me just do some sort of second order stuff. I started off by saying 10 million people are arrested, but actually there's 10 million arrests. Lots of people are arrested many times. So a reasonable guess is that actually the true number of people arrested is half that. And I'm going to spend most of my time talking about the outcomes I know how to interpret best, which are the effects on the employment rate. Will was looking at the employment rate of those aged 25 to 54. Now, they're only 57% of all detainees. The final thing is he focuses on this coefficient here, which is the effect of employment 3 to 4 years later. In the original paper, it turns out he has actually two coefficients. One is, what are the effects in the first 2 years after pre-trial detention, and the effects in the subsequent 2 years? And the latter turns out to be big and the former turns out to be small. So I don't know what to do with two coefficient estimates like that. So rather than just pick the big one, what I did was I took a precision weighted average. And the precision weighted average of those is actually only 60% as large. So now we take this 355,000 people and we scale it down accordingly. And this says that if we got rid of pre-trial detention, it would lead to about another 60,000 jobs, workers among those aged 25 to 54. 60,000, keep that number in mind. Because now we want to move to, that was the first study. What are the individual micro effects, the direct effects? Now, if we want to get to the spillover effects, we're going to have to look at what happens at whole communities. And that's what this paper is. This paper looks at the change in employment rates over a 10-year period against the change in the detention rate. And it does this by looking across counties. So you figure if all the spillover effects are within county, this is going to show you the full effect, the direct plus the spillover effects. Will just showed you this slide. He says employment, taking the regression coefficient seriously that he just showed you, it says that the employment rate, if you got rid of cash bail, would increase by 7.5 to 10 percentage points. That's an increase in the employment to population ratio. That's staggeringly large. Now, I think he's slightly miscalculated. So I'm actually going to take his numbers. I'm going to scale them back to what I think they are. And so the employment rate, I think, actually only increases by 3.6 to 6.4 percentage points. This is using his smaller coefficient. This is using his bigger coefficient. Okay. So I'm reducing what he does. Now, it turns out in 2000, when he's looking at long differences since 2000, there were 63 million 25 to prime age people working. And if getting rid of pretrial detention would cause the employment to population rate to rise by 3.6 to 6.4%, that means it would create another 2.2 to 4.1 million extra jobs. Compare that to the direct effect, which was 60,000 extra jobs. So it looks like the indirect effects, the spillover effects, are 35 to 70 times larger than the direct effects. This just seems too large to be plausible to me. Now, what I'm going to do is I'm going to try as hard as I can to reconcile. So let's try and figure out, the micro study tells you what are the effects of being detained on your employment in a specific year. What does that mean in a steady state? Well, if detention only has effects on 1 year, losing 60,000 jobs for 1 year will only cost you 60,000 jobs. If that scar sticks with you for your entire career and there's on average 30 years left in your career, do we want to multiply this by 60,000 and say the direct effect will be 1.8 million jobs? Now, I suspect it's unlikely that when you're 60, that you're not going to get a job because of a crime you committed when you were 24. So I suspect actually the scar depreciates. So I made up a number. Let's say that the scar depreciates 10% a year. That says the direct effect can get you to 600,000 jobs. So far, so good. Now, remember the direct plus the spillover effects, I told you was 2.2 to 4.1 million jobs. But that's what would occur if all of those effects occurred on the first day of his sample. Typically, you'd expect things to change slowly. And so when things change slowly, the average effect turns out, which is what the econometrics measures, turns out to be half the steady state effect. So that says the total effect would be 4.4 to 8.2 million jobs. So again, the spillover effects look to be 10 times larger now than the direct effects, which still seems too large. Let me give you another way of thinking about how large they are. Here's the employment rate of 25 to 54-year-olds. The financial crisis caused that employment rate to decline by 5 percentage points. Will and Crystal are arguing that if you eliminated cash bail, it would cause the employment rate to rise between 3.6 and 6.4 percentage points. So they're arguing that this one small part of the labour market has an effect as large as the financial crisis and nearly as large as shutting down the entire service sector of the economy. So this seems sort of too large to be right. Let me say one other thing. They do an analysis separately for blacks and whites. So this is black employment against the county-wide detention rate and white employment against the county-wide detention rate. Now realize the horizontal axis is not showing a different effect by race. That's important because these coefficients turn out to be remarkably similar. The effect on blacks is, as you would expect, somewhat larger than the effects on whites, about 50% larger. But what should we have expected? Well, it turns out, of course, that inside, among people who are detainees, there are 2.3 blacks for every white. In the population, there are 5.3 whites for every black. So that means if you're looking at the ratio of detainees per capita, there are 12.3 blacks to whites. This suggests that we should have expected the black coefficient to be 12 times larger than the white coefficient. Instead, it's only 50% larger. So that suggests maybe there's something else going on here. So I'm not sure I'm convinced by the macro effects, and there's a bunch of whiny complaints about this later, and hopefully for your sake, I'll skip them. But I just want to ask, what is a reasonable prior for what these spillover effects would be? So I did the simplest thing I could do, which is I wrote down a really complicated model of the labour market. Labour supply, of course, depends on the marginal utility of leisure. Labour demand is the marginal revenue product. What would happen if we took a whole bunch of people and gave them pre-trial detention? Well, it wouldn't change the marginal utility of leisure and it wouldn't change the marginal revenue product. So to a first approximation, the equilibrium with pre-trial detention is the same as the equilibrium without pre-trial detention. So in equilibrium, we don't expect a small number of people behind bars to change total employment. All right, that's a little bit too simple. Let's not take perfect competition seriously. What if we're in a world that has some rigidities? So here's a friction that creates unemployment. Fair enough. Now, what if we have pre-trial detention? If we've got unemployment, there's a queue at the factory gate. I now get to choose who to let in. If I want to discriminate against those who've been detained, I can now do so for free. What I do is I take some of the people who previously I was going to let in and I'll stick them back out the other side, but someone else is going to come in and take their job. So even here, we'll see direct effects on the detained, which is what Will's earlier AER paper showed, but no effects on the total in equilibrium. So I'm being too simple and a little bit glib. So let's think about what pretrial detention actually does. It leads more people to be found guilty. That's what they find. And more people to plead guilty. But it doesn't actually lead them to spend any more time in jail after they've been incarcerated. What it leads to, in fact, is for them to spend more time prior to the disposition of their case in jail. How much longer? 2 weeks. So this whole thing seems like it's really small. You spend 2 extra weeks behind bars. So what must be going on? It must be that the main effect is that a criminal record is a signal or a scar. And this is very much what Conrad was suggesting earlier. So if we eliminate pretrial detention, then we suppress that signal. What are the spillover effects going to be of suppressing that signal? So here's a wonderful study by Amanda Egan and Sonia Starr, in which they send out resumes and they say, what are the effects of having a criminal record? They send out resumes with historically black names and historically white names, and they measure the callback rate. And what you see is for both, if you have a crime, if you've committed crimes, your callback rate is much lower than if you haven't committed a crime. This is exactly what you'd expect. Right? But then ban the box comes in, and you're no longer allowed to ask people whether they've committed a crime. And so what happens now is that the callback rate for whites, all whites, goes way up, but the callback rate for blacks goes down. They can no longer signal that they're not criminals. Employers infer then maybe they are, and they become much less likely to hire them. So suppressing this signal really hurt black workers. In fact, you can see this with this wonderful paper from Doliak and Hansen, in which they look at when cities adopt ban the box. Cities that adopted ban the box, the employment, oops, I've got these labeled the wrong way, I apologize. The employment of black men declines relative to cities that didn't. And we see no such effect on white men. All of this says that the spillover effects may actually be negative. So let me just pause there. Let me just stop there. I just want to say the big points here are these spillover estimates credible? They strike me as being incredibly large. And then do we necessarily think these spillover effects are going to be negative? And it's not obvious that they are. So I think a reasonable prior is to say the spillover effects are going to be either an order of magnitude smaller than Crystal and Will suggest, or they may even be negative. Let me stop there.
Thanks, Justin. And I'm going to open it up to questions. I give people a chance to put their hands up. And while we're waiting for questions, maybe Will, you want to respond to some of the discussants' points, or Conrad, if you want to add in some more comments after hearing Justin's comments, we can start the discussion with the panel.
Yeah.
So Will, you want to lead it off?
Yeah, I'll quickly respond, but Justin, Conrad, thank you both, and I'll follow up afterwards. Justin, just a couple quick notes. The IV estimates are actually case weighted, so you don't want to do the deflation that way. And I apologize, we didn't explain those numbers. We're actually adding the base change in as well, so we have the same numbers as you. So anyway, I think some of the deflations you're doing are not actually what we should do, but the broader point is 100%, we agree. I don't think changes on changes is anyone's idea of a lock solid identification strategy. And we would never want to interpret those estimates as seriously as the micro estimates. And like you said, that's the challenge. So I think, we're trying to provide as much information as we can and keep the conversation going. But if we wrote the paper in a way that suggested more seriousness to those estimates than we meant, then we'll definitely revise. The one thing I would say is I don't think that the implication you drew from the Egan studies, I do think that's not quite right. Because again, the Egan study is really holding the mix of people constant and is taking away information. Here, we're actually changing, who the people are in a sense. We're taking away a scarring activity. And so I do think that the implication there isn't quite mapping one-to-one in the way that, that you're suggesting.
Conrad, did you want to jump in?
I don't have any.
Okay.
Yeah.
All I mean, one follow-up I had was similar to what Will just said, that Justin drew, a parallel between the ban the box policies and your elimination of cash bail. And so maybe you could expand further on the difference between those policies, or maybe Justin wants to comment as well, or other possible policies, because I think there's a debate here about the magnitudes, but it would be interesting to think about what other policy interventions might address the effect that you're identifying and that you identified in your earlier paper.
Absolutely. And Conrad, I'm going to lean on you for the second part of my reply, but I think broadly you can think of helping people in this population in at least two ways. One is to prevent the scarring effects in the first place, and I think that's really what our paper is about: is to say, well, here are changes that we could potentially make to the criminal justice system. In the AAR, we show that the changes to public safety are going to be minimal, and yet it seems like there's large economic benefits to the individuals themselves. And so if we kind of multiply that out, this seems like a bit of a no-brainer policy to actually just make these people more employable from the point of view of employers by not putting them through the scarring experience. I think the other set of policies that you should be interested in, might be interested in, would be things like ban the box, where we say, holding fixed what's happened to people, how do we get them reintegrated into the labor market, particularly in light of some of Conrad's points that people are using these signals in a way that it's not obvious and makes a lot of sense. So that's definitely work that I'm interested in as well. And I think building on some of Conrad's ideas, that could be things like increasing liability protection for employers, or providing more objective information. So in other work that I've been doing with co-authors, we show that at least where we have productivity data, individuals with and without a criminal record seem like they're just as productive. This happens to be a setting where we have really fine-grained productivity data. It also seems that employers are very responsive to when we simply just tell them, it turns out that at least in this setting, people are just as productive. You're making mistakes in the way that you're screening folks. So I think, I would very much put ban the box in the category of, well, we've put people through this very scarring experience. How do we reintegrate them? Whereas I would put pretrial policies in the category of, let's avoid scarring people in the first place when there's no real public benefit to doing so.
Look, let me just add something here. I don't want to take ban the box too seriously as the analogy, but what I do want to do instead is just think about just a very, very simple model about what you expect the general equilibrium effects to be. So the treatment is like 2 extra weeks in jail. That's almost nothing. Therefore, it sounds like you think it's almost all signaling. So this is like we walk around and on 10% of the population, we put the letter L on their foreheads. And then we try and figure out what the long run effects of that are going to be. It's obvious that it's going to have direct effects on them if this is a socially constructed group that we want to discriminate against. For most models of the labor market, the net employment effect of putting a scarlet letter on some random group of the population, 0. So I come with a very strong prior, not that it's a negative effect like ban the box would tell you, but it's got to be awfully close to 0. And there's second order reasons why it might not be. And again, I do think it just speaks to this broader thing. There's wonderfully identified micro studies, but then how does this play out in equilibrium?
I mean, the one thing that would give me pause is the same arguments were made about the micro estimates. So before our paper was written, the most common thing we would hear from economists is it's only 2 weeks. This can't possibly have effects 4 years later on the labor market. Why would it have any effects? So I think it speaks to the broader point that we do need better macro estimates. And I totally take the point that this paper has not gotten us all the way there where you and I will necessarily agree now, but fingers crossed, if we get invited back in a couple of years, we'll have better evidence and I can sway you with the data.
Just one quick interjection here. I think the comparison with ban the box makes this response to convictions a lot easier for me to interpret just in making the contrast, because in some sense it is pretty different in the type of information that would be obscured here if we removed pretrial detention, because what's happening, at least in the context of Will's study, is it's not as though you could get all the information about the underlying case, who the judge was that sentenced this person. in principle, you could basically get all the information you need, yet people are responding to the conviction itself, which I think is I don't know how surprising it is, because maybe, you know, people aren't getting into the weeds as Will and Crystal are, of course, but it is kind of striking that people would have such demand for a criminal record, as is indicated by the Egan and Starr paper, but they're not, it doesn't seem like they're digging in to look at, you know, someone's arrest record in principle tells you just as much, regardless of the conviction outcome.
So we have a couple of questions queued up. Let's start with Steve Davis and then Erica Grosjean. We have, there's Steve.
Yeah, thanks. Great paper discussion. I wanted to speak to two issues briefly. One is why do employers screen on a marginal conviction, much of which Conrad focused on. And there's an answer to that implicit in what Justin said that I think is worth drawing out. And that is, in many settings, employers cannot benefit by paying less to convicted felons, which would increase their incentive to hire them. And so we have minimum wage laws, collective bargaining agreements, fear of lawsuits, and firms' own internal compensation policies that don't really open that avenue towards taking a chance on risky hires. And I think that's something to consider in the design of these policies and institutions. Second, let me speak to Justin's point about, you know, why the equilibrium effects might be quite small, even if we take the tightly identified individual effects as large. And I think the point is largely right, but there is one kind of effect that I don't think will get swept away in equilibrium, and that is the effect of the scarring on the incentive to accumulate human capital that makes you more or less employable in the future. And here I'm thinking about this in a broad way. If you decide to engage in, you're more likely to engage in criminal activity going forward rather than pro-market investment type activities because of this scarring effect, then that will persistently and possibly cumulatively in greater and greater force over time reduce your employability as an individual. I don't think that's an effect that will get offset in equilibrium, because you're basically taking a segment of the workforce and just making them less employable, less productive in the legal sector.
Thanks, Steve. Erica Grosjean is next, and then Carolyn Hawksby.
Okay, so there are two things that I wanted to raise. First of all, actually, there's a group that I've been working with here at Cornell that is investigating the accuracy of criminal records that employers have access to. And this information is really lousy. And so it seems to me that that acknowledging how bad that information is, you could imagine models where it would exacerbate the impact of that information. But the second thing is, maybe another way to think about this is that it's another set of comparisons that might be useful is to think about displaced workers. In the simple model that Justin's talking about, there would be no wage impact of displacement. And yet we know that there is a wage impact of displacement, particularly for people with low amounts of education, right? And so if one of the major impacts of a pretrial detention is that you lose your job and you become like a displaced worker and additionally have this scarring effect on you, then you could imagine that that sort of thing that you're estimating is not so far off. And so that might be a comparison that you want to make.
Great, thanks. And now Carolyn?
Sure, I'll try to be really brief. I'm thinking back actually to a comment on Justin's discussion where he had his nice little graph with the unemployment wedge between supply and demand. in the labor market. And what Justin suggested, which made a lot of sense, was that I displace someone from the employed pool and put the person in the unemployed pool, and then I pull someone who would otherwise be unemployed and I put them that person in the employed pool. And that all makes a lot of sense, and it's very rational. But I will note that if you look at the Egan and Starr paper, it suggests that when the ban the box policy is put in place, employers more than statistically discriminate against Blacks. And so it might be the case that if we're doing this kind of employment swap, I make someone unemployed who's Black, and I replace that person with a Black person. And if I make someone unemployed who's white, I replace that person with a white person. In that case, the spillover effects could be quite different from what you would expect if I were willing to draw from the pool of the unemployed at just sort of the ratios in which they exist in the unemployed. The spillover effects could be kind of exaggerated.
Great. Thanks for those comments, and those all really helpful. And also thanks to the authors and the discussants for a terrific panel and follow-up discussion here. We're going to take a 5-minute break, and we will come back at 4:10 Eastern for the cognitive skills paper, and we'll hear more from Carolyn.
Eric, hi, Brian.
Oh, hello. Making sure my buttons work, so it's good.
Okay, I think we're going. So welcome back, everybody, and it's nice to see Caroline, Brian, and Eric here for the final paper. Caroline Hawksby, Cognitive Skill Deserts.
Okay, I am sharing my screen now. And let me just get started. So today I'm going to be talking about mapping advanced cognitive skills in the United States. And let me give you a little bit of a plan for today. The plan is I'm going to tell you two anecdotes that I think are very important. They have two takeaways that will help you understand the rest of the presentation. Then I'm going to give you a bit of neuroscience in a nutshell, very short, but just enough to know what you need to know. We're going to look at several maps of the United States, which you can assess largely for yourself. These are pretty straightforward. And then I'm going to end with some speculations. So let me tell you two anecdotes that really motivated this project. The first one took place when I was doing research on charter schools. I was doing research on more than 100 charter schools, and I was aware of a charter school network that began all of its schools with the 5th grade. And I thought that this was just crazy. And I actually told the charter schools this as well. And the reason I thought it was crazy was that I had been inculcated by that point with the notion that if you did not get a child by the time the child was maybe age 3 or age 4 or at a maximum, maybe kindergarten, the child was probably not on a great trajectory if the child was already falling behind. And therefore, it made no sense to start a charter school with the 5th grade. This network of charter schools always started with the 5th grade, ran through the 8th grade, and they were picking up students who were in the lower third of the achievement distribution and from very disadvantaged households. So I thought they were just crazy to be starting with the 5th grade. But when I actually did the empirical work on this charter school network, and it was a lottery-based study, so the results were very credible, what I found was that these charter schools raised achievement far more than any other charter schools. And in fact, they were able to move students from the bottom third of the achievement distribution to the top of about the 67th percentile on average, something like that. So just amazing transformations. And what I took away from this was that adolescence was not too late to begin trying to transform children. 5th grade was not too late to be trying to change children. The other anecdote that I want to tell you about is something that everyone who's an economist of education runs into all the time, and that is Algebra 1. It's often called the gatekeeper in education. Most people take Algebra 1 for the first time in middle school, 6th, 7th, 8th grade, something like that. And a lot of students sort of stall out in Algebra 1. In fact, they continue to take Algebra 1 throughout the rest of middle school and high school, although it's often called something different. And many people object to this and say, we should really not have Algebra 1 be this gatekeeper to higher level learning in math and science. We should eliminate Algebra 1. Furthermore, Algebra 1 is the most common higher education course in the United States. It accounts for about 8% of all higher education course taking in 2-year colleges and 4-year colleges in the United States. And again, it is a gatekeeper in the sense that if a student does not pass through Algebra 1, the student tends to drop out of college or university without getting any type of degree. But what I've really learned over time is that Algebra 1 is not a gatekeeper. It is a marker for students having made the transition to having advanced cognitive skills. It is by no means the only marker. It just happens to be a very convenient marker, and we'll talk about that when we get to the neuroscience. So the fact that students get stalled in Algebra 1 and that it has strong predictive power for future cognitive development isn't telling us something about gatekeeping. If we eliminated Algebra 1, that wouldn't really help. Okay, what it's telling us about is that there are a set of students who are just not making a successful transition to advanced cognitive skills, which I'm about to define, so don't worry about that. All right, so what is this paper going to do? First, I'm going to show you advanced cognitive skills maps of the United States, and I'm going to demonstrate that deserts exist. And by deserts, what I mean is places where advanced cognitive skills are not at all prevalent among adults. And I will note, and I think this is very important, this is not the same thing as saying that there are areas in which few people have high educational attainment or few people are employed in skilled occupations. So for instance, if we think that the problem is just low educational attainment, it might suggest that we have policies like more generous funding for public colleges and universities. We might want to have merit scholarships for in-state colleges that are designed to keep skilled people in state. Or if we think the problem is just a low prevalence of skilled occupations in the area, then we might want to have place-based policies that are designed to attract firms that want high-skilled workers. Whereas, if we really have a local lack of advanced cognitive skills, these types of policies will not be very productive. Simply plonking down more public colleges or more merit scholarships or more firms that demand high-skilled workers is not going to take care of the underlying problem, the more fundamental problem, which is a lack of prevalence of people with advanced cognitive skills. So that's the first thing I'm going to try to do in the paper. The second thing I'm going to try to do is just show some very basic evidence that's going to allow us to parse three explanations which are not mutually exclusive at all. The first one is early age factors that are difficult to affect with policy. And by that, I'm going to mean factors that affect children between the ages of birth and about ages 2 or 3, but maybe up to 4 or 5. I'll be more generous than that. Adolescent age factors that are more likely to be influenced by policy, simply because we have adolescents in schools 5 days a week, 6 to 8 hours a day. So we have much more opportunity to influence them. And then finally, migration from some areas to other areas, so that the fact that there's variation in advanced cognitive skills prevalence in the United States is really a consequence of migration and not a consequence of something that's more fundamental to different areas. And then I'll discuss implications of these mapping exercises. So first, let's talk about what advanced cognitive skills are. It is higher order cognition that cannot take place in your brain until your frontal lobe has been developed. So it's actually a fairly tightly defined set of things. So it's higher reasoning, logic, abstraction, critical thinking, and synthesis. It also includes planning and self-regulation. This is what happens in the front lobe of your brain. A perfect example is algebra, because it requires translations of problems into equations, solving of abstract problems and proofs. And this is as opposed to even quite difficult rational numbers reasoning, such as long division, which does not require this sort of abstraction, solution, higher order reasoning. I've also given you an example from history coursework. Now, neuroscience indicates that advanced cognitive skills develop in adolescence and not before. And I've given you just a little tiny taste of the neuroscience here. Basically, at the very beginning of adolescence, you have all the possible neural networks in your brain. Then those are pruned by synaptic pruning, which starts at about age 10.5 for females, 11.5 for males. After that, a process called myelination speeds up and reinforces the neural circuits that remain. This means that your frontal lobe is unusually plastic for a few years starting in early adolescence, and it allows you to really learn a lot of things and get to the advanced cognitive skill stage, but it also allows you to not make that transition. Okay, there is an analogous crucial period for the back and central parts of your brain. Those are -3 months, 3 months before birth to about 2 years. And this crucial period is important for motor skills, language skills, visual skills, learning skills, social skills. So it's not that that period isn't important, but it's not you cannot learn algebra, no matter what little Einstein you are, you cannot learn algebra until your frontal lobe develops. So it's a pretty well-defined set of skills. I have one quotation here from Lawrence Steinberg, but I'm going to skip on to this next one from his book called The Age of Opportunity. The abilities that develop in adolescence are not as necessary for life as those that develop early in life. You can live without being able to reason logically, etc. And unlike elementary skills, whose development is tightly regulated by pre-programmed biology, evolution left more room for variation in the development of complex abilities. Let you read the rest of that paragraph. In the past, not all environments demanded advanced cognitive abilities. In today's world, though, where formal education is increasingly important for success, people who are bad at reasoning, etc., find that the fact that the development of these abilities is highly sensitive to environmental influence is a mixed blessing. For people in favorable circumstances during early adolescence, the plasticity of these brain systems is wonderful. For those who aren't, the same plasticity can be disastrous. So it's an age of opportunity, but also at risk. I'm just going to show you a little bit of evidence that advanced cognitive skills trajectories harden by age 15. So they start hardening by about age 15. On the rows here, I have 10 deciles of math achievement in 10th grade, about age 15.5 for males. And in the columns, I have 10 deciles of math achievement in grade 12. That's about age 17.5. And if everyone stayed in the same decile from age 15.5 to 17.5, everyone would be lined up along the diagonal. You can see that the diagonal is quite prominent. For instance, if you look at row 8, which is the 8th decile, so third to top. It's a good measure of advanced cognitive skills. About 37.5% of them stay on the diagonal. That means they end up in the same decile where they began. And most of the people are staying in deciles 7 through 9, showing that there's a fair amount of hardening of the trajectories. If we just look at an earlier age, at 5th grade through 8th grade, so early adolescence, you can see that there's a lot less hardening. If you look across that same row, only 22.7% of those who start off in decile 8 and up in decile 8, there's just more off the diagonal activity altogether. So brains are more plastic during early adolescence, and they later harden up. And then as we get older and older, they harden up more and more. We can talk about that during the discussion. So now let's look at some maps of the United States and see whether advanced cognitive skill deserts exist. So this is the typical map of the United States. It's a chloropleth map, so the darker the county in the United States, the more prevalent are advanced cognitive skills. We're looking here at a test called the BPEA, which tests adults in the United States between the ages of 16 and 65 on literacy, numeracy, and some problem-solving types of skills. I'm looking at the numeracy scale here for reasons that don't just have to do with math and algebra 1, although being able to score in the advanced category here basically means you can do very easy algebra 1 problems. I think Brian Jacob might show you a very easy algebra 1 problem that's on this test. That's kind of what gets you into this advanced cognitive. So it's not terribly high up. About 37% of the American public gets into this category. And I will note for you that you ought to neglect paying attention to those big counties in the United States that have a lot of land mass but hardly any people. They occur in Nevada, Southeast California, and so forth. You know where they are. Okay, so let's look at some areas that you would expect to see. These are areas where you see a lot of advanced cognitive skills. They're very prevalent. So you can see Boston, New York, the Washington, D.C. area, Chicago, Salt Lake City, Seattle, Portland, San Francisco, Los Angeles, San Diego, and Sacramento in California. You'll also notice this area in the middle of the United States. This is usually called the Lutheran Belt. It's where Lutherans settled a lot, and it's no surprise to economists of education that you see a lot of advanced cognitive skills there, although this is not a place where there are high-tech capitals of the United States or anything like that. Okay, now let's look at some of the areas that inspired the title for this paper. So these are areas in which we see an unusual lack of prevalence of advanced cognitive skills in the United States. And the first area that I'm picking out for you is Appalachia. This follows the Appalachian Mountains from northern Alabama up through Pennsylvania and actually into southern New York. And with the exception of college towns, which are picked out in the paper, but I'm not going to show you that map here, with the exception of college towns that are in that sort of skill desert, it is an area that is very, very low in advanced cognitive skills. Many of these counties have 5% of the people, 6% of the people scoring in that top 37% in terms of numeracy skills. I'll also pick out the Ozarks for you. That's another mountainous area. It's in southern Missouri, eastern Oklahoma, and northwestern Arkansas. But like Appalachia, it's almost all white. So these are areas that are not very mixed in race. And then I'll finally pick out a sort of area for you that I call it the Inland South. It sort of snakes through from East Texas all the way up to southern North Carolina. Now, this is a very mixed race area, so it's different than the other areas. Remember, these are for adults. Now we're going to work backwards to try and figure out when does this map of the United States in terms of advanced cognitive skills appear, and I'm going to work backwards through grades 12, 8, and 3 in that order in order to figure out these early age factors, adolescent factors, and migration factors. And I'm going to try to go fast because I can see I'm running out of time. This is 12th graders scoring above the 90th percentile. And you can see that the map already looks a lot like that of adults. In fact, we can pick out Appalachia, the Ozarks, and this inland southern United States area pretty clearly. They're not very different than that for adults, suggesting that migration doesn't play a very big role. If we look at it for 8th graders, the patterns are already pretty evident by 8th grade. If we go back to 3rd grade, though, the patterns have started to look quite different. Let me pick out a few big differences for you. Appalachia doesn't look nearly as much like a skills desert. North Florida and also Indiana now look like they have a lot of advanced cognitive skills. They don't look like that for adults. And the Southwest and California look very different than they're going to look for adults. So that's something where immigrants might be an issue. I do a longitudinal exercise in the paper. I don't think I really have time to go over it here, but let me tell you what it demonstrates. It demonstrates that the correlation between a child's being in the top 30% and the local prevalence of adults with advanced cognitive skills is only moderate. It's about 50% correlation. So if you're born in an area that is a cognitive skills desert as a child, you're not necessarily going to turn into someone who has a lack of advanced cognitive skills. But this correlation does rise very substantially in adolescence from about age 10 and a half to about age 15 and a half. Migration is not an important factor before the 12th grade. After that, migration does become a major factor that explains the rise in the correlation, mainly with people with advanced cognitive skills going on to college. So they're moving to areas where there are a lot of other people with advanced cognitive skills, and also apparently moving for job-related reasons, although it's hard to show that that's why they're moving. Okay, so finishing up, what are some of the implications likely to affect children directly? Well, what we found is that advanced cognitive skill deserts are associated with factors that disproportionately affect adolescents and are associated with a local absence of adults who have advanced cognitive skills. So an obvious one might be something like a scarcity of local teachers who have the skills to teach advanced courses, or it could just be a relative neglect of the middle school grades. I have another paper on that we could discuss, but it doesn't necessarily have to be something about education. It could be something where schooling is just collateral damage. It could be, for instance, a culture that expects people to start being parents in their teen years so that teens sort of give up on spending a lot of their time focusing on school and instead start focusing on teen parenthood or something like that. The key thing is that a child who begins life in an advanced skills desert nevertheless has a reasonable probability of attaining advanced cognitive skills. So we need greater analysis of this crucial period of adolescence, brain development, because it does indeed appear to be an age of opportunity, and let's try to make it that instead of an age of risk. And then finally, just for some speculative evidence, when I was writing this paper, I started to think that maybe children who were born in advanced cognitive skills deserts might reasonably develop economic fatalism, resentment of perceived intellectual elites, or a lack of social trust. And a paper by Eric Hurst and some co-authors demonstrates that when an area experiences a decline in manufacturing, industries that don't need advanced cognitive skills very much, there are persistent negative effects on employment and wages. So if I were a student and I reached age 18 and I didn't have any advanced cognitive skills, I might realistically foresee a long future ahead with little hope of achieving economic security. That might lead me to something like opioid use or death of despair. We all associate Case and Deaton with those deaths of despair. And if you compare the maps in their work to the maps that you've just seen, you will notice striking similarities. There's also some work on that in Eric Hurst's paper. And finally, I will note that if people perceive technical change to be persistently skill biased for the foreseeable future, students who reach age 18 without advanced cognitive skills may foresee a future in which demand for their skills is just going to persistently fall, while the demand for skills of intellectual elites is persistently rising. In global trade or immigration, they may think that that exacerbates these forces. This might lead them to resent or distrust elites or support politicians who oppose trade and immigration. So I'm going to leave you with two suggestive maps that are just to stimulate research and thought. The first one is the percentage of adults who believe that most scientists think that global warming is occurring. So this is not that you believe it yourself, but you believe that most scientists believe it. Actually, more than 90% of scientists believe it. And you'll notice you can easily pick out Appalachia and the Ozarks there, not so much the inland south. Okay, so there's some striking similarities. And then finally, I'll leave you with one final map. This is the share of votes for Donald J. Trump in 2016. So put your reverse colors map on in your head, and you'll notice that you can pick out some of the same areas of the United States, the Ozarks and Appalachia in particular, and also an area sort of going north to south in the United States that was a bit of an advanced cognitive skills desert in the earlier work. So I'm going to leave you with this map, and this you can speculate for yourselves about what this means.
Okay, thanks. First discussant is Eric Hurst.
I think I need Caroline to yeah, there we go. Now I can share my screen. Boom. Okay. So so the paper, it's an empirical paper with some kind of thoughts about what's explaining the patterns. And so there are advanced cognitive skill deserts within the United States, so spatially places where people do very poor on some tests that were designed to measure some sorts of math or reading cognition. And potential different investments in these skills during adolescence may be responsible for these deserts. And so the paper has lots of data for different groups and the spatial variation. And I think all of that is wonderful. And so in my 12 minutes, I'm only going to do two things. And so I want to talk a little bit about the relationship between advanced cognitive skills and educational attainment more broadly. And I'm going to show you some maps on just the share of people with a bachelor's degree, and we could compare those to kind of some of the maps that Carolyn showed. And so then I'm also going to discuss a little bit how the spatial variation in skill deserts is related to other types of demographics. I'm going to show you some stuff on race. Not everything is going to be race, as again, the Appalachia is different, but other places might be much more correlated. And so we're going to do a little bit of that as well. So this is the picture that Carolyn showed. In the paper, I took this from the paper. I didn't have the color version. So this is in black and white, but the pictures I'm going to show you next are going to be in color. But as you can see, this is going to be the share of people who scored relatively low on a standardized test to measure, as Carolyn said, advanced cognitive skills. It's going to be some math numeracy, if you will. And if you kind of your eye just draws to it in black and white, you can kind of see the same areas that that were shown in the presentation. There's big declines in the South relative to other regions in these measures. You see a little bit in the Appalachia, a little bit in the Ozarks, pockets along the Texas border or so. And so with that as a backdrop, now I'm just going to show you a different picture. Now this is going to be in different units with different colors from census, and this is just going to be the share of people in 2015 to 2019 that have a bachelor's degree. And so it's not in deciles like Carolyn's pictures were. It's going to just be in 40% or more, etc. But your eyes should go to the same types of places. That there's going to be this very large education desert in some places. Again, very much in the South, around Appalachia, a little bit in the Ozarks, around the Texas border. The places that are deep in the cognitive scores are also the same places that are relatively larger in the education shares. And so this brings the question of, what is it about these cognitive skills that is important above and beyond education in a measurement sense? And if they're highly correlated, maybe that is good news because we have lots of data on education shares spatially and how they change over time. And that could give us a deeper, measure that's more easy to use in some senses. But as Carolyn pointed out, education is not a perfect measure of skill. It might not respond also to the same policy levers. But again, test scores might not be either as well. So one thing I'm going to try to ask us is there measures of test score predictive measures of test scores predictive of skill deserts above and beyond education? And so that's one question. In order to do that, I'm going to exploit some data from the NLSY. And so this is going to be some work I had. I've been thinking about independently about the roles of skills when you're young and how that affects sorting when you're old along a large amount of metrics into schooling, into different migrating to different regions, into different types of occupations. And I have some papers on that. So what I'm going to do is just think about now from the NLSY, I'm going to use one measure of what I'm going to call advanced cognitive scores, which is going to be an AFQT test that young adolescents were asked in the NLSY 79 and 97. For those who are not familiar, I think most people will, the AFQT, the Armed Force Qualifying Test, is going to be kind of just a measure of cognition that people have been using in the NLSY to try to predict future labor market outcomes. What I'm going to show you, these test scores are going to be in Z-score units. So a number like 0.1 means 0.1 standard deviation higher than some other groups. And then I'm going to take the panel dimension of the NLSY, and then I'm going to figure out what people look like when they're old, how it's related to their test scores when they're young. And so the variation I have in geography in the NLSY is much cruder than what Carolyn has in her paper. So I'm going to have regions. And so what I'm showing you here is the average AFQT test score in column 1 of NLSI respondents, pooling together the 79 and the 97 cohort, and just running that in the first column on region dummies. And that's it. And then in column 2, I'm going to control for things like urbanicity. Do you live in a metro area? And it doesn't matter, so I'm not even going to talk about column 1 versus column 2. But what the NLSY shows is kind of what your eyes saw in Carolyn's pictures, in the census education pictures, is that there is lower skills in the South by this crude metric of test scores relative to other regions in the US. And you can see the admitted group here is the Northeast, and you can see, a number of minus 0.36 is a big number. It's a third of a standard deviation in AFQT scores lower than individuals who resided in the Northeast. That's a big number. And now I'm going to ask, suppose I could control for the individual's education. And so what I'm measuring here is just a control for the highest level of degree you attained at some point in the future in your life. So I'm going to use the panel dimension and go out to the future, see the highest education, and then see how your test scores of when young related to that. And education explains some, maybe about a third of the coefficient, but there's a lot of variation in test scores above and beyond subsequent education that people are going to accumulate. And so this is kind of what Carolyn said, there's something above and beyond these test scores, even relative to future levels of education. And notice that the other regions, once I control for education, look identical to each other. The Northeast, the Midwest, the West on average, all look the same. It's the South that's an outlier. And so I'm going to do one more thing, and then we'll have I'll say a few more comments, and then we'll move on to Brian, is, there are large gaps in test scores by demographic groups. And so what I'm showing you here now is just AFQT scores in the NLSY. Here I've broken it out by different waves of the NLSY in terms of black-white gaps in average AFQT scores. And I'm going to condition on your subsequent education that you get when you're old. I'm going to then, the data I had lying around easy, these are people who actually worked when they're old. And you can see that there's a big gap in these systematically, even conditional on education, between race. And so what I'm going to do in this last column here is I'm just going to control for race and see how much of the region variation in these cognitive skills measures changes when I can just condition on race. And you can see, the South coefficient falls by another, 12 percentage points, or 12.12 standard deviations in terms of narrowing once you control for race. So a lot of the residual variation between the South and the other regions is due to race. Now, as Caroline pointed out, a lot of our variation just isn't race. The Appalachian is pretty homogeneous in race relative to the South in general. But it did get me thinking a little bit about, what it is we're trying to measure with the spatial variation across space. Now, race is just one dimension of that spatial variation. And then there is a literature about whether, test scores in themselves measure skills the same way across people of different race. So let's even put that aside for a second. So what are we trying to pick up in the spatial variation? And it led me to, this will be my last comment, and then I'll move on. But it led me to think, how much of the variation would it differ if I did the same kind of patterns within Chicago itself? So I'm sitting here on the south side of Chicago, and if I go 20 blocks south, and I compare that to 20 blocks north, I'm also going to conjecture, get large variation in cognitive skill measures, in education measures, and other labor market measures more broadly between the two types of places. And so when I think about a spatial variation in this, from places in the Appalachia, again, aside from college towns, for places in the South, how does that compare to within city variation? And this is going to be my last statement. I promised my last statement already a couple of times, but this one will be my actual last one, is, we know that there is some evidence about people moving within cities and how that affects their educational attainment, their skill acquisition later in life. So a lot of the work on moving to opportunity is exactly that. what happens when we try to randomly move somebody from the south side of neighborhood to a different neighborhood, and what happens to their skills over their lifetime. And so one thing it would be kind of interesting to think about is the moving the opportunity type of studies that we know about the same type of things that we would do in the Appalachia as well, or is there something inherent different when we go to big, broad swaths of regions relative to what we would do within a city itself? Okay, I'm done now. I'm going to let Brian talk for a little while. Paper super interesting, should be a launching off point for lots of future research. Okay, I'm done.
Thanks, Eric. Brian Jacob.
Okay. Let's see. We'll share.
Okay.
Okay, so hopefully you are seeing the comment screen. Yeah, so I really appreciate the opportunity to discuss the paper. It was fascinating. And let's see, so, okay, so there's really a lot to like in this paper. I love the focus on adolescents, not just because I happen to have a few right now, but it really is a useful antidote to the recent focus on early children is really the only important factor, like as Carolyn was mentioning. The focus on kind of early developmental stages has predominated the economics of education literature in the last decade or so. I like the focus on geography, which is really in line with a lot of other recent interesting work emphasizing place. And then I thought the focus on advanced cognitive skills was very interesting as well. I'm going to have like a few questions, quibbles about that, but I mean, my main takeaway is I think the basic points are really interesting and spot on, and highlight something really important for policymakers and researchers to think about. So I think I had some initial questions similar to Eric, so I'm glad he went actually to the data and created some figures. I was wondering how highly skills are correlated with educational attainment and other proxies for socioeconomic status. Mostly because that might be easier to identify places, especially if we get into smaller geographies. I was wondering whether the distinction of advanced was important empirically. I think Caroline talks a little bit about this in her definition of what advanced cognitive abilities are. I mean, in terms from a data perspective, at the aggregate level, the average test scores in an area are very, very highly correlated with the proportion in kind of any advanced category. So I know if we kind of made similar figures with just average test scores, we'd probably see a similar thing. Finally, one thing I want to highlight, and I would love to have a discussion and hear Caroline's thoughts on, is how much of a distinction is there between advanced skills, and how does that map into the notion of general versus specific skills? Because when I think of some of the debates within K-12 literature, and especially involving adolescents, there's a lot of discussion these days around career technical education and the various trade-offs of specific versus general skills. So I think that's an interesting point for us to discuss. I wanted to give people just a little sense of what might be underlying some of these PEOC data. I mean, because I've been fascinated with this data set for years. This is a low difficulty numeracy item, basically asking folks to look at this thermometer, and if you decrease the temperature by 30 degrees Celsius, what temperature would it be? This is, I think, a level 3 item that may be included in Caroline's measure of advanced skills. This item doesn't look particularly advanced, although that could be, the problem of introspection and kind of thinking of only the Ann Arbor community here. This one, though, is, I think, a level 4, clearly in like Caroline's advanced categories. And you can tell that it does take some abstract thinking, metacognition, and so forth. So this is kind of converting different units and doing a few different calculations within one problem. So I think this is a good example of what Caroline was thinking with advanced cognitive skills. So the paper establishes that cognitive ability is malleable, that there's substantial variation in children's advanced skills across counties as early as age 8 or grade 3. And at the geographic level, the variation in child skills associated with this adult cognitive skill measure, and that correlation increases during adolescence. So I think each of those conclusions is spot on. I had a little, as someone who has kind of thought hard about cognitive test measures and assessments, I had a little caution I wanted to add to kind of thinking about working with cognitive assessments. Measurement error and scaling, I think, are going to make it really difficult to do any fine grain calculations or interpretations of some of the statistics that Caroline was calculating. Measurement error in early ages would lead to kind of us finding higher correlations with these adult measures at older ages, regardless. And then test scores, the fact that we think of test scores as interval scales when they're really ordinal makes some of the kind of exercises that people always do with test scores, including in this context, a little bit challenging to interpret. So I think this is just an example from Bond and Lang, and a really interesting paper showing with the ECLSK data that the black-white test score gap and how much it changes from kindergarten to grade 3, depending on what sort of monotonic transformations you do to the underlying test score metric, you can get very different measures of a change in the black-white test score gap. And so I think a little bit of caution if we're going to be kind of going down the path of really interpreting these cognitive assessment measures in a fine-grained way. But having said that, I found this graphic, which is kind of illustrating something that's existed for many years in international comparisons. The US historically and to this day does much better relative to other countries with younger children. This is true in math as well as kind of literacy scores. So there is something happening in adolescence, and something that is, I think, distinctly is special in the United States, that is causing cognitive ability of adolescents to kind of decline relative to children in other places. I think speaking again to the focus on adolescence. So what causes this correlation to increase in adolescence? Thinking about factors in the school system, teacher quality, accountability, funding. I think those are certainly places to look for. But I think there's lots of factors outside of the school system. I'm reminded of kind of one of my favorite books by James Coleman, The Adolescent Society, where he's kind of describing, after some ethnographic research, of the adolescent culture, a world of its own, that shows little interest in education and focuses the attention of teenagers on cars, dates, sports, popular music, and other matters just as unrelated to school. So I think, I guess it's an empirical question as to whether it would be easier to affect child development as an adolescent as it would be a younger person. But it's certainly true that we do have them for a longer period of day in school. And then I was thinking a little bit about what other work we could do, what other analysis could we do to kind of learn more about this critical period. I think looking at developmental trajectories separately by gender, socioeconomic status, race, and region would be really productive. There's some evidence that boys are more susceptible to environmental influences than girls. I think it would be fascinating to do a deeper dive into certain geographic areas. In the paper, Caroline didn't mention it in the talk, but there's a really interesting point made about the southern border and how that changes across the age span in her paper that I think is could be quite informative. And then obviously looking at experimental evaluations of different interventions would be valuable. So I took some data on, this is kind of county level standardized achievement measures from, I think, a similar source that Caroline used, and wanted to just look at the relationship between some kind of well-known test score gaps and grade. So kind of, this is regressing the male-female gap in math and English language arts on kind of the best measure I had at the county level, the fraction of adults with a BA degree. Grade, this is going from grade 3 to grade 8. So the negative number suggests that kind of as children get older, males do progressively worse relative to females. They're kind of falling further behind females as they age. But then here, grade times BA plus, the fact that this is positive and in one specification significant, may tell us a little bit about some of the dynamics and could help inform potential intervention. So boys' performance is declining relative to girls from grades 3 through 8, but the decline is largest in counties with lower educational attainment. Right. And so I think this is, I just wanted to illustrate this as the type of descriptive analysis and looking at trajectories that I think would be really interesting to do and might be kind of a way to kind of pursue potential solutions to the cognitive skill deserts that Caroline describes in her paper. Okay, and then finally here, just wanted to throw out some things for discussion about potential avenues of intervention. Considering interventions outside as well as inside formal schooling, I think is going to be important. I think especially our last year of experience with virtual learning in the pandemic, I think provides both some potential sources of optimism as well as some caution for virtual learning and how that might be used to improve cognitive ability in skill deserts. There's some interesting work, some RCTs showing that providing virtually kind of Algebra 1, as Caroline mentioned, the marker, for students in rural US schools where it's typically not offered, have long-term benefits on those students' outcomes. High intensity tutoring is another area that I think there's some promising evidence on. And then finally, I think there's growing evidence on the benefits, at least the short to medium run benefits of career technical education in high school. And I think that kind of is an interesting window to think about the relationship between these advanced cognitive skills and how they map onto the general versus specific skill dimensions. So that's all I have. Really interesting paper, lots of good insights, and I look forward to discussing it a little bit now.
Okay, thanks very much, Brian and Eric. So we'll go to Q&A. So there's a hand up, Carol Graham.
Yeah, hi. I really enjoyed the paper, Caroline, and also the comments. And a couple of comments, well, points that Caroline made, and then one that was added by Eric. Caroline noted that that the adolescents were likely giving up if they didn't have a trajectory towards college, and that low skill work is essentially disappearing, which is obviously true. And then also related to this, the kind of, if you look at the map and how closely it links with deaths of despair and Trump voting, we've been matching metrics of well-being and ill-being with patterns in deaths of despair. And we find two things that fit with your story. One is that they're much higher among less than college educated whites, very well-known finding, but also that they're associated with lack of hope. So despair of all our well-being markers is the most closely associated with a probability of dying of deaths of despair or living in a place where there are high levels of deaths of despair. And these same places, which are predominantly white in a lot of the areas on your map, also have lower levels of civic education, any kind of civic community activities for young adults, and this lack of trust in science, which you noted. So you get this pattern, which is kind of a vicious circle downwards. And a lot of these same places where you have high levels of prime age males out of the labor force, not only is despair a big problem, but also opioids and lots of other things. So when you talk about moving to opportunity, these people are very likely to be living in their parents' basements or census tract. They're not moving to opportunity, even if it exists. So what that means for the next generation is obviously a pretty daunting challenge. A more optimistic part of the same story, which again, I think fits in your patterns, is that Eric noted the declining gaps in race, and that, Blacks are slowly catching up with education gaps. Well, it turns out, and including in some surveys I've been doing among low-income whites and low-income Blacks in Missouri, that minorities, both Blacks and Hispanics, are still much more likely to believe in the value of a college education than are low-income whites, even though it's harder for them to get there. So there are differential trends across races. And it seems that having hope for the future, some education aspirations, any way you want to define hope, you can measure it lots of different ways, plays a big role in whether kids who face obstacles manage to overcome them and get some sort of education and not. And all of this does roughly fit with the patterns in deaths of despair and just entire population groups that have given up of having any kind of decent labor market experience. So just to supplement everything you said, a really great paper. I enjoyed it a lot.
Catherine Abraham, are you?
I'm unmuted, but I actually would withdraw my question.
Oh, okay.
I think it pretty much got answered.
Okay, that's great. Richard Reeves, you had a question.
More of a suggestion, which is already in there. Just as Caroline was talking about the cultural aspects, just we do know teen pregnancy rates by the areas. I'm thinking about the work that Melissa has done with Phil Levine and so on. So it was just a thought for a potential development of the paper. That was all. But great, fascinating stuff, Caroline.
Yeah, if I could interject a question while we're waiting from the floor, I wonder if you could comment on gender here, because in the data that Eric was looking at about educational attainment, women tend to have high levels, say if you look at bachelor's degrees, but I wonder how this looks in Carolyn's measures, and if there are gender differences that are meaningful that you could comment on.
Yeah, so I should back up a step and say one thing for everybody. I guess I'm going to do a tiny bit of self-promotion here. So this is actually the third in a series of 3 papers, but the other 2 papers are kind of hidden because they were my Tanner lectures for the University of California at Berkeley, and they got delayed because of the pandemic. So in the first of those papers, which is called The Fork in the Road, I actually looked to see what are the long run effects of not making the transition to advanced cognitive skills in early adolescence, and it shows that there are very long run effects on people through adulthood and so on. So I'm going to get to your male-female differences there. And then in the second paper, I basically do a bunch of natural experiments that show that a successful intervention Something that is a successful intervention tends to be more productive if you do it during adolescence than if you do it before or after adolescence. So it's kind of showing that adolescence is this especially malleable period. So those are the two papers that go ahead. And it's a little confusing to look at this paper because it's like it kind of needs those two other papers, and I don't do those. In terms of boys versus or females versus males, their educational trajectories look quite different from one another. They don't look that different through about grade 3, but then they start exhibiting differences, and a lot of those differences are because brain development is actually occurring at different ages between boys and girls. So boys get about a full year behind girls, and that sort of gap between boys and girls remains right through the end of high school. And one could even argue that it is unfair for boys to be put in school at the same age as girls, because they are always behind girls in the 5th grade, 6th grade, etc., where their brain development is literally a year behind. Okay, so you can imagine how the boy gets discouraged during 5th grade and 6th grade, those sort of key math transitions where he may be lower in the class, and then ends up being on a trajectory which is lower throughout high school, maybe gets discouraged, is more likely to drop out, more likely to stay. And so there are follow-on effects from having boys be put into school at exactly the same ages as girls. And that does show up right through college and university. We know that educational attainment is higher for women than men in the United States. And that's partly because women are, at the end of high school, they look significantly better prepared on average. I mean, there are exceptions in certain types of subjects and certain types of, achievement levels, but that's in general, that's true.
So I'll contribute a question here, which is, or a comment and a question. I guess my concern or a concern is that the combination of the low sort of lack of advanced cognitive skills, and then figures like your figure on how many do scientists think that global warming is actually happening could be interpreted not as correlates, but in some causal framework. And I think it's important to stress that we don't really have that here, that these are super complicated issues, that there's a lot of things that are going on both simultaneously. This could be outcomes of the previous, we haven't commented on parental education or parental background or disadvantages that parents might have faced that was then translated into disadvantages that the youth might be facing as they're growing up, and other environmental considerations. And I think we just want to be careful in making sure that there aren't inappropriate conclusions pulled from this. So I guess then the question part of that is, how do we turn this into something where we could make those sorts of causal inferences?
Right. So I think, I'm very glad you made that point, Jim. I'm very careful in the paper to say all the time, these are associations, this is not causation. And the causal mechanisms could be many, and they're also not mutually exclusive. So for instance, Richard Reeves brought up this idea about teen pregnancy, right? That's a totally different causal mechanism. As I say, education and cognitive skills could be sort of collateral damage, but that's not really the mechanism we're talking about. Or Brian Jacob brought up the idea that adolescents may start paying attention to other things in life. They may be paying attention to sports, or they may be paying attention to cars or whatever else. And that also is, cognitive skills could just be collateral damage from that. Like being interested in cars doesn't have any probably causal relationship on that. So what's very important is the two facts that I really wanted to leave you with, and they're both about associations. That one is that there's a lot of action that's still happening in early adolescence. Not everything is not determined by grade 3. Okay, so I think that's an important takeaway, because I think people are too fatalistic now. They sort of look at a third grader and they say, gee, you're already in the bottom third of achievement, it's pretty much over. Okay, that is, I think, not a good conclusion to draw, because we can see that there's clearly still a lot of action, and that in fact, adolescents seem to be more influenced by their environment perhaps than we would think they are. They're clearly very influenced by their environment, but we don't know how. I mean, we really, and it could be some mechanism that isn't really environmental, but I don't want to get into that. But I'm just saying they're clearly still changing in early adolescence. And then the other is that there's something about it that is associated with adults' advanced cognitive skills, but it does not have to be that the mechanism runs from adults' advanced cognitive skills to children's. And it does not have to be the case that it's adults' advanced cognitive skills that cause something about disbelief in scientists. It's just that there are a whole bunch of associations which go together here. And if we want to try to understand what's happening, we want to try to look at all those associations and try to triangulate. But that's why I said in my second Tanner lecture paper, which as I said is kind of buried, I do these natural experiments where I'm actually looking to say, okay, here's an intervention. Let's try to get a causal effect of this intervention, and let's look at it if I give it to a 3rd grader, to a 5th grader, to a 6th grader, to an 8th grader, to an 11th grader, something like that. Same type of intervention, but different potential causal effects, because we should be interested in whether there are causal effects and not just associations. Because if it's just associations, then we might never be able to make very much progress on these things. But I'm actually very optimistic. I mean, I think it's funny because I think economists of education tend to be rather pessimistic based on early childhood education, because it does have a tendency to sort of feel like children get frozen very early on, and then you're sort of stuck. Like you might say, I can already see that this 2nd grader is not going to probably go to college, so I ought to be immediately aiming this person for like a voc tech program instead of aiming the child for college education. And that's whereas if you think, no, actually a lot of the skills that you need for college, nobody's learning them until they're 10 and a half or 11, then that gives you a different age of opportunities for improving a person's skills.
Great. Eric, Jake, Brian, Eric?
Yeah, can I just so how do you think about within city skill deserts versus cross city? I mean, is it the same mechanism in your mind if we looked within a city as you would see across cities, or do you think there's something potentially different about that?
I'm not sure. I think that it's very different if we're talking about big cities like Chicago, yeah, where there could really be big differences among areas, schools, neighborhoods, things like that. Because most of the mechanisms that we're talking about could vary across metropolitan areas in that way. I would think small cities, it seems a little less plausible that you could kind of have that sort of variation in culture. And I think it's important also that you have some potential variation in schools. But let me just mention a simple fact. This comes out of one of my other 2 papers, the Tanner Lectures papers. Middle school students are very much the neglected bunch of students in the United States. Nobody likes to work with middle school students. If you've ever met an adolescent, you don't want to be their teacher, okay? So if you want to see where are the vacancies in any public school system, they are in the least attractive schools, in the least attractive neighborhoods, in the middle school grades. And so those kids are in the biggest classes, they get the least experienced teachers, they get teachers who are determined to try to get out of there as fast as they possibly can and go teach the 3rd grade or go teach the 11th grade. So within a city, you could very easily see that there are quite big differences, even within the same public school system, between the quality of teachers who are experienced in one area, who kids experience in one area of the city versus another area of the city. So I don't at all think that it's necessarily a different mechanism within cities. It's just a smaller amount of variation, I guess I would say, probably.
Okay, Brian, any final comments?
No, I'm just I'm dying to know about these interventions that you found were effective and differentially effective among adolescents. But I mean, it sounds like I'm going to have to wait.
Well, I told you it was free advertising. Yeah, no, that I really did want to get at causal mechanisms, and I also wanted to make sure that these looked like they had long-term effects on people. Okay. But I think you can learn a lot more from neuroscience and the economics of education and in labor economics more generally.
Okay, well, great. This is fascinating stuff, and this brings our panel, our conference today to a close. Let me thank all of our presenters, discussants, and panelists for the excellent presentations today. Let me especially thank the Brookings staff, especially Mary King and Anna Dawson, for all of the work making this happen. Fall 21, so we're going to have a conference this fall, September 9th and 10th. Based on Brookings' current guidelines, the fall conference would need to be virtual on September 9th, Thursday. But if public health conditions improve, then we'll maybe be able to hold a 2-day conference in person. So at least what I am doing is I'm holding the 9th and the 10th in my calendar and crossing my fingers. And with that, we look forward to seeing you one way or the other in 6 months.